Welcome back to the first trade. Stock futures under pressure this morning after a disappointing report on jobless claims, which actually rose last week to 870,000. Wall Street was expecting a decline there. We've got Dow futures and NASDAQ futures each off more than 100 points. The definition of what makes a company ethical has changed over the years. It's no longer enough to run a reputable, profitable business. Shareholders are now looking at companies' track records when it comes to things like diversity, the environment, and human rights issues. Our editor-in-chief, Andy Serwer, recently sat down with actress and co-founder of The Honest Company, Jessica Alba. She explains why ethics practices should not be a marketing ploy.
If we can do anything for business, we can show that you could have a positive impact on the world. You can put health and wellness and sustainability as a value. You can have honesty and transparency as a value. And you could also have a really healthy business that has a great margin and really grows at a very healthy rate. And we have, chipped away at taking share from big, categories. And I believe the reason why consumers are choosing honest over others is because we have those values, not in spite of. And another huge aspect of our business is we give back. So we've been able to also embed, and from day one, when I put, had the first board meeting with our initial VC investors, I said we have to embed this in the model as well. And they were like, that might be stretching it. You guys aren't even launched yet. And I was like, how about this? In 3 months from now, if everyone at this board meeting feels like that's something we should take off the table, then let's talk about it. But I believe that consumers expect companies to have this type of value embedded in the model. And it shouldn't just be a marketing ploy. It should just be who you are.
For the full interview with Jessica Alba, check out Influencers with Andy Serwer tonight at 5 p.m. Eastern on yahoofinance.com or your favorite streaming device. All right, let's get back to that early market sell-off here in the futures market with Jared Blickery. Jared, a few interesting analyst calls this morning, namely Dan Ives over at Wedbush downgrading Nikola. Tell us about it.
Yeah, can you believe it? With all the controversy surrounding Nikola, there are concerns that if the allegations prove to be true, that would be in that short seller report that sparked all the controversy, that there could be shareholder lawsuits and also possibly action by the SEC. We know the SEC is already probing the matter after Nikola went to them in the first place. Nevertheless, we're seeing Nikola, which was down 25% yesterday, down another 15% in the pre-market. We're also seeing Tesla down another 5% after being down 10% yesterday. Those are some of the biggest, well, Tesla is one of the biggest losers in the NASDAQ right now. But if you take a look to the left of your screen here in the NASDAQ 100 heat map, you can see the carnage in the big cap tech stocks. Apple down 4% yesterday, down another 1.8% in the pre-market. Microsoft off nearly 1%, Amazon down just a little bit more, Facebook off more than 1% as well. And just looking into the tech space, the chips are looking pretty weak. AMD's off 1%, so is NVIDIA and Taiwan Semi. Taiwan Semi is actually down 1.8%. And then in the software sphere, that's also looking to be having a lot of losses right now. Salesforce is down 1.5%, Microsoft down 0.9%. Adobe and Oracle each off more than 1%, and Zoom, which has been a rare, oftentimes green spot in our NASDAQ 100 heat map, even when everything else is red, that is down 3% after being up about 1.6% yesterday. Even Shopify down 1.9% right now. Looking at the sector action, tech, no surprise, is off the most, 1.4%. Then we have consumer discretionary, that's off about 0.6%. Energy about the same, healthcare off 0.5% right now. And just looking at some of the names in the energy space, we're seeing Royal Dutch Shell up 1.5%, Total up 0.75%, and BP, that's up 1%. So the foreign majors, they are doing fairly well right now, while the US majors, Exxon is down 0.25% and Chevron is down just a little bit more. And looking at the US dollar, we do have that up for the 5th day in a row. That is the Dixie you're looking at after it crossed over the moving average, the 50-day moving average, which you see in blue right here, it is in liftoff mode, and that is causing headwinds for equities. And we are seeing it at the highest level that we've seen in 2 months. Correspondingly, the euro is the weakest versus the dollar that we've seen in 2 months. Alexis?
All right, Jared Blickery, thanks for that. Coming up next, we're going to hear from the Boston Federal Reserve President, Eric Rosengren. So don't go away. This morning's disappointing jobless claims numbers will certainly be on the minds of Fed leaders today. Chair Jerome Powell is due back on Capitol Hill this morning, and our Fed correspondent Brian Chung is here now with the president of the Boston Fed, Eric Rosengren. Hi, Brian.
Good morning, Alexis. Good morning, President Rosengren. How are you?
Good morning, Brian. Good to be with you.
So I want to chat a little bit about the jobless claims numbers that did come out this morning. As Alexis was alluding to, we're past 6 months into this pandemic, still over 800,000 turning to jobless claims, another over 600,000 when you include gig and contract workers. I guess I'm wondering, you touched on this in a speech yesterday, how far away is the economy from maximum employment? And do you worry that structural damage is going to make it hard to get back to 3.5% unemployment?
I am very worried that we're pretty far away from what we think is maximum employment, and I think there are going to be significant headwinds to getting there quickly. So I have a somewhat more pessimistic forecast than my colleagues that you could have seen from the summary of economic projections that the FOMC recently put out. They're expecting that the unemployment rate will get below 6% by the end of next year. I'm not expecting that. And some of the headwinds include the problems with reemploying people. So I am worried that many temporary layoffs are starting to turn to permanent as the pandemic drags on much longer than people expected earlier this year. So I think that's going to be a challenge, and particularly the segments of the labor market that are being impacted. So if you think about travel, if you think about tourism, if you think about restaurants, if you think about retail, those are areas where a lot of payroll employment increased over the course of the summer. But continued progress is really going to require that the pandemic be tamed to the degree that people can be fully employed, people feel comfortable once again going to restaurants and hotels.
So, President Rosengren, part of your more pessimistic outlook, as you just said, is maybe a second wave of the virus itself. You've also added, though, that fiscal policy might be the bigger tool in addressing that, if that is the case. In your district in the northeast of this country, what is the biggest need for fiscal policy at this point? Is it state and local government support with the shortfalls that they face? Is it a new round of stimulus checks? What is the need right now?
Well, I think the need is in part, we wouldn't need it if the pandemic was under control. But since the pandemic is not fully under control, I think it has to be targeted to those sectors of the economy that's been most impacted by the pandemic. So that's low and moderate income individuals, that is small businesses, and that is state and local government spending. So those are the three areas that I think are going to be most challenged if this pandemic gets worse as we get into the fall and winter. Many epidemiologists are expecting that we're going to have a difficult fall and winter. We'll see if that's true. It partly depends on government actions. It partly depends on personal behavior actions around the country.
President Rosengren, what does that mean for the Fed side of things? You did say that there could need to be continued monetary stimulus. What might that look like with the Fed already having opened up those liquidity facilities, having rates backed up to near zero? Is that further bond purchases under quantitative easing, or maybe even yield curve control?
So I think activities like further quantitative easing would be supportive of the economy. I would say that the 10-year Treasury rate is below 70 basis points. We're already well below the lowest level that rates were in the middle of the financial crisis. So while I think it would help to do more quantitative easing, I'm not sure it would be nearly as supportive, for example, as fiscal policy. The other monetary policy tool that we have is the 13.3 facilities. So if we do have a second wave, I think it would be up to the Treasury Secretary and the Board of Governors to decide if that required additional changes to any of our facilities, but that's always an option.
Well, the Fed's reaction function, as you just kind of alluded to there, is now also involving that framework change where the Fed would allow for moderately overshooting the 2% target. But it seems like there's been some confusion this week from Fed speak from your colleagues that's birthed out of not knowing the time horizon over which you plan on assessing averaging 2%, in addition to the tolerance for how high you'd be willing to let inflation rise. So on both of those things, what is your personal comfort level with regards to the new framework?
So I think people are worried about the details, and to be honest, I'm afraid we're a long way away from being anywhere near our 2% goal. So this is likely to be much more of an issue 2 or 3 years down the road. I think the market fully understands that we're not raising interest rates from the 0 to 25 basis points that the federal funds is currently trading in for several years. And that's consistent with the forecast that came out of the Summary of Economic Projections. It's also very consistent with the guidance that we provided. So exactly how we measure it when we're so far away from where we want to be, I think is a secondary concern to just trying to get the economy moving more quickly. And again, I think that requires fiscal policy.
And you have cautioned, though, that the Fed should wait on raising rates unless there are other important risks that could become more significant. I took that to mean financial stability risks. I just want to make sure that I'm reading that correctly. And does that also signal that the Fed could raise rates before you get to maximum employment? I know you said we're a long way away from 2% inflation, but does that mean that it is possible if there were to be some sort of financial imbalances arising as a result of this current environment?
Yeah, I think the statement made clear that if there's significant imbalances that would hinder us getting to maximum employment and our inflation goal over time, that there is that caveat that then we would potentially raise interest rates. It would depend on the circumstances at that time. So the hope is that financial stability issues are not that serious and that we're able to fully keep interest rates low in order to meet our inflation goal that's set out in the statement. But that caveat, I think, is important because keeping interest rates low for a long period of time does have consequences. I think we're seeing some of the consequences now of the fact that we had fairly low interest rates. We're seeing problems in commercial real estate. We're seeing leverage firms that are going into Chapter 11 or Chapter 7 bankruptcy. So I think some of the concerns that people have had with corporate leverage and with commercial real estate are going to likely start being one of the headwinds that challenges the economic growth over the course of the next 6 to 9 months.
I want to shift now to the Main Street lending program. The Boston Fed has really taken the helm on that specific initiative. The message from Chairman Powell and yourself has really been that the Paycheck Protection Program might be better suited to keep those businesses whole because they can be forgiven, something that the Fed's loans cannot do. But if there's no stimulus package, which it kind of looks like those discussions are stalling and therefore no more PPP, I mean, would the Fed be open to further adjusting the terms of the program, or are you pretty insistent that the program is tailored to the needs of the economy for right now and that's basically it?
Well, I think the program's tailored to mid-size businesses. And if you look at the 30-day report, highlighted all the loans that we've made. Most of the loans are in the $1 to $5 million range. There were very few loans at the lower limits of our lending already. So I think one of the challenges is that this program works through banks. And for banks to make money on a much smaller denomination loan is very challenging in this program. You'd probably have to design a very different program than the Main Street lending program because there is significant legal documentation and other costs involved. So it's really intended for mid-sized businesses, larger small businesses. $1 million loan is not all that big. A $500,000 loan is not that big. I think when you start dropping it down to a loan, for example, at $100,000, I think the challenge is that most banks don't want to do that unless they can do it in a more cost-effective way than through the Main Street program. And they normally will require either real estate or personal guarantees from the borrower.
Got it. So you're not advocating for lowering it to $100,000 at the moment?
I don't think the Main Street program is particularly well designed for really small businesses. I think the PPP program is much better designed, and I don't think we should let fiscal policy off the hook just because they're having a political roadblock.
Got it. Well, that was Boston Fed President Eric Roskin joining us via the phone. Thanks so much for stopping by Yahoo Finance today.
Good talking with you today.
Alexis, we'll send it back over to you.
All right. Thanks very much, gentlemen. And stay with us. 3 minutes away from the opening bell. Stock futures under pressure. We'll be back right after this. Stock futures have been lower all morning long, and the selling picked up steam after we found out jobless claims rose last week instead of fall. Here's your opening bell on Wall Street. Thursday trading now underway on Wall Street. The Dow Industrial starting the day down 70 points. And here are the headlines making the first trade front page. A grand jury indicted one of the Louisville police officers involved in Breonna Taylor's fatal shooting on charges related to endangering her neighbors, not charges linked to her death. The decision sparked protests throughout the country, and 2 police officers were shot in Louisville. They're in stable condition this morning. Demonstrations took place across the country overnight, including in New York, Chicago, and Milwaukee. President Trump told reporters yesterday that he will not commit to a peaceful transfer of power if a tally of ballots shows Democrat Joe Biden wins the November election. The president continues to bash mail-in balloting, saying it is wrought with fraud. Meantime, a New York Times poll shows Joe Biden gaining ground with voters in the traditionally red states of Iowa, Georgia, and Texas, states Trump won by a wide margin in 2016. And weekly jobless claims are showing that the U.S. economy is taking longer to rebound from the coronavirus pandemic. Claims for unemployment benefits last week jumped to 870,000. That versus the estimate of 840,000. Claims have stagnated over the last few weeks at above 800,000. The economy has regained about half of the jobs lost when the pandemic first hit. All right, I want to get back to the markets now. And with this very early morning loss, the S&P 500 index has now erased its gains for the year. I want to bring in Keith Bliss, managing partner and CEO of IQ Capital. Keith, good morning and good to see you here. I know that you were in the Google Hangout when we were speaking with the Fed president of the Boston Fed, Eric Rosengren, and he painted a rather pessimistic picture of the job market, saying a lot of the job losses we're seeing now have not been temporary. They're turning into permanent losses. Were you surprised by his pessimistic take on the job market?
I was quite candidly, because it actually doesn't square with some of the messaging that we're getting out from the broader Federal Reserve statements. Now, I'm not naive as to think that all the Federal Reserve presidents, as well as members of the FOMC, agree on all the data and the statistics and how they view it and what lens they look through. But that was a little surprising to me. I guess the uptick in jobless claims that we're going to now start seeing in the weeks here in September and October actually makes sense, because as we continue, lockdowns or modified lockdowns, especially in the very populous states like California, New York, New Jersey, Connecticut, outdoor dining is now going to go away because we're starting to get colder weather, and at 25% capacity, restaurants and other types of hospitality businesses will likely be laying off employees. So we'll see an uptick on that. I think the bigger thing I took away from President Rosengren's comments was 2 things. Number one is that we are not going to be back to full employment anytime soon. And in fact, he didn't think it would even come back in 2021, which I think was a little surprising to me, and dare say will be to a lot of traders. And the second thing is that we're going to have the Fed funds rate tethered to the 0 to 25 basis point range, likely like the statement from last month's meeting, or this month's meeting rather, tethered in that range for the next 3 to 4 years. And quite frankly, that really starts to reduce one of the major bullets, if not missiles, that the Fed has to prop up the economy. They just have no wiggle room on interest rates at this point. And that is going to be a headwind going forward.
Keith, as you were speaking, the S&P 500 index it's erased its gain for the year. It's now down 10% from the September 2nd all-time high. As we look into October, what would stop the selling? I don't see it. Do you see it?
No, well, I don't at this point. You know me, the times that I've been on with you throughout 2020, despite what's been going on, I've been very bullish on the market. I did call that we got very oversold at the end of March, and we're very oversold again here. I think what's most unsettling at this point in time is just the whipsaw that we've seen. Apple, because it's the largest market cap and it's in every index, acts as a very good proxy to watch what's going on in the market. Apple did a 40% round trip from late August into the middle of this month, moving from $100 to $139 and then back down to 107 and trading off again. And that's having a major impact there. So I think what you're seeing going on in the market right now, Brian, and until we get some positive news on some of the broader themes that we have, like reopening on COVID, like getting a stimulus bill, like calming down tensions with China, which has started to rear their head again, like getting more news, positive news on a phase 3 vaccine from both Pfizer and J&J, that's not going to stop the selling and the selling pressure. And what you're seeing is that it's a momentum trade now. It's not a logic trade with what's happening in the marketplace. And the momentum players, they're putting very tight stops because they don't want to be caught getting into a massive reversal if the market starts to head south. So until we get some positive news, and I think the stimulus, getting a new stimulus package would be the most positive news that could impact the market right now. I don't see the selling pressure stopping. At the very best, I think we move sideways.
Keith, all right, I get it. Stimulus is going to be a big catalyst, but what about this election? I mean, President Trump coming out and saying it's not going to be a smooth transfer of power if he were to lose. He keeps saying that mail-in balloting is wrought with fraud, although he's not shown any evidence to support that. I mean, is that really the biggest risk to this market, an election with a big question mark over it over the next few weeks and months?
I don't think it's the biggest risk, but it's starting to rank right up there. You know, back in July and August, we were asking the same questions, and in my opinion, at that point, the market wasn't really paying attention to the market. But now that we're less than 40 days out from the actual election, people are really paying attention, and they're nervous. I mean, when you hear statements like that coming out from the President of the United States, one could only wonder what's going to happen on November 4th if we don't have a clear and decided winner on either side. At this point, I think it just doesn't matter. We need to have a clear and decisive winner on the night of November 3rd. I do think, like a lot of the things that President Trump says, that's a lot of bluster. I can't imagine here in the United States for over 200 years, we've had the peaceful transfer of power. It's one of the things that definitely is different about our country than any other country in its history. That wouldn't happen. So I think that's just a lot of bluster out there, but it does make people unsettled, Alexis, to your point, and it will start to factor into the calculus. I think an important night, obviously, that we're all looking for will be next Tuesday, September 29th, the first presidential debate. That's where a lot of the tea leaves, certainly for me, will start to be sorted out. There'll still be a long time to go, but October, while September, most people don't know, September is historically and traditionally from a seasonal standpoint, the most volatile month on the trading calendar. October gets all the headlines, but October may outdo September this year.
Keith, got to ask you about the dollar here. It's been surging, strengthening broadly for about 5 days straight. We got the Dixie at a 2-month high, and it's considerably weighing, I would say, on the risk markets right now. Emerging markets, multinationals, et cetera. Do you think that this is a trend? Because the dollar has been going down most of the year, or at least mostly over the last few months. Do you think this is a trend that's reversing now and causing a pain to the upside?
Yeah, it really is. That's a good observation, Jared. In our quantitative work, one of the patterns that we look at very closely every day is looking for the relationship between the dollar and the euro. Typically, in that pattern, if you get an overbought dollar, which is where we are right now, and an oversold euro, which is where we are right now, at the same time, that is a negative trend for equities globally, but most assuredly in the U.S. market, we're seeing that play out. Interestingly, though, you would expect that if capital is going to flow out of equities, it would flow dramatically into bonds. We've really not seen that, or flow dramatically into commodities, which we've not seen as well. So the really interesting part about what's happening with the dollar is because the strength has been so rapid, it's actually created an environment where shiny commodities like gold and silver and copper are now oversold themselves. So until we get to a top in the dollar, again, we have it overbought. It should reverse here. That is better at trading on overbought and oversold signals, even better than equities. It should reverse, and that should work to lessen the pressure on equities globally and here in the U.S. But again, as I mentioned earlier to Brian, I think all it will do is make us go a little bit sideways here for the next few sessions. But the dollar should be rolling back here as people get a little bit comfortable with where they're positioned, and also recognize that the dollar is overbought. Again, stimulus package, positive news on reopenings, vaccine news will make money come out of the dollar and pour back into equities.
All right, Keith Bliss of IQ Capital, always good to see you.
Thanks. Y'all have a good day.
All right, you too. Want to bring you some breaking news on AMC Entertainment right now. The company says it's reached a deal with some banks to sell up to 15 million shares. So AMC trying to raise some fresh money here as this pandemic wreaks havoc on really movie theaters across the country. Shares of AMC Entertainment down 7% right now. Coming up next, we're going to speak with the former CEO of Sonic Drive-In about what it takes to be a good leader. A little unconventional. We'll talk about it coming up next. As the country returns to eating out at our favorite fast food restaurants, one industry veteran is offering some insight on what exactly it takes to make changes at restaurants. Here to discuss is Cliff Hudson, former Sonic Drive-In CEO. He's also out with a new book, Master of None, where he highlights those key leadership tactics. Cliff, good to have you on the show this morning. Before we get to the book, and there's a lot to get to there, I'd love your take on what's happening right now in the restaurant industry given the pandemic. I mean, you took Sonic from being this smaller Southern brand to being a national chain. How do you see the way we eat at restaurants, particularly fast food restaurants, changing in the wake of this pandemic?
Well, I think change is the order of the day, and it's a challenging time. The phrase that comes to mind from my viewpoint is that fortune favors the prepared. And in this case, it was a difficult thing to prepare for. Sonic was ready because one, I think naturally it stood ready because of the service delivery model, meaning it's a drive-in restaurant where car hops bring you the food. And in a pandemic, that's played very well for Sonic. In addition to that, just before it was acquired a couple of years ago, we had finished the rollout of our mobile app, so mobile order, mobile pay. And that's a rapidly growing piece of Sonic's business. So from that standpoint, taking that and broadening that lesson, the question for folks in the industry is, what is your service delivery model in this pandemic time? And is it something that works for consumers? And if it does work, and if you're meeting their needs where their needs are, then you're more likely to see your sales stabilize, if not grow. Many restaurants don't fit that characterization, and they've seen restaurant sales decline, and they're in a very challenging time.
Cliff, I already started to see renderings of the restaurants of the future by the biggest fast food chains. Do you think the fast food chains of the future just won't have a lot of employees in them, that will be mostly robots flipping burgers and serving food as we all try to get beyond this pandemic?
Well, the incidence of mechanization and application of robots is something that's going to grow in the economy generally. The chances that will occur in the restaurant industry are excellent, just like it's going to occur across other industries. I suppose the variation, I think that could play out. I do go back to my experience with Sonic. All the food's made to order, and there's an opportunity to customize, literally customer by customer. So in that circumstance, the same robot application could occur, but the customization is going to make it a little bit more personalized and probably require a little bit of individual effort. Now, beyond that, I think that these issues of separating location from service, meaning various mechanisms for delivery, the growth of dark kitchens, et cetera, is going to mean a big shift in the industry, and the way customers expect to be able to order their food and receive their food will continue to shift. And this will play more into what you're describing, I think.
Cliff, we talked a good many times when you were the CEO of Sonic, and I never realized this about you, and I did now reading the book. You're a bit of a history buff for a long time. Where do you think we are in this country when you hear the president come out and say he is not willing to commit to a peaceful transfer of power? As a history buff, what does that mean for the country?
Well, your last person, your guest on your program just before me here, made the comment that he hoped that was mostly bluster. And I think we'd all have to hope the same thing. We do have 200 plus years of peaceful transfer from one president to the next, whether the same party or not. And so, your prior guest also made the point, it'll be good if we have a clear outcome so that the question about transition shouldn't be a question. But we have come to expect that with great historical roots to that expectation. And I think American people are going to be expecting it here as well.
Cliff, I want to get to the book titled Master of None. I really like it, and it piqued my curiosity because we're always told it's not good to be a jack of all trades. You should pick something, focus on it, master it. Why is it okay to be mediocre at a number of things and not master just one thing?
Well, one of the things that's pointed out in the book, and right to your point, is that the term "jack of all trades" was one applied to a person some time ago, a very well-known person named William Shakespeare. And the interesting thing is, here a few hundred years later, we all remember the term "jack of all trades." We all remember William Shakespeare. We don't remember the fellow's name who made that accusation. And I think that's kind of a telling point, that the fellow who thought it was a bad trait and he accused William Shakespeare of being a jack of all trades is the one we don't remember. And that's Robert Greene. So, in fact, from my standpoint, as made very clear in the book, being engaged in a variety of activities, whether in your personal life or even in your professional life, not only makes life much more interesting, but I think it makes you a more effective, whatever you are, a more effective leader, a more effective executive, a more effective member of society, certainly a more interesting one. So my life has been quite varied from that standpoint, as I talk about in the book, as Brian asked a moment ago about the enjoyment of history, the enjoyment of music, but the heavy engagement in transition of our business, the passion for the business and the compassion for the people. The combination of these things, I think, make me a better executive and a more interesting person, I hope. So,
well, there were lots of great key takeaways here on leadership. Again, the name of the book is Master of None. Cliff Hudson, former CEO of Sonic Drive-In. Thanks so much for being with us.
Thank you, Alexis. I appreciate the opportunity.
Coming up next, we're going to speak with the CEO of Echelon and straighten out this whole thing between Echelon bikes. Are they on Amazon? Are they not? We'll figure it out right after this. It's been a roller coaster of a week for exercise gear maker Echelon after the company released a $500 bike on Amazon, branding it as the Prime bike. Amazon said it has no formal connection to the product, telling Yahoo Finance, quote, "This bike is not an Amazon product or related to Amazon Prime. Echelon does not have a formal relationship with Amazon. We are working with Echelon to clarify this in its communications, stop the sale of the product, and change the product branding." Here to discuss is the CEO of Echelon, Lou Lenteni. Lou, good to have you here. Break this down for us. What happened exactly this week, and what is your relationship right now with Amazon?
We have a great relationship with Amazon. So how this happened, in January, we met with Amazon at the Consumer Electronics Show, and Amazon was very excited to get our entire line of Echelon connected products up on Amazon. We actually created a a great program where they were actually bringing it in on import. I mean, it wasn't a seller central program; it was a merchant where we're selling to them. One of the things they asked for was a $500 price point bike as well. So we worked on a $500 bike, and we agreed on calling it Prime. The buying department agreed on calling it Prime. We have emails, we have correspondence. Everybody was on board in the buying department. Even as I said, even the purchase orders came in. And it was Amazon Prime packaging. Everything said Prime on it. It was the Echelon Prime bike. Well, the product launched. It's been being sold on their website for almost a month, and press came out about it this week. And we got a call from the buying department, says, great news, we sold out of the bike within hours. But however, the internal team within Amazon does not want us to use the Prime name on the bike, which was a complete shock to us. So so now the bike is sold out, and we're working on a new brand for the bike and moving forward on it. So it was a disappointment. Miscommunication within Amazon. I guess the full Amazon did not align on their branding strategy on this bike.
Lou, I did a search for the bike on Amazon just before the show. I didn't find it. Is that $500 bike that you were branding as a Prime bike on the Amazon platform right now?
How Amazon works, when a product sells out, it's no longer on there. And so it's not available on there right now. It was actually part of a multi-product display, and it's been it's not on there because it's sold out. So we hope to have it back on there. We are, I said, working on repackaging and working on. There is no inventory with Amazon right now. We have because we sold it out. We have more goods coming in soon, and we'll be working on a new brand together with them to relaunch the bike.
Lou, I was reading a recent interview with you, and you were noting that the likes of I believe it was Peloton, and maybe even a Tonal, those brands are excluding. They're exclusionary type brands. What did you mean by that? And what are you doing, I guess, to be more inclusionary with the instructors you bring on and the bikes you sell?
Well, our price points start from anywhere from $500 all the way up to $2,000, and we're creating an environment for people to work out that is not based on the amount of money you have or what you can afford. We try to make a price points for everyone. We have a very broad distribution strategy, unlike the Peloton or the Tonal, where you can find our products in Walmart. I mean, we have a great bike called the Sport Bike in Walmart, $500. We have a great product in Costco. We have a product in Best Buy. We have most major retailers are carrying our product. So it's very easy for people to get it, to try it out. And we've created great distribution. So it's easy for everyone to have it. Our instructors are real people. They're not all the six-pack ab instructors. These instructors are great. They relate to you. They get involved with you on social media. They almost become your friends. If you just follow us, you'll see the instructors are real and people love them. An example, we had an instructor appreciation day that was put on recently for our instructors. We have over 30 instructors. It wasn't us who put it on, it was our members who put it on. And they created a big, huge card. They all went on on classes and just made notes within their leaderboard, how they love them, and thank you so much for everything you do for us. And then they created a 30-minute video that they put together with about 150 different of our members. So it's a really nice, close-knit community, and we're very positive. We're all about being positive and all working together for better health.
I just want to clarify, 30 seconds left, Lou. Just want to clarify some things. The Amazon bike, it didn't sell out. Amazon pulled it, right? And then we've also seen reports, too, that the Echelon bike at Walmart has not sold too well. Where do you stand on that?
Oh, that's false. Number one, it did sell out. And then they did decide not to put it back on, but they can't put it back on. They don't have inventory. But we're not putting it back on till we have rebranded it. But it did sell out. That's false information. Walmart bike not selling out. My gosh, we've gotten multi-million dollars worth of orders from Walmart. Walmart is doing tremendous. It's almost it's a 4.6 rated bike. It's crushing it. It's the #1 fitness product in Walmart and online. I mean, it is doing tremendous. So much. I mean, we had meetings with not only, we were on phones with Amazon yesterday trying to get more purchase orders for them because they want to place more orders, and they said they want to get them, but we're working through this name issue. But no, Walmart is destroying it. They're doing an amazing job. Everywhere. I mean, our business is up 600%. Our business is booming. This was a little issue with Amazon, but really it's not an issue because we're really close with them, and we are working through it with them.
All right, we'll be watching how it plays out. Lou Lentini, CEO of Echelon, thanks for being with us.
Thanks, Alexis. Appreciate it.
Let's check in with Jared Blickery now for another look at the markets. Lower, but off our lows of the morning, I guess, is the big news here.
Yeah, almost a mirror image of where we were about 30 minutes ago. We can see a lot of green on the screen on the NASDAQ 100 heat map. Apple now up about almost 1% now. Microsoft and Amazon just short of 1%, along with Alphabet. Tesla still in the red, but coming off of its lows here, down only 3%. But you can see after yesterday's loss, it's now down about 13% over the last 2 days. All right, we got to check out something here, and this is the VIX. This is elevated, so we still are in dangerous territory. The S&P 500 closes at 3222 or below. We will be in correction territory, Alexis.
All right, thanks a lot, Jared. Stay with us. Much more of the first trade to come on Yahoo Finance. We'll be back right after this.
Welcome back to the first trade. Markets are in selling mode again today. Let's get right to Inez Ferre for a look at what's hot and what's not. Inez?
And Brian, taking a look this morning at Nikola, shares are under pressure, down more than 12% for the electric truck startup. It was downgraded at Wedbush Securities to underperform from neutral with a price target of $15. With Dan Ives writing, overall, we still believe the company's ambitions, but with concerns over whether the execution and timing will be on track. There's two reasons really for the downgrade. One is that Ives says that the Nikola story has changed now that Trevor Milton has left the company. leaving a big void for the company. And also the battery innovations that have come out of Tesla looking to reduce battery costs, saying that this ultimately throws a wrench in the ROI story around hydrogen fuel cell vehicles in the long term. I also want to point out a company which is merging with a special purpose acquisition company called ChargePoint. This company operates EV charging stations, a huge network. The deal values the company at $2.4 billion. And the SPAC company management says that the EV charging industry is accelerating and charging infrastructure investment is expected to reach $190 billion by the year 2030. Moving on to BlackBerry, that stock is up today. It's up more than 6%, 8% right now. Beat on the top and the bottom line for its latest quarter. The company saw continued demand for its secure work-from-home solutions, with a major driver being its BlackBerry Spark business. This is its security and management business, which performed well this quarter, Brian.
All right, thanks so much, Inez. Let's bring in Keith Lerner, Chief Market Strategist at Truist SunTrust Advisory. Keith, always good to see you. Before we get going here, I want to toss to a clip what we just heard from Boston Fed President Eric Rosengren. Get your reaction on the back end.
I am very worried that we're pretty far away from what we think is maximum employment, and I think there are going to be significant headwinds to getting there quickly. So I have a somewhat more pessimistic forecast than my colleagues that you could have seen from the summary of economic projections that the FOMC recently put out. They're expecting that the unemployment rate will get below 6% by the end of next year. I'm not expecting that. And some of the headwinds include the problems with reemploying people. So I am worried that many of temporary layoffs are starting to turn to permanent as the pandemic drags on much longer than people expected earlier this year. So I think that's going to be a challenge, and particularly the segments of the labor market that are being impacted. So if you think about travel, if you think about tourism, if you think about restaurants, if you think about retail, those are areas where a lot of payroll employment increased over the course of the summer. But continued progress is really going to require that the pandemic be tamed to the degree that people can be fully employed, people feel comfortable once again going to restaurants and hotels.
Keith, that continues. Just the sobering tone by Fed officials, Rosengren, certainly Jerome Powell this week. Does this explain why the market is selling off?
No, I don't think it explains it. I actually think if you really think about where we've come from since March, we were up over 60%. That was the strongest bull market we saw off a low in history coming into the month. And we pointed out in this program back in August that we thought there was some complacency building in the market. There's some overconfidence. We had the stock splits that came in. So there's a lot of retail excitement. And don't forget, we were up 5 straight months, 60%. So I think the market, is really right now, this is more of an excuse more than anything, because the reality is the Fed's going to continue to provide, a stimulus. Now, I do think a bigger picture of why we've seen a little bit of weakness, besides just being an excuse, is that, the fiscal stimulus package looks like it's likely not going to be done before the election. And that's hit the market on the margin itself.
I want to talk about some sectors with you now, Keith, because when I look at financials, they've been coming under pressure because of this low interest rate environment. But are valuations attractive there? Because a lot of the big banks are talking about other areas of their business that are doing quite well, namely trading. Their trading desks are booming.
Yeah, well, we've been underweight financials for several months. We're still underweight financials. They are cheap. They've been cheap, but they have to prove themselves, right? I mean, the low interest rate environment is here to stay. So that's a challenge. We think the economy, the trajectory is still positive, but it's going to be uneven with fits and starts. And for banks to do really well, you typically, historically, have needed to see rates rise. And if you track the 10-year Treasury and overlay that with the banks, there's a pretty high correlation. So yes, they're cheap, but we need more proof that something's turning, and so far we're not seeing it. So we remain underweight the sector.
And Keith, big tech continues to lag here, but it hasn't been, I would say, steep. Those big, steep one-day sell-offs. It's been very much drip, drip, drip throughout September. Does that big sell-off lurk over the next couple of weeks?
Yeah, I think the same thing with tech. We talked about that about a month ago. I think it just got overowned. I don't think it's a growth problem. I think we just got overowned and expectations got too high. I will say on a relative basis, you're starting to see tech somewhat stabilize. And if you get more of this uneven growth, at least near term, with the uncertainty into the election and also some of the uncertainty on the economy, just more short term, I think you actually, as we get through this, you'll likely see a more rotation back into tech, probably closer to we get to the earnings season. So investors can be reminded that the earnings growth there is still spectacular. In fact, it's the only sector where forward earning estimates are above where they were pre-COVID. But short term, I think it's going to be more of a consolidation. But again, they are stabilizing relative to the overall market. And that's a different tone than the beginning of this market decline where they led on the downside.
Keith, we know there's still a lot of cash sitting on the sidelines, a lot of folks holding on to some dry powder. What are you seeing with your clients? Are they in a wait and see mode, waiting for this election to come and go with so much, when you just said it, so much uncertainty swirling around the election, President Trump coming out and basically making it sound like he's ready to contest this election if he doesn't win?
Yeah, I think in general, what you just said is right. It's a wait and see mode. I think maybe there was a little bit of a buyer's strike even this last week because there's so many headlines ahead of themselves. I think if, we're already down 10%, from our perspective, though, if this goes a little bit longer and we have a little bit longer duration, because the correction is both in price and time, we're going to be looking at leaning into that. In fact, we've been telling our clients that we should be averaging in during this period because the big picture, as we get past the election, I realize there's a lot of questions about when we will know the election results. Is we still think we're in the early stage of an economic recovery. The Fed is likely on hold, as we mentioned at the top of the segment, and the relative opportunity is still within stocks. But the admission price to being in the market are these short-term corrections. But we think we might be in the early stages of a multi-year bull market, one that moderates from those big gains, but has some longevity as far as time.
All right, we'll leave it there. Keith Lerner, Chief Market Strategist, the Truist SunTrust Advisor. Always good to see you.
Great to be with you.
Well, if healthcare was the key issue this November, Joe Biden would win in a landslide. That is the finding of a brand new poll out this morning. And we've got Yahoo Finance senior columnist Rick Newman here to break it all down. So Rick, tell us about this. First of all, what is this latest survey? What is this latest poll?
I don't think these findings are real surprising, but what the Commonwealth Fund did is they asked around more than 4,000 voters in 10 swing states their attitudes on what are their top issues with regard to healthcare, and then which candidate do they favor with regard to those issues. The three biggest issues are the COVID pandemic, not surprising, healthcare costs, also not surprising, and then people say they are concerned about pre-existing conditions. So that gets to what we've been talking about all week, which is the Supreme Court vacancy and the fate of the Affordable Care Act. But at any rate, in just about every category in every state, voters favor Joe Biden over Donald Trump on these healthcare issues. There's only one exception in which in Ohio, on one of these issues, voters say they trust Trump a little bit more than Biden. But overall, Biden just swamps Trump on the issue of healthcare in the 10 states likely to decide the outcome in November.
Rick, some of the polls that I've seen of late, we're seeing the race tighten a little bit. What are you seeing out there?
It's tightened a little bit nationally, but of course that doesn't matter as much as what's happening in the swing states. The things that have caught my attention recently, Brian, there was a recent poll in Georgia showing Trump and Biden essentially tied. That was a poll by the Atlanta Journal-Constitution. Georgia is normally a red state, so the idea that Biden actually has a chance to pick up Georgia is pretty stark. We've also seen a tightening in Texas, also another reliable red state, although it has been trending in the blue direction during the last several years, partly because a lot of Californians are moving to Texas. That could also go for Biden. So that means Trump is going to have to spend precious advertising dollars and campaign money in states he won comfortably in 2016. But don't count Trump out. Healthcare is a top issue for voters, but probably the economy is even more important to voters than healthcare at this point. And Trump does still have a slight edge over Biden on the economy.
And Rick, you and I talked about this during our Electionomics podcast this week. The fact that Biden is sitting on a whole pile of cash, very different from where he was just a few months ago. He's actually even outspending President Trump when it comes to some of the ads. What does that mean for the Trump campaign? Are they in trouble?
It is trouble for the Trump campaign. I mean, it's really unusual that an incumbent president would trail a challenger in fundraising and trail by a lot. Trump has raised about $1 billion, but that money is mostly gone, and it's not entirely clear what happened to it. There have been some allegations of reckless spending in the Trump campaign by the former campaign manager, Brad Parscale. He got demoted. Somebody else is now running the Trump campaign, and they may not be able, in fact, they probably will not be able to match the Biden campaign ad for ad in Florida and Wisconsin and Pennsylvania, and even in Minnesota, which are the states that are really going to decide the outcome here. Trump does still have a lot of money, but Biden has, at this point, has a fundraising advantage he's probably going to keep all the way through November 3rd.
All right, and again, you and I go into a greater detail on Biden and Trump and their coffers here as we near the election on the Electionomics podcast, which is out right now. You can get it
Best
on
podcast anywhere.
Right? It's a shameless plug, Rick, but I've got to do it.
I'm all for it.
Rick Newman, thanks a lot.
Bye, guys.
Warren Buffett just made one of his classic money moves. More on that coming right up. Welcome back to the first tray. Let's check out one of the hundreds of companies Yahoo Finance is watching today. TV station owner EW Scripps has inked a deal to buy Ion Media for $2.65 billion in cash. Warren Buffett's Berkshire Hathaway will get $600 million in preferred stock for helping to finance that deal. Yahoo Finance's Inez Ferre is back with more details. Inez, pretty sweet deal here, I think.
It is a sweet deal. And just talking a little bit about what Scripps does and the number of television stations that it owns. It operates about 60 local TV stations. It owns Court TV. It also owns Bounce. It also owns the news platform Newsy. So this deal could really double its local footprint when it comes to Ion Media. So part of the slide deck of the deal shows that Scripps will own 59 local television stations and 48 Ion stations in 76 markets. Now, Ion is based in West Palm Beach, Florida, its TV stations, along with its affiliates, reach almost every American home in the US. The big reason for this deal is that Scripps can reach those viewers through what's so-called the over-the-air network. And this is especially important as viewers are cutting cords, as they're going to streaming services, as they're watching free-to-air programming. And Scripps says that its own programming will reach nearly every American through free over-the-air broadcast, cable and satellite, and over-the-top and digital distribution. Now, Scripps used to be involved in the newspaper business as well, and also radio. It sold off those assets. It's only been focusing on TV. And remember that for Berkshire Hathaway, it sold off Lee Enterprises in January, just realizing that the newspaper business is very difficult to sustain. I would say television is also difficult, but for Scripps and acquiring Ion Media, this is a very big deal for the company. Right now, Scripps is up more than 16%. Brian?
Okay, the fate of TikTok is lying in the hands of Chinese authorities. The social media platform's owner, ByteDance, is seeking approval from Beijing to complete the White House-backed Oracle Walmart deal. Yahoo Finance tech editor Dan Halley is here with the details. Dan, it just keeps going on.
Yeah, this is just another kind of, I guess, advancement in the saga of the TikTok story. Really, if you think about it, Microsoft seemed to have dodged a bullet here when it comes to kind of missing out on this deal. They were obviously the other suitor that was involved in the situation. Oracle's still there. Walmart's still there, still hanging in. But now, yeah, this is going to Beijing. Whether or not they will allow something like this to happen remains up in the air. But, we saw that some of the state media over the weekend and late last week basically saying that this was America acting as gangsters, things along those lines. So I think that this is going to be something that's pretty problematic. I don't know if we'll see anything come to a conclusion by the end of this week, though.
It looks like we're getting some breaking news regarding this as it takes yet another turn. This just breaking. A TikTok judge asks the U.S. whether to delay the Trump ban. So perhaps they're going to be given a little more time to sort things out, Dan.
Yeah, the ban has been something that's, been kind of ongoing. There was the idea that they were being taken out of the App Store. Then, with WeChat, it was they were going to be canceled outright. With TikTok, it was they were going to be taken out of the App Store, and then they were going to be able to hold on until the end of the election, which gave people, the idea that they were using WeChat as kind of an example to set that TikTok would then be able to look at, and then it would kind of scare TikTok or Beijing into acquiescing to the U.S. demands. But yeah, this I don't think is going to get done as soon as people would like. And as I said, it seems that Microsoft really, really dodged this bullet because this just acrimonious relationship between the two countries and how they handle this is just going to continue to go forward.
I want to switch gears a minute and talk Fortnite because it's teaming up with Spotify and I think Tinder against Apple regarding the App Store. What do we know about this?
Yeah, this is a new group called the Coalition for App Fairness, and it's essentially a bunch of app developers coming together to kind of air their grievances about the various app stores out there. Specifically, they point to Apple on their website more than Google, which is interesting. I think it's worth pointing out that both companies charge the same 30% commission for payments made through apps or for apps in their respective app store. So it's not as though Apple is the only one doing it. The issue that companies have with Apple is that Apple also has a walled garden kind of ecosystem, whereas you can get a third-party app store on Android and download apps for that. You can't do that on Apple. And so app developers see that as an ongoing issue. For instance, Fortnite is no longer available in the App Store on your iPhone or in the App Store for your Android phone, but you can download a third-party app store for your Android phone and then download the app there. So it kind of, is this ongoing back and forth, which is the worst of two evils. But this really is a lobbying group, more or less, for these developers. And it's big names. It's, the likes of Spotify, Epic Games, obviously. Basecamp is in there as well. And they've issued complaints about Google in the past and their search dominance. So I think this is just a kind of another, they smell blood in the water because of the DOJ, the FTC, the various investigations and think, well, if we can get this pylon, really get our message across, maybe something will have to change.
Dan Halley, thanks so much. Hey, California will look to do away with gas guzzling autos by 2035. We'll look at how that will impact some of the country's biggest automakers coming up. Welcome back to the first trade. It looks like the used car industry got a big boost this summer thanks to that government stimulus. Ronnie shares of CarMax after the company posted higher than expected sales and profits in their latest earnings report. Inez Frey is back with the details. Inez, I for one bought a new car. I just didn't buy it at CarMax.
You always have great cars, Brian. Right, taking a look right now at CarMax, the stock is down more than 10%, but I will tell you that its earnings per share came in at $1.79, well above what the street was expecting. Comparable store sales were up 1.2%. Very important, the company says it rolled out its omni-channel offering so that customers had the option to seamlessly do as much buying online or in person as they wished. In the first quarter of fiscal 2021, it did pause its store expansion. CarMax is now resuming that growth and opening 8 to 10 stores in fiscal 2022. I want to take a little bit of a look at sales because total used vehicle unit sales increased 3.9%. Positive comparable unit sales, used unit sales in both July and August more than offset the high single-digit negative comps that the company says it experienced in June. And it did say that inventory was a headwind as far as sales was concerned, but the company returned to its targeted inventory levels in September. Just taking a look at CarMax, the stock, as I mentioned, it's under pressure right now, but I will say that used cars during the pandemic have done very well. And we saw upgrades the other day from Goldman on Vroom, on Carvana, and those stocks today a bit under pressure as well. Brian?
A decision in California may cause a ripple effect in the auto industry for years. The state will ban sales of new cars and trucks powered by gasoline starting in 2035. Let's rev up the analysis on this one with Lauren Fix, the car coach and automotive analyst. Lauren, good to see you this morning.
Good to see you.
What does this mean for the big three automakers in the lead up to this ban?
Well, the big three automakers have been offering electric vehicles. The traction has not been great. The one with the most traction is obviously Tesla. Other brands from Europe have also had good traction, but not great traction. And across the US, we're only looking at 2% purchases, a little less actually than that, of electric vehicles. So to demand that everybody move to electric vehicles as far as buying a new vehicle, that could lead to a lot of issues financially for people and for companies and for the state.
What do you see? I mean, look, California's governor made this decision in an effort to fight climate change, right? Environmentalists are getting behind this mandate. We should note it's a mandate. They're not putting it up to a vote for Californians to decide. It's one of the issues the Trump administration has with it. But on its face, is this a good thing? Should the auto industry be embracing this?
It's actually not a good thing because California is about 11% of the total sales in the United States. So as California goes, the rest of the country typically goes. If we remember back to the emission standards, once they put those in place, that sort of mandated that they want to build one vehicle across the US and not more. But if you're expecting more electric vehicles to be sold, what they're really doing is putting a burden on the used car market. You've looked at CarMax, you just talked about, and their increase in sales. Used car sales are 10 to 15% higher. Can you imagine what it's going to do to the cost of a used car in California? Remember, those people that can't afford a new car are looking at used cars, and you're making that cost to them higher. They're not suddenly going to go buy a new car, even with an incentive. And most of the brands have an incentive, but you've already lost it with Tesla and General Motors. Nissan is very close to losing that $7,500 tax credit. How can the average consumer who makes under $50,000 a year be able to afford an electric car? They can't. And then there's the cost of charging. This all means that they're going to really jack up the prices of electricity. They've already got brownouts. They tell you big notifications to unplug your toaster. We've all seen that. So think about how this is going to impact when solar and wind are only 4% of what their usage is. The rest comes from coal and from natural gas. And if he doesn't want that, if the governor's demanding that, he's going to have to be in power to make that happen. I have a gut feeling that if he's not in power, the next governor may reverse this.
And Laura, but what does it mean for the price of new cars in the 15 years before this goes into effect? If I'm a Ford, if I'm a General Motors, Toyota, you name it, why not raise prices on new cars by $1,000 now to prepare for this eventually happening?
Well, that's kind of what happened to the price of vehicles. They went up because the cost, California sets the pace. So if they have to produce electric vehicles, they have to pay those carbon credits, which sometimes in the past, they were buying them from Tesla. That all gets figured into the price that you pay, somewhere around $2,500 a car already. So if they're going to increase that cost, that means no longer will the average price of a vehicle across the US be somewhere around $34,000. It could go up to closer to $40,000. Again, that makes it untouchable for some consumers, and that's not going to help. But also think about the repair shops. They're going to be very busy for a period of time if this goes into place. And that's what's never really thought about is the little guy who runs a corner repair shop or does oil changes. He'll have less customers down the road, or she'll have less customers down the road. And so that could lead to an impact on the economy. Also, possibly a large group of people owning vehicles out of state. You can buy them in other states and then have them licensed in Montana or Maine or Nevada. And that has been done already. I know people that do that today in order to avoid the California taxes.
Yeah, not great to do that with your insurance company, but you're right, it does happen. But Lauren, look, Gavin Newsom's heart might be in the right place with this mandate, but if this isn't the way to go, then how can the automotive industry help reduce these emissions and help with the environment?
Well, there's actually some new technology. China had originally placed a mandate stating they wanted all electric vehicles. And of course, they started producing them through their suppliers and other suppliers. But what they realized is they don't have the electricity to support it. So they started, and they are building quickly as they can, nuclear power plants to create electricity, which is kind of one of the things that Gavin Newsom didn't want. So they found a new solution. It's something called blue gas. And if you're in the investment world, you should start looking into that. It's a combination of CNG and hydrogen, and it is a good solution. They've already put $66 billion into a station in Shanghai and into creating more technology because they know that if they don't have the electricity and consumers can't plug in, there has to be another solution because there never is just one solution. You will always have gasoline, you'll have diesel for trucks, you'll have electricity, you'll have CNG, you might even have algae. That's also being worked on right now.
Laura, real quick before we let you go, Battery Day, Tesla's Battery Day continues to dominate my Twitter feed. A $25,000 Tesla, is that exciting or is that just hype?
I think it's hype. He's always been known for the hype. How many promises he's made that haven't come to fruition? That's just how Elon Musk operates. It's his way to raise money, except it backfired this time because Nikolai got in trouble because of his false statements or the supposed false statements. I think Elon got really smart and said, you know what? I don't need to be in this mix and lose billions of dollars. I think I'll bring this down to a more controlled message. And I think that's what he did this time, which was probably really smart from a legal standpoint.
All right, we'll leave it there. Lauren Fix, the car coach and automotive analyst. Good to see you.
Good to see you.
All right, big tech could be in for a very rocky end to 2020. More on why straight ahead. Welcome back to the first trade. Inez Ferreira is standing by with some other tickers moving right now. Inez?
Yeah, Brian, and just looking at the overall markets right now, we're looking at energy stocks that are under pressure as well as healthcare. Real estate is in green territory. And I do want to mention new home sales, which rose 4.8% to just over 1 million units last month. This is the highest level since 2006. Also, the July sales were revised up to 965,000 from 901,000 as the housing market just continues to keep gaining momentum amid COVID-19. And just also looking at Darden Restaurants, that stock is up more than 4%. Its earnings per share coming in at 56 cents. Net sales decreased 28% during the quarter. That was a miss. Its biggest decliners were in fine dining restaurants. Same restaurant sales for fine dining was down 39%. Olive Garden's same store sales were down 28.2%. But the company is offering current quarter guidance, expecting sales this quarter to be down 18% compared to last year. And also the company reinstated its dividend. And also looking at Rite Aid, that stock is sinking right now, down more than 16%. Its adjusted earnings per share came in at 25 cents. Its revenue came in better than expected. The company did say it saw some strength in retail pharmacy and also its pharmacy services. Year to date, the stock is down 28%. Brian?
All right, we're seeing some breaking news across the wires here from Fed Chief Jerome Powell saying it's likely additional fiscal support will be needed. Again, Powell's giving another day of testimony down in D.C., and this is a message he has continued to relay to lawmakers throughout his testimony this week. All right, Google and the rest of big tech are back in the sights of Washington. The Trump administration is laying out its plan to launch an antitrust suit against Google while also pushing to change a law that gives immunity to the social media giants. Hal Singer closely watches tech and antitrust at Econ One, and he joins us now. Hal, good to see you again. So how concerned should Google be?
I think they should be pretty concerned. The suit is coming, and as you mentioned, the immunity shield that they have used, not just Google, but other dominant tech platforms have used to push off certain liability suits, might be coming down as well.
Hal, I want to turn to that changing Section 230 of the Communications Decency Act. We know President Trump continues to rail against social media. Now you've got the Justice Department out with its proposal to take away some of those legal protections. Is this really going to make a difference at the end of the day, do you think, for these big tech companies?
Oh, sure, it will. Amazon, just to pick on one, has been successful in part at using that shield to push back certain lawsuits, depending upon the state in which those suits were brought. So I could see a pairing, maybe not exactly along the lines of what the DOJ suggested, but for example, saying you can no longer use the shield in the sale of physical goods. This was never the intention of Congress originally. It was always about ideas. And so if you're selling a counterfeit Chinese battery that some child swallows, you shouldn't be shielded from the liability suit that would come.
Hal, what would be the worst case scenario be for Google in your view?
Well, the worst case for the 230 that we're still talking about. I mean, I presume we're still talking about that. Worst case is that they would now be opened up for lawsuits, depending and being held responsible for the kind of things that are going across the transom on their platform.
Hal, how likely does a breakup of any of these big tech companies look to you, regardless of who's in the White House?
Well, the breakup could come in one of two forms. Everyone thinks that it's going to come potentially at the end of a successful antitrust lawsuit, in 5, 6, 7 years. But a breakup could also come via legislative fiat. When Senator Elizabeth Warren talks about a breakup, she's talking about one that's written into law. Right. And so the question is whether or not she could gather a collection of Democratic senators to get on board with that, and ultimately whether a President Biden would be willing to sign on. But short of the breakup, there are a lot of other remedies that we could enforce, beginning just, for example, with a non-discrimination regime. So which would be another regulatory solution. So it could happen, but it's probably a low likelihood event.
But Hal, a breakup of a Google, a Facebook, you name it, wouldn't that just cause another entity that has a significant amount of power too?
Well, it could open up the possibility for a new entity to move in. I don't know if it would open up the possibility for a new entity to come in and monopolize the way that Google has. So I think it's a very viable and plausible and elegant solution. And it ought to be on the table alongside other less invasive remedies, including, for example, this non-discrimination regime that I spoke of.
Which big tech company is most at risk? Is it a Google that would make most sense to be broken up? Is it Facebook?
Well, Facebook, it's difficult to think about the different parts of Facebook. One natural thing we could do is that we could go roll back all the acquisitions that Facebook made. But I think that what's very interesting is that Facebook defies convention. The way that Google has gotten into the content space and now leverages its platform power into content, we can take care of that with either a structural solution or a behavioral solution, non-discrimination. Amazon, the same thing. They've used the private labels to kind of leverage their platform power and steer users into search of their own wares, and everyone recognizes that's unfair. And again, it lends itself to these very traditional forms of relief, either structural separation along those product lines or a non-discrimination regime. When you come to Facebook, what it's doing, it's the way that it's kind of propagating misinformation, causing extremism, undermining democracy. It largely defies kind of these conventional tools. And so I think we have to think about Facebook in a very different way, including just dismantling the entire business practice, potentially banning, for example, targeted advertising. This is a whole different animal, something we've really never confronted before. And Facebook may not be allowed to exist in its current form under a new regime.
Hal, before I let you go, back on the Google potential antitrust suit, how long would it take before a decision is rendered down? Are we looking at a decade here? Is it a year? What's typical for something like this?
Antitrust is slow. I mean, I did an analysis that looked at cases that I think ended around 2000. And even then, just to get a resolution in the lower court, the district court, took you on the order of 3.5 years. But if you're talking about appeals to a federal court and then ultimately up to the Supreme Court, we could be looking at 5, 6, 7, 8 years. And so the problem here that I keep stressing is that we cannot wait 7, 8 years to solve this innovation problem. If we're worried that Google is leveraging its power into the edge and making it difficult for independent content creators to survive and thrive, we cannot wait 7 years. And so I've been pushing, even alongside a suit, I've been pushing for a regulatory solution that would bring some relief to the edge, in our lifetime.
All right, we'll leave it there. Hal Singer of Econ One, always good to see you.
Yeah, good to see you. Thanks for having me.
All right, do stick around. Much more ahead on The First Trade. Welcome back to The First Trade. Software company Checkpoint says it found a vulnerability in the Instagram app back in February. In the finding, it says through one single image on the platform, an attacker can turn a victim's phone into a spying tool. The company says it waited until today to publish the report in order to ensure enough people updated the app. Yahoo Finance's Melody Hom is here with the details. So, Melody, I understand you reached out to Facebook. What'd they tell you?
Yeah, I spoke with both Checkpoint and Facebook ahead of actually publishing this report. And Facebook initially, according to Checkpoint, said that they were very grateful for flagging this sort of vulnerability, which is basically what Checkpoint's bread and butter is. In addition to selling software cybersecurity services, they have a research arm that tries to do some white hat hacking, as we call it, right, to make sure that a lot of these tech companies are held accountable for potential flaws in the system. Facebook, when I reached out to them, actually had a very different tune when they were flagged about this report. They said to me that Checkpoint's report overstates a bug, which we fixed quickly and have no reason to believe impacted anyone. Through their own investigation, Checkpoint was unable to successfully exploit this bug. I want to take a more macro picture view, right? As you mentioned, this happened in February. So for many users, this actually was not a problem at all. But it just shows that as much as we may resist that update button when it comes to the applications we use frequently, that's actually the best order of action, right? It's a very practical way that those security fixes can be seamlessly integrated in your using of the app. Unfortunately, if you don't update the app, which I know a lot of folks prefer not to do because they don't want to give additional information, they don't want to be privy to more security concerns, it's very ironically actually them unprotected. I think this is also top of mind right now because there is a lawsuit that was filed in San Francisco against Facebook, specifically because there are reports that Facebook was spying on users through the Instagram app, through the camera. Facebook in turn has replied saying that that is merely an error, that was a bug in the system. But again, when does a bug become malicious? When does it become complete oversight from the engineering side of things? I think it is valuable to keep companies like Facebook in check with these sorts of measures that are put in place.
Melody, how long has Checkpoint been looking into this?
Yeah, so Checkpoint is actually a pretty robust organization, Alexis. One of their most notable findings was back in January of this year when it came to TikTok. They revealed multiple vulnerabilities that users could have access or could be exposed of their contacts, of their photos, of all their personal information in a way that according to TikTok, they were not aware that that was a bug in the system. When it comes to Facebook and Instagram, they're constantly on the lookout, right? This is sort of what these so-called good hackers are trying to do, saying, hey, heads up, I'm flagging this to you. Make sure you fix this before this actually happens in a real way. So you can say it's a proactive measure. You can say perhaps it's making something out of nothing. I prefer to err on the side of caution, right? Especially given your big tech conversation, as we anticipate more and more scrutiny to face these companies, you better be doing everything in your power, right, to protect user identities and data. So in the case of Facebook and Instagram, it's an ongoing process for a firm like Checkpoint to continue monitoring potential vulnerabilities there.
All right, Yahoo Finance's Melody Hom. Great to see you.
Same here. See ya.
All right, do stick around. On the other side of the break, we'll look at some of the hottest toys for this upcoming holiday shopping season. Welcome back to the first trade. Holiday toy season is heating up. And for a look at what the hot holiday toys might be, we're going to head straight to our man, James On. He's a senior editor over at the Toy Insider. James, I have a lot of questions to ask about toys, but I see two big giant boxes right in front of you. What are they?
Yes, these are present pets. This is brand new from Spin Master, and it's so excited, it's going to unbox itself for you this morning. Oh, yes. So right here, 100 different phrases and actions from an interactive puppy, because kids always have this idea that they'd love to get a puppy in a big box with a bow on top, and not everybody can have a real puppy. So here we have the present pet. And
like
you get it, you
growling.
pull the tag. It seems like, oh yes, it's very excited. It's growling. It's ready to come out. And
Alex, this is really happening now.
This is actually one of the glitter pups. There's glitter pups and fancy pups. And oh, here we go. There she is. So this is one of the present pets. This is the first time anyone is seeing this on television. These went up for pre-order this morning on all the major retailers. This is going to be in limited supply this holiday season in North America. And then you're going to want to order those or look for them. They're on shelves October 1st. So that's present.
She's free and she's thrilled because she's still yapping away. How much is this going to retail for?
$49.99 and Magic Television. I have another one right here. So they come in 4 different styles. It's going to be 2 different fancy pups and 2 different glitter pups. And yeah, they're a lot of fun. 100 different actions. You can pet them, cuddle them, all kinds of cool stuff. Want to talk about cats versus pickles?
I'm just taking it all in.
She's just still yapping. So, of course, this is all from the Toy Insider's 15th annual holiday gift guide. The Present Pets is one of our hot 20 items. Cats versus Pickles is one of our 12 under 12. This is these are $4.99. 68 million views on YouTube already for Cats versus Pickles. These are little plush collectible characters inspired by a meme. The idea that cats are afraid of pickles, but pickles just want love. So, you know, think Beanie Babies, weighted plush with beans. Kids can collect a ton of them. These have been selling like gangbusters all summer, Walmart and specialty retail. We've also got from the makers of LOL Surprise, MGA Entertainment. This is Rainbow High. It's a new fashion doll line. These are articulated fashion dolls. Articulation is very much like an action figure. Each one comes with a separate outfit. There's 6 different dolls that kids can collect. These are $26.99. They're available almost everywhere, all the big retailers. Pokemon, kids still got to catch them all. Pokemon trading card game, Battle Academy. This can teach folks like myself that never really learned how to play Pokemon. This can teach you how to do it, and the family can get involved. It comes with 3 starter decks, all the instructions, and a cool board that you can play with. And then if you got kids that are really into STEM, science, technology, engineering, math, this is from Thames and Cosmos. This is the Mega Cyborg Hand. This is a 203-piece building set that kids can put together and learn how hydraulics work. And it is an articulated hand. My hand is a little bit large to go in here, but when they put their hand in there, they can actually pull triggers that will activate this thing, and they can lift objects and everything, understand little robotics and how hydraulics work. There's actually water and stuff running these tubes.
Wow, those are really awesome. And kids love the collectibles, but how much is that hand going for?
That hand is $39.95. You're going to find that at stores like Walmart. Hobby Lobby is carrying it as well. And a bunch of the specialty independent toy stores are going to have that one.
Okay, and we got to talk one of my favorites, right? Disney and the Mandalorian. They're coming out with something called Mando Monday. What is that?
Mando Monday is going to kick off officially on October 26th. They did a sort of ceremonious launch this past Monday. Every Monday for 9 weeks, all of the different licensees, so we're talking Hasbro, Funko, all of them are going to be rolling out brand new product tied to The Mandalorian. And of course, everybody here loves Baby Yoda. We've shown him a few times in different forms, so there will be a ton of that. One thing I did bring to show you that just hit the streets from Hasbro, this is really tiny, but this is the Star Wars Mission Fleet collection. These are 2.2-inch scale action figures. And here we have the little child in his pod that can float around. And he is just so adorable, but so small. He's holding the little gear shifter. And these are available at Target right now and Walmart.
Oh, you're killing me with these. I've got to get my hands on that now.
I know. So yeah, articulated figures, that's a whole new scale for them, the 2.2-inch scale.
Really,
Well,
just
James,
make sure your cat or dog doesn't eat it, I guess, but they're cute.
Absolutely.
Well, James, we'll have to leave it there, but I will say this. My niece washes this wash every morning. Now she's going to want one of those Presents puppies, but Uncle Lame is not getting her one. She's not getting her one. She's getting a Yahoo Finance premium subscription. That's what she's getting. James On,
Yeah,
senior
so
editor
many
at
great
Toy
toys.
Insider. Always good to see you.
Thanks
All
for
right.
having me.
Of course. All right, let's get back to Inez Ferre for a look at the markets. Inez, top that. I dare you. Come on.
Oh, Brian, you're no fun. Come on, get that for your niece. Nikola, right now down 13% after being downgraded at Wedbush to underperform from neutral with a price target of $15. Dan Ives at Wedbush saying two reasons really for this downgrade. One being that Trevor Milton has left the company, leaving a huge void at the company. And also because of the announcements that were made by Tesla during Battery Day, looking to reduce battery costs, saying that this will potentially change the game with further price parity on the EV front and really throw a wrench when it comes to the ROI story around hydrogen cell vehicles long term. We're taking a look at Good RX Holdings, down more than 6% on its second day of trading after it went public yesterday. The stock had closed yesterday at $50.50 per share, and that was up from its IPO price of $33. And then we're looking at AstraZeneca, down more than 2.5%. The company is saying that it's still waiting for a decision from U.S. regulators as to when to restart the trials in the U.S. after it paused trials globally when a patient became ill for its COVID-19 vaccine trials. AstraZeneca, of course, is working with Oxford University on that vaccine candidate. We're watching BlackBerry after BlackBerry beat on the top and the bottom line for its latest quarter. Year to date, the stock is down 20%, but today it's seeing a nice bump. And also Darden Restaurants seeing a bump today after reinstating its dividend. Its net sales decreased 28% during the quarter. Its big decliner was in fine dining, but it did offer guidance for the current quarter. Brian?
Inez Ferre. All right, we'll go out and start toy shopping, Inez.
I will. You think you've seen it all until you've seen that toy.
So true. Wow, am I getting old? Okay, On the Move is up after the break. They'll take a look at investor reaction to President Trump's comments on whether he will adhere to a smooth transition of power after the November election. And you bet the team will have all the analysis you need on some of the market's rip-roaring stocks. Do stick around. On the Move is coming up next.
It's 11 a.m. here in New York City. We are 90 minutes into the trading session. Here's what's happening with stocks. A mixed picture. Trying to go positive on the Dow. We're almost there, down now just about 7 points. S&P 500 is actually up about 5 points. The NASDAQ is up close to 40 points. We'll see what happens. President Trump's refusal to commit to a peaceful transition of power should he lose the November election raises concern on both Main Street and Wall Street. There's no place like home, as new home sales in August continue to surge. They're up more than 40% year over year. The coronavirus pandemic has people stampeding for more space. And tests take flight. United Airlines becomes the first major U.S. airline to offer COVID-19 rapid testing for its passengers. Find out if you can expect one on your next flight. That's in a few minutes. But welcome to On the Move. I'm Adam Shapiro, along with Julie Hyman. Joining us this hour on the panel are Brian Chung and Emily McCormick. We want to turn our attention to what's driving these markets. And one of the things that had people concerned at the beginning of the trading session were those comments from President Trump about not accepting or going for a peaceful transfer of power should he lose the election. Here's the president in his own words.
Well, we're going to have to see what happens. You know that I've been complaining very strongly about the ballots, and the ballots are a disaster.
I understand that, but people are rioting. Do you commit to making sure that there's a peaceful transfer of power?
We want to get rid of the ballots, and you'll have we'll have a very peaceful. There won't be a transfer, frankly. There'll be a continuation.
And you'll have a continuation. How is that playing across Capitol Hill on both sides of the aisle?
Exactly as you would expect it to play. Trump's critics are outraged, which makes me think Trump is probably chuckling. He loves to trigger his critics and create a media firestorm, and he's done that. And, you know, we've even seen some Republicans today pushing back on this, including Senate Majority Leader Mitch McConnell. Republicans in Congress, basically the ones who have been having anything to say about this, have been saying, don't worry, we are going to have a peaceful transition no matter who wins in November. So to some extent, this is Trump being Trump, but we all know that Trump is trying to lower expectations for how well he's going to do in November and create some kind of excuse for if he loses and he's clearly trying to delegitimize the election before it even happens.
Rick, I think all of us, both in the news business and just regular voters out there everywhere, are sort of struggling with how seriously to take all of this, right? There is now a report, though, from The Atlantic saying that one of the strategies that the Trump campaign is weighing is somehow trying to bypass results in some swing states by installing electors who would vote for the president in the Electoral College even if he loses the popular vote. I mean, how realistic is that kind of a scenario?
I think it's going to be very hard for the Trump campaign to overtly cheat. I think we have to remember that the federal government does not run presidential elections. The states run the elections, so that any cheating would have to happen at the state level. Could that happen? I guess it probably could. I think it would be hard to do it secretly. I think it would be pretty clear. One really complicated scenario, I mean, it is possible that there is an electoral college tie at 269 to 269. And this becomes a little mind bending because if there's a tie, the tiebreaker is the House of Representatives, where the Democrats actually hold a majority in terms of seats, but Republicans have more state delegations in the House, which means they control more states than the Democrats do, and that is the determiner in a tie. So if there's a tie, Trump is going to win because of this weird tiebreaker that's never been invoked. I mean, let's honestly hope it doesn't come to that, whoever you favor, because that would really provoke an uproar. But I think the Trump campaign for sure is looking for every edge it can possibly get because the odds are strong that they're going to lose.
Rick Newman, thank you very much. This is having an impact on investments and on markets. And to take a look at the outlook as well as the concerns of the election, we invite into the stream a friend of the program, Stuart Kaiser, UBS's head of equity derivatives research. He is in New York, joining us now. Stuart, we would normally go right to markets, but I have to ask you, this kind of back and forth, the volatility of the rhetoric from President Trump, from the Democrats, it's having what kind of impact on the markets? Is it making them queasy?
I think it is making them a bit queasy, but the markets are, and good morning, sorry, Adam and Julie, nice to be on here again. The markets are obviously very much aware of this and have priced a tremendous amount of risk into the options markets on election day. And then frankly, for the 6 to 8 weeks after election day at this point. So I don't know that it's responsible for day-to-day movements in the S&P 500, but in terms of how people are preparing for it, there's a tremendous amount of risk priced in. And the way we saw that evolve was initially a lot of risk priced in on election day. And then over the last 4 to 6 weeks, that risk has been slowly pushed out into later November and then into earlier December. So the market seems to be pretty on top of this in terms of the narrative. Whether it actually plays out, obviously, is another is another question to ask. If you look back to 2000, which of course everyone is doing, to get a precedent for a contested election, the equity market itself, the S&P had about a 10 or 12% drawdown over about a month-long period, but volatility didn't respond nearly as much. So I think the market's trying to decide whether this is a cash equity trade or something that you should do much more on the option side.
And Stuart, it seems as well, just looking at the situation now, it seems like it could be potentially more extreme than what we saw in 2000 also. Are there any other places that you're seeing it besides sort of the VIX curve, this election uncertainty play out, or are there any other ways that people seem to be sort of bracing for that eventuality?
Yeah, look, the VIX curve clearly, listed S&P options as well. And then I think at the single stock and sector level, people are really struggling with how to reflect election risk. The most obvious one would be to trade taxes. So to identify companies most impacted if corporate taxes were to rise under a blue wave type scenario. And then that also brings tech into the discussion. And a lot of people are really trying to handicap what would happen to tech in that case, because tech has been the market leader. But if there were broad-based regulatory actions taken against the sector, or if you increase corporate taxes, or if you increase capital gains taxes, which might have smaller investors selling stocks to lock in a lower tax rate, all of those could be headwinds for the tech sector. The hard part is it's the sector that's generally working. So do you want to bet against it, in the approach to the election, or is this something you want to do as the election really nears? So I think those would be the two areas, corporate taxes and then the tech sector, where the most debate has been had. And healthcare and financials, I think, would be your tier 2 ways to approach that.
Hi, Stuart. This is Emily. Just looking at the election, if you're a short-term investor, I can see how markets perhaps can't see past the next 40 days or so. But if you're a longer-term investor, how do you really see them playing this election risk? When might those uncertainties start to dissipate, and when could that positioning start to come back into play?
Look, I think for a long-term investor, ideally, if there's any pullback, you'd look at that as a buying opportunity. I think the question would be, if you're thinking about the blue wave type scenario, which I don't think most investors consider the majority outcome, but probably the plurality outcome. So, the most likely of the three. If that were to happen and you were to get a significant change in the regulatory and tax environments, over the medium term, then clearly you have to kind of bake that into your outlook for markets. So I think, big picture, if there's a stock you really like and the election gives you an opportunity to buy that at a better level, that probably makes sense. But if you did get a blue wave with real structural changes to the corporate and regulatory environment, then maybe you need to ask some questions about what that means for longer term earnings power. But I would tend to agree with you. If you're someone who's going to hold the stock for 5 years, the election may give you a better entry point rather than a risk.
Hey, Stuart, it's Brian Chung here. So Emily asked you to look forward. I guess my question is kind of looking backwards. What does the derivative space look like in terms of volume now versus, say, at the onset of this virus in late March, early April? It does seem like for right now, if you look at broad asset classes, it seems like things have kind of gone back to normal, if you will, with investors maybe ignoring some of the economic data that we see on that front. But is derivative pressure maybe to blame for some of these 500, 600 point sell-offs that we've had kind of periodically over the past few weeks, or is that just normal market functioning there?
It's a great question. I think there's been a lot of new coverage, obviously, of the large options activity, particularly in the tech space, that went on in late August and early September. And clearly that did have an impact on how markets were trading. Our view would be that positioning doesn't drive the market. to sell off or to rally, but it creates a situation in which the market can move more or less in response to news. And I think that's what happened in late August. Basically, what happened is a lot of investors were buying call options and upside in the tech space, and that left Wall Street short a lot of those options. And I think that did contribute to the very sharp rally you saw in late August. And then unfortunately, it also kind of contributed to the unwind a bit. Our view is that a lot of that risk has been digested over the course of the last couple of weeks. More than 50% of those options expired last week in September. So, the size of it has decreased a little bit. And we do believe that the last couple of weeks when the market calmed down, even just a little bit, allowed Wall Street to adjust a little bit better to those positions. So, it's definitely had an impact. It's just sort of curious that the impact was that a very bullish trade actually, turned into creating a risk of a sell-off. So, I would say, definitely derivative space is in play here. If you take a step back, U.S. equity markets, their implied volatility is very, very high relative to other parts of the world, and also relative to how much realized vol they've been generating. But I think you could argue that makes sense. We've got a lot of headlines ahead of us, and a lot of people are worried about the election, the vaccine, the Fed, earnings. There's a lot of reasons for that risk to be priced into the system. But clearly it has at least been one contributor in terms of the volatility we've seen for the last couple of weeks.
Stuart Kaiser is UBS's head of equity derivatives. Good to see you, Stuart, and we look forward to the next time you join us.
Thanks very much. Have a good day, everybody.
Let's talk about the need for space, because a lot of people, not only working from home, are looking for either an existing house to buy or even a new home. Sometimes it's because you're the father of triplets, somebody like Tendai Kapfidze, who's Lending Tree's chief economist, joining us now to talk about what's happening with housing sales, but also the fact that if you're about to refi your mortgage, starting December 1st, that's going to become more expensive. But Tendai, it's always good to see you. Let's start with home sales. Median price around $310,000. It's going up. And we know new home sales are surging once again, more than 43% in August. What advice do you have for people who might be trying to get a house but worried about the stampede to do that?
Yeah, what I would say is that if you had a plan to buy a house this year, say, and maybe you had postponed that plan because of COVID and the upheaval in the economy, you probably want to follow through on your plan. I would caution against rushing in to buy a house because you see everybody else buying a house. If that wasn't originally your plan, you want to proceed very cautiously. Of course, rates are very low, so it's advantageous to purchase a home right now because of low rates, but low rates also driving up prices, which is eroding some of that advantage. So you want to make a very measured and thoughtful decision here, as you always want to do when you're buying a house.
Hey, Tendai, it's Julie here. So that new home sales number is pretty eye-popping when you look at the year-over-year number. So the annual pace of new single-family homes, 43% higher in August than it was a year earlier. Now, is that a question of pent-up demand from earlier in the year being pushed out, or is that also just straight-up demand here?
It's a combination of both. So you definitely have a lot of demand that's being generated by the low interest rates. But you also have this pent-up demand from earlier in the year that's been pushed later in the year. And a thing that happens, this getting into some of the technicalities of how they calculate these numbers, is a thing called seasonal adjustment, which is what they do to try and smooth the numbers out so that they're comparable over the entire year. Now, traditionally, your highest home sales months are early in the spring. And August is still a pretty high month, but you're kind of on the tail end of the home sales season at that time. And because we've had these sales pushed later in the year, but we're still applying a seasonal adjustment as if it was a regular year, that's bumping the numbers up. So a very clear example is today's new home sales number, where if you look at the unadjusted data, they were unchanged from July to August. But if you look at the adjusted data, they were up 4.8%. That 4.8% is entirely because of the seasonal adjustment process. So you want to be a little cautious interpreting these numbers because they're not the usual type of numbers we'd get in August.
Tendai, starting December 1st, refinances backed by Fannie Mae and Freddie Mac are going to have to pay an adverse market refinance fee, roughly 0.5% of the total loan amount, in some cases at the higher end, depending where you live. That could add an extra $3,800 to the overall cost of a refi. Do you expect this to have a negative impact, or is this a nothing burger?
I think it'll definitely have an impact, right? It'll probably boost rates by about an eighth of a point. If you translate that fee into an interest rate, there's kind of technicalities of how you do that. But I wouldn't be surprised if they bump again, right? They tried to do it earlier. There was a huge outcry, and they may not end up doing it. Part of it is that I guess Fannie and Freddie are looking at the profits that the mortgage lenders are making, and they're saying, well, we want some of that. So they're going to impose this additional fee.
Hey, it's Brian Chung here. So that fee, in addition to a number of other market pressures, I think one being the Federal Reserve's commitment to keeping rates near zero for at least the next few years, in addition to people probably being discouraged by the asset prices themselves, how expensive homes have got as listing prices around the country really go up. Does that mean that we should expect an alleviation of some of this buying or demand pressure for right now, especially now that we're headed into this off and quiet winter season? Or do you still expect it to be quite elevated through the end of this year?
I think it's really difficult to say. I mean, it's such an unusual year, both in terms of the economy and the housing market in particular. I think as long as you have the Fed committed to low rates and they're driving these mortgage rates lower, that's going to create a lot of demand. A lot of people are going to look at those rates and say that's really attractive, right? We think rates could still fall by almost another 30 or 40 or 50 basis points. We could get rates as low as 2.3%. if you look at the spread between the 10-year Treasury and mortgage rates and take it back to pre-COVID levels. So there's a lot of attraction for people who are looking to acquire assets. There's a lot of attraction for people who have been thinking about buying a house and are looking at these rates. And some of this is really fundamental. If you look at the millennial generation, a lot of people are kind of getting into those peak home buying years. So even before these low rates, demographically, housing was set up really well, and these low rates have just added juice into that.
2.3% is the headline, Tendai, and I think we want you back as soon as that happens. Tendai Kepfise is always welcome here on The Move. He's Lending Tree's chief economist. All the best to you and your family, Tendai.
Thank you.
Taking a look at markets right now. Want to look at some stocks on the move. My old stomping ground, WEWS, Scripps Howard, TV station chain that had 59 stations, about to have 62 news stations. Why? They are purchasing Ion Media. This is a deal that caused the stock price of EW Scripps to surge before the opening bell more than 40%, right now up about 21%. It's a $2.65 billion deal. The company's market cap prior to this was under $1 billion, but who's backing it? Berkshire Hathaway, with a $600 million investment by Warren Buffett for them to close the deal with Ion, which again will add 62 markets for Scripps. They'll have a total of roughly 120 plus TV stations. And Buffett, by the way, second largest holder within the EW Scripps chain. Then there's United Airlines. A lot going on with UAL. Shares were down about 4.3% at the opening bell. They announced this morning they are going to provide a rapid 15-minute COVID-19 test to passengers on their San Francisco-Hawaii route. That will start October 15th, but this could be a new protocol going forward as international travel starts to ramp up again. Also, we heard from Oscar Munoz, the former CEO, now the executive chair at United, saying there are no plans for a bankruptcy filing by United Airlines. Again, no plans for a bankruptcy filing. And one last thing, as you look at that stock price, United Airlines is the official airline of the Commission on Presidential Debates. They will be flying all of the staff that are involved in putting on the presidential debates. The first one is the 29th. For the 3 debates, it's about 65 people who United will be shuffling between the cities where the debates will take place. More on The Move right after this. Markets here on the move. S&P 500 essentially flat right now. The Dow is off by about 50 points. NASDAQ has fallen just a bit, but still positive, up about 37 points. Nothing breaks the ice on a first date than talking about the Fed's inflation target or maximum employment. Right, Brian Chung? You spoke with Eric Rosengren. What did he have to say?
Well, I'd speak for yourself, Adam. I think inflation is extremely exciting. But yes, as you mentioned, I did speak with Boston Fed President Eric Rosengren this morning, had the chance to talk about his economic outlook. What's notable about the Boston Fed chief is that he has a more pessimistic outlook than his other colleagues with regards to what the economy might look like in this recovery. One example being he doesn't see that case for a 5.5% unemployment rate by the end of 2021 as the median member of the Federal Open Market Committee does. But he does say, regardless, interest rates will remain low for a long time. Here's what he had to say this morning.
I think the market fully understands that we're not raising interest rates from the 0 to 25 basis points that the federal funds is currently trading in for several years. And that's consistent with the forecast that came out of the Summary of Economic Projections. It's also very consistent with the guidance that we provided. So exactly how we measure it when we're so far away from where we want to be, I think is a secondary concern to just trying to get the economy moving more quickly.
Years is the main keyword that President Rosengren really used there. And he was saying that the markets are pretty well aware of what the Fed is trying to do here. But he did express some concern that, yes, indeed, it is hard to communicate the Federal Reserve's intention to moderately overshoot its 2% target. We realized that was going to be a problem when we had Charlie Evans from the Chicago Fed earlier this week jumbling markets up by saying it's possible the Fed could raise interest rates before that time. But it is notable that the framework does allow for that. President Rosengren saying in our interview that as well, that if financial imbalances do come up, things like financial risks or stability problems, that the Fed could indeed raise interest rates, but definitely not the case for right now was his main message.
Brian, I know it's the second round of testimony by Jay Powell, as well as Secretary of the Treasury Mnuchin before Senate banking today. Any update? Have they said anything we didn't hear the other day?
Well, Adam, it's actually the third day of testimony here. And yes, as you would expect, after multiple hours on both Tuesday in addition to Wednesday, nothing particularly crazy new coming from his testimony to the Senate Banking Committee that's ongoing right now. But Chairman Powell saying that, quote, there is a time coming when we're going to need to get back on a sustainable fiscal path, end quote, related to the U.S. debt that's been accumulated in the middle of this crisis. But he's been very adamant in saying that we should not fear spending right now, and that now is not the time in the middle of a pandemic to be concerned about spending. So yes, we spent over $2 trillion on that CARES Act bill back in March. That's definitely something that's going to add to the federal debt, but that if we don't try to do something further, if we don't have further fiscal support, as Fed speakers have called for in recent weeks, that the ultimate damage to the economy could be far worse than whatever the consequences of higher federal debt and deficit would be. So something that's definitely in view as the Senate, who he's speaking to, tries to continue to work with the House Democrats in addition to the White House on trying to get another package, if that is indeed in the pipeline.
And that hearing's still going on. We're going to go into a commercial break, but want to let you know when we come back, we'll check markets. We're also going to be talking about the impact everything is having, especially with the pandemic, on fintech and how COVID is changing the way we pay for things. Back to On the Move as we check markets. Want to let you know that the S&P 500 does retain its ability to stay positive, now up about 8 points. Dow is up 11 points and the NASDAQ is up 73 points. We're inviting into the stream right now Dan Dolev. He is Mizuho's senior tech analyst. He's joining us from New York City to talk about the impact of the COVID-19 pandemic on the way we transact all kinds of things through contactless transactions. And before we get into that, I just want to talk to you real quick about something Wall Street Journal wrote about with Venmo, because I think a lot of us know Venmo and Zelle, but Venmo particularly got into some issues with having to go after people who overdrew their accounts, whereas other fintech apps don't necessarily go after people on these kinds of situations. What kind of impact does it have if someone as big as Venmo is doing something that the users might think, yeah, I want to stay away from them?
I think this is a really interesting question. Those apps have become so viral and so important and such an integral part of everyone's day-to-day life, right? People are transacting once, twice, 3 times a day with Venmo. I think that the overall impact is going to be minimal to that. I think that they've become such a big replacement of cash that you're not going to get a big impact over the medium term on these news.
Dan, as we look across, it's Julie here. Nice to see you. As we look across the different payment companies, and I know you look at PayPal and you also look at the likes of Visa and Square, which of them do you think have navigated this time the best, maybe gained the most market share, and might have the biggest, stickiest advantage coming out of the pandemic?
I think it's a great question. So we like both PayPal and Square a lot. Let me just parse it out. For Square, the Cash App has been a tremendous success, and it just shows how much successful it has become during the pandemic. You have over 30 million actives who are actually using it right now, and they're actually targeting even more and more demographics, and the TAM is going to be bigger than what we expected. We hosted some executives from the Cash App this week, and they were talking about just how big the opportunity is and so many more opportunities. So they're going to come out strong out of the pandemic. The use case there has become much more strong. On their seller side, on the point of sale side, Square is a natural share gainer. So if things get rough, they actually gain more share because the incremental user or the incremental restaurant is going to go to Square versus their old solution. So they're coming out super strong out of the pandemic, and we're very bullish on them. Same goes for PayPal, right? The work that we did, it shows it's not just e-commerce growth that's driving the growth, it's share gains, right? So the more people are clicking on the PayPal checkout button more often than before. So it's e-commerce, but it's not just e-commerce. There's idiosyncratic growth at PayPal that makes us really bullish on it. And last, I want to say the QR code, they're piloting a QR code right now. So as you know, people in China pay with using QR codes. Here, it's mostly Apple Pay, Google Pay, tapping. They're piloting QR code, and we did a survey showing 60% of PayPal and Venmo users want to use QR codes. You've got 120 million users, 60% of them likely would say that they want to try it. That's 10 to 20% upside to their volumes over a very short period of time.
Dan, this is Emily. You mentioned Square's point of service, and that's one of the things or point of sale, and that's one of the services that I wanted to touch on, because when we think about that company, its exposure to small and medium-sized businesses, does the pandemic-related widespread shutdown of many of these stores and restaurants, some permanent, actually have a downside risk or create a downside risk for that company and others like Visa and MasterCard that might receive revenue as a percentage of each of those transactions?
That's a great question. Thanks, Emily, for asking that. So one thing, over a short period of time, over 1 or 2 quarters, yes, it does create a risk, right? But if you think about Visa, for example, they get paid 3 times more for the average e-commerce transaction. They get paid like 45 cents. This compared with like 15 cents for the average brick and mortar. So even though brick and mortar is going down because of the shelter in place, e-commerce is growing 30% plus consistently in the US, and that's not stopping, which more than offsets the decline in brick and mortar. So guess what? E-commerce stays where it is, but brick and mortar is slowly coming back, right? All you have to do is walk around, the streets of New York, which I do, and you see all these restaurants and they're packed and there's people waiting in line to sit at the restaurants. So you're going to see a stable e-commerce and a recovery in brick and mortar, which means that payments is going to get more popular and drive more volumes for both Visa, PayPal, and Square than in the past.
Dan, the next evolution in fintech and these payment platforms, would it be some of them perhaps becoming banks themselves and no longer being kind of a middleman?
That's a great question. This is sort of the holy grail, right? So if you think about it, we hosted the executives from the Cash App executives earlier this week, and yes, becoming more and more of a what I would call a BaaS, which is banking as a service, is the holy grail for some of those apps. And the interesting thing here is the cost of acquisition for someone like Square are much lower than for traditional banks, so they can afford to acquire more customers and monetize them better. And I think this is kind of the future. And there's such a big TAM on disrupting the big banks. And I think this is sort of the ultimate holy grail for the Squares of the world.
And let's get you back soon as we see them perhaps taking movement in that direction. Dan Dolev is Mizuho's senior tech analyst. Good to see you again. We look forward to the next discussion, hopefully before we're all back in studio. All the best to you. When we come back, we're going to have Dan Halley's tech support segment on how you can make your iCloud storage, for all of you with Apple devices, more efficient. Copy. Welcome back to Yahoo Finance on the Move. We talk a lot about our devices, whether they be Android or iOS, but specifically for people with Apple devices, cloud storage is becoming more and more of an issue, especially once you run out of the free space. Dan Halley, how can I get the most out of my iCloud storage?
Yeah, never has there been a service that's both exceptionally convenient and annoying. iCloud storage basically lets us save anything we need, but then you get those really, really obtrusive pop-ups telling you that you're running out of space. But there are ways that you can save space to stop getting those and get even more. So the first thing that you're going to want to do is actually delete some photos. Your photos are probably the thing that takes up the most space in iCloud. So to do that, what I want you to do is go into the Settings app on your device, and then you're going to want to go to Apple ID, iCloud, Media, and Purchases. And this will bring you to an area where you'll be able to go into your iCloud tab. And then once you're in there, you'll be able to see which apps are eating up your storage the most. If you go to iCloud, what I want you to do is untap the button that allows for constant iCloud backup. And this will prevent your photos from continually uploading to the cloud. It is incredibly important, though, that you take into account that once those photos are not uploaded to the cloud, they are staying on your one iPhone. And if they stay there and you lose your iPhone, those photos are gone forever. So if you do decide to do this, you may want to back up to another cloud storage software or to your own computer. Just keep that in mind. There's also a piece called My Photo Stream that will automatically update every 30 days of the photos that you've recently taken. They'll stay in the cloud. It won't count against your iCloud storage. And what you can do is just take that and then offload them to another device. And then the next 30 days rolls around, you'll get a new 30 days worth of photos. After that, the second biggest thing might be your old iCloud backups. This is basically when you have your iPhone or your iPad, you automatically back them up to iCloud, and that allows you to then get a new phone and then automatically download all of your data to that device. It also makes sure that if you lose your phone, all of your data is still in the cloud and not lost forever. But if you have several iPhones or several iPads over the years, chances are you've got a number of backups stuck in your iCloud that are just taking up space. So you want to go into that iCloud tab again and then go to backups and look at the old ones and delete those. I personally have 14 gigabytes of space being taken up by old backups, but I use a lot of different phones, so that's kind of outside of the norm. But for the average person, you may have one that's just taking up 5 gigabytes of space. Get rid of that and you'll have more storage. After that, I think the other thing to do is delete your old text messages. Believe it or not, these can take up a ton of space between the photos, videos, GIFs, different things you send to each other. What you're going to want to do is go into that iCloud tab again and then tap text messages. You can delete all of your text messages from here if you want, or you can see your top conversations and then delete those as you see fit, depending on which have the most data taken up. And then there are certain apps that are being backed up to iCloud that you just don't need. For instance, I use a photo editing app called Pixelmator, and that's taking up a ton of space. You can just turn those off in the iCloud tab entirely, and then they won't be taking up any more space anymore. Plus, some of these services have their own cloud backups that you can rely on. And I think one of the last things that you're going to want to do then is buy more storage. Unfortunately, it's not what a lot of people want to hear, but it really is the easiest and most convenient way to do things. I personally subscribe to a 50 gigabyte plan with iCloud. It's 99 cents a month. I can save my photos online. It's not a problem. If you need more space than that, there's also a 200 gigabyte plan, and that's only $2.99 a month. This is less than like a Burger King meal or a Wendy's meal. Burger King's not as good. But I would suggest going with the 50 or 200 gigabyte plan. There's also a 2 terabyte plan for $9.99 a month. You don't need that. That's just way too much. In the end, buy more storage, delete some of that old nonsense that you don't need, those backups and those text messages. And remember, you're going to want to back up those photos regardless.
Dan, I got to ask you regarding photos. So this is an issue for a lot of us because, and I'm looking at mine, I actually have more docs stored in the cloud than photos, but photos is next. But if I turn off photos now on the phone, it'll delete, but then it deletes all of the photos across my different Apple devices. How do you do this simply? Why don't they make it simple?
It's supposed to be simple. The whole idea of iCloud is so you can get your photos on any device. Now, if you delete or stop using iCloud, then you're going to lose those photos. If you don't want to lose them, you would just then download them to, say, your Mac or your PC or something along those lines, so they're in another device stored there. And I think that's really the big issue for a lot of people. That's why I say the best bet is honestly to just subscribe to iCloud storage.
All right, Dan Howley. A lot of people are going to be reading how to do this as soon as we wrap up. We're going to head to break. When we come back from break, we're going to be speaking with the CEO from Open Igloo, especially for New York renters. This could be a big one, rating New York City landlords. So a lot of people are renters, and in New York City, one of the things that can be so aggravating is dealing with your landlord, especially when the hot water, which legally is supposed to be there, is not, and so much more. Alia Mohammed is the co-founder and CEO of Open Igloo, and she joins us now to talk about how Open Igloo can help make that process a lot easier, kind of a little bit of prevention, right?
Absolutely. So Open Igloo is a mobile application that allows tenants to share their rental experiences, but also access real-time city data about their landlords and buildings. So for example, open building violations, litigation history, eviction history, and more.
If people, hi, Ali, it's Julie. If people wanted this information before, how would they get it? I mean, is this something that is accessible like at City Hall, for example, in terms of the data part of it? And are there any other competing sites that sort of do these kinds of reviews?
Yeah, absolutely. So New York City is really sophisticated in the way that it collects building and landlord data. So landlords in New York City are required to register with the city. Violations are documented, but of course they're spread out over various data sets on the New York City government website. So what Open Igloo has done is really taken out the guesswork and compiled the important data points that we think is important for renters to know. There are other sites out there that have tried to collect reviews over time, but we think we are launching at a perfect time where vacancy in New York City and other big cities are at all-time high, giving renters the first time a chance to actually take their time, take a breath, and do research about their apartments. In the past, really, it's been a 5-minute decision, and we really want Open Igloo to be the platform that helps renters do their due diligence and make a confident decision in their home.
Looking at the data that you've aggregated so far, what neighborhoods in New York and Brooklyn and elsewhere in all the boroughs really have the highest ratings, lowest ratings? And does that at all correlate with the number of users in these areas who've actually input information into the apps?
Yeah, it's a great question. So we're really excited about the data that we've collected across the 5 boroughs. What we've learned, interestingly, is that landlords from Queens are the most responsive. So we ask tenants to review their landlords and their buildings on a variety of factors. So water pressure, heat, landlord responsiveness. You know, does your landlord respond to your email after an hour or 7 days? So what we're seeing is that landlords from Queens are definitely the most responsive. Naturally, the bulk of our users so far have been from Manhattan, and we're seeing some interesting rivalries between the neighborhoods on who's outperforming. So it's been really interesting data so far.
Hey, it's Brian Chung here. There's some serious Brooklyn erasure there, but I wanted to ask briefly about just what the numbers look like right now during this pandemic. It seems like actually, if anything, this type of information will be extremely useful because it is kind of a renter's market right now. A lot of these buildings are desperate to hold on to tenants or find new tenants, so people might be moving around. Is there heightened interest in the type of data and services that you're providing specifically right now during this time?
Absolutely. I mean, COVID-19 protocol is at the top of mind for renters looking at a home. So they want to know, how did the landlord and the building management respond to COVID-19? They implement new sanitation measures. What have they been doing to protect tenants and staff? Have landlords offered rent relief during this time? Were they flexible in tenants trying to get out of leases? That's all information that we've been collecting. So far, 20% of Open Igloo users have said that their landlord has offered some sort of flexible rent payment plan due to economic stress caused by COVID-19. And what we want to do is we want to help renters find those landlords that have showed a lot of flexibility and compassion during what has been one of the most difficult periods in American history.
3-part question for you, Alia. First, can you share with us the number of downloads you've had for the app? Second, expansion plans to other cities. And third, the data you've got has got to be incredibly valuable, not only to the users, but someone out there, I bet, is going to want to buy it. Do you sell any of this stuff? Because you're seeing things in real time.
Absolutely. So in our first 6 weeks of launch, we have 15,000 New York City users across the 5 boroughs, and definitely want to keep expanding to other cities. So cities like Chicago, LA, San Francisco, with huge renter populations, with a huge demand for this data and being able to find a home. What we're really trying to do is address this asymmetry of information between landlords and tenants. So landlords, all the information, your tax returns, your statements, your reference letters, credit check. And what we really want to do is give tenants something in return and give them the information that they need to make a confident decision. And we're not selling the data yet. We're really, our focus is just on tenants and building a platform that's useful for them.
Yet is the operative word. Some of us don't think there's anything wrong with selling data. So we wish you the best, continued success, all the best to you, Alia Mohammed, Open Igloo, co-founder and CEO. Good to have you here. Turning our attention to Influencers, the program that airs here on yahoofinance.com every Thursday. Our Andy Serwer spoke with the actress Jessica Alba about an evolution that's underway in Hollywood.
Movie theater business, is that coming back? Are you concerned about that?
I'm not too concerned. I mean, I think that, the old Hollywood has a kind of a tough time, right? Adjusting they've seen this coming for a good decade, and they were slow to move from the, certainly representation. The Me Too movement really blew up a lot of the kind of old stodgy ways that Hollywood operates. And I think similarly, I think Hollywood just really has been forced to think of the new media and new digital era, and how do you also create experiences around what is a movie night, and how can you create a real experience beyond go and show up at a movie theater. How just think outside the box. And then if people do want to enjoy entertainment on their phone, no matter where they are, on their iPad, on their computer, on some device at home, it's like, how can you show up and give that to them no matter where they are, instead of creating so much friction? So I think Hollywood will get there. They're just a little slow to, adjust and change, but eventually it'll happen.
You can watch Influencers at 5 p.m. here on yahoofinance.com. We'll be right back after this break. Back to Yahoo Finance on the Move. Earlier in the program, we talked about United Airlines, the news from Oscar Munoz not seeking a bankruptcy filing, putting those rumors to bed, and those shares are down still about 2%. And then there's the big deal with Scripps Howard and their investment with Warren Buffett to purchase Ion Media. Those shares are trading up more than 20%. Much more going on in the markets, though, and Jared Blickery is joining us now to tell us about it. Jared?
Well, we got a turnaround today. Tech is leading higher, and that's quite the about face from where we were at the open. Let's take a look at the Wi-Fi Interactive. We can see the S&P 500 somewhat choppy, but finally climbing into the green. NASDAQ is up 0.8%, pretty close to session highs. Let's take a longer term look. This is going to be a 3-month candlestick chart, and we're going to put that 50-day moving average on it. And we can see that we hit new lows, new 2-month lows earlier in the session, but now we are climbing inside of yesterday's range. A lot of people on the Twitters noting that we could get a bounce from here. Let's take a look at the VIX, because that is back under 30, and we can see it's still a little bit elevated after it bounced off the 50-day, not once, but twice in recent weeks. But if you look at the VIX of the VIX, and yes, there is such a thing, we can see it's been relatively subdued, maybe not indicating as much panic here. 10-year T-note yield is down just a bit. That's going to be half a basis point right there. And we can see it's still consolidating in this trend channel, this pennant formation that we have here. Let's take a look at some heat maps. We got the NASDAQ 100, lots of green here. Again, a flip from the open when there was a lot of red in these big cap names. The Apple's up more than 2%. So is NVIDIA. Tesla having come back, it was 4 or 5% in the red pre-market. It is now 3% in the green. You can see over the last 5 days, though, still pretty close to the lows that we've seen, off 7% during that time period. Microsoft and Amazon each up more than 1%. And let's take a look at the travel names. Those are deeply in the red. Those started out red and they stayed that way today. Southwest is down 2.8%. Delta, similarly, United, we were just talking about, down 2% as well. And the cruise lines off 3% or nearly 4% in the case of Norwegian. And we can see just how bad it's been for them over the last 5 days, down 15%. Let's take a look at the sector action. So tech is in the lead. That is up 0.9%, followed by real estate, staples, and utilities. Kind of an interesting mix there. And to the downside, energy off 1%.
Jared, you still there? I wanted to ask you about the value of the dollar, especially, not only the dollar, but I'm also watching gold. It's higher today, but still it's below $1,900 an ounce.
Yeah, I'm glad you asked. We have the US dollar index surging for the last 5 days, and it is now definitively above that 50-day moving average. We were talking with Keith Bliss earlier in the day. He said he thinks the dollar is overbought and due for a pullback now. That would be supportive of risk markets. So gold is up just 0.2%, bouncing off key support here around 1850. And just taking a look at silver as well, that's down 1.7%.
All right, Jared Blickery, we appreciate that. We have much more Yahoo Finance on the move for you. We're going to be talking more about the impact from President Trump's comments about a peaceful transition of power and what that's doing to markets when we come back after the commercial break.
It is noon here in New York. We're about 2.5 hours into the trading day. Stocks are trading higher for the moment. We've got the Dow up by about 0.25%, the S&P up 0.5%, and the Nasdaq up 0.9%. So reversing some of the recent volatility that we have seen, at least for now. Transition tensions. President Trump raises concerns after refusing to commit to a peaceful transfer of power should he lose to Joe Biden in November. Taking action, Facebook's highly anticipated oversight board plans to launch before Election Day, but is it too little too late? And losing its charge, the rough ride continues for Nikola shares after BP reportedly calls off a potential partnership with the embattled company. Welcome to On the Move. I'm Julie Hyman along with Adam Shapiro. And joining us this hour on the panel will be our Dan Howley and Melody Hom. First, we do want to talk about those comments from President Trump because they're causing a ripple effect, at least among market participants, even if we're not seeing a hit to stocks today. This all happened after a reporter yesterday asked President Trump if he would commit to a peaceful transfer of power. He said, we'll have to see what happens. And for more on his comments and the reaction, we're joined by our Jessica Smith, who covers D.C. for us. Jess?
Well, Speaker Pelosi just talked about this to reporters in the past hour or so, and a reporter did ask her if the House should take any formal steps like a censure or a resolution in response to these comments from President Trump. But she said that she doesn't think he's worth the trouble at this point. She just urged people to get out and vote. Now, President Trump has raised some doubts over whether he'd accept the results of the elections in the past. He has railed against mail-in voting repeatedly. But now, as you mentioned, he is refusing to commit to accepting this peaceful transition of power should he lose in November. Let's get right to the video of what he actually said when a reporter asked him that question.
Well, we're going to have to see what happens. You know that I've been complaining very strongly about the ballots, and the ballots are a disaster.
I understand that, but people are rioting. Do you commit to making sure that there's a peaceful transfer of power?
We want to get rid of the ballots, and we'll have a very peaceful. There won't be a transfer, frankly. There'll be a continuation.
Now, Democratic lawmakers and critics are sounding the alarm on these comments. Congressman Adam Schiff said in a tweet, "This is how democracy dies. A president so desperate to cling to power that he won't commit to a peaceful transition of power, but we will fight back. America belongs to the people." We have seen some Republicans push back as well. Senator Mitt Romney called a president not respecting a peaceful transition unthinkable and unacceptable. We have heard from a few other Republicans like Majority Leader Mitch McConnell. They haven't mentioned President Trump by name, but they are saying that there will be a peaceful transition in January, no matter what happens. President Trump has also said that he expects the election results to end up before the Supreme Court, and that is also raising more concerns as President Trump and Republicans try and fill this vacancy on the Supreme Court quickly before the election, potentially. Julie?
Jess, thanks so much. Let's get rid of the ballots. Haha. It seemed to have been meant as a joke, maybe, but definitely sparking some conversation. Let's bring in Paul Grunwald. He is S&P Global Ratings chief economist. He's joining us from New York. Paul, we've been talking over the past several weeks about the election and how market participants are pricing it in more and more, or trying to price in more and more the idea that we could have a contested election. But I'm curious for you if you have been thinking about a potential economic effect, if there is any potential economic effect. Will we have, for example, if the election is up in the air, could it have any effect on confidence or spending? What do you think?
Yeah, hi, Julie. That would be my first guess at the channel. I mean, if there was uncertainty, what happens? Well, people dial back on their spending, particularly on some of the more discretionary items. Maybe firms dial back on their investments. So whether it's election uncertainty or something else on the horizon that's, sort of clouding the picture, I think the implication for us macro folks and forecasters is that you get a potential slowdown in activity.
Hey, Paul, it's Adam. Good to see you.
Hey.
What are we seeing right now in real time? We get the labor numbers on one hand, and we're going to get next week the September job numbers. But then we see the spending situation. So we had 870,000 claims for initial unemployment, but yet it seems, although slowing a bit, that spending is holding up. And wouldn't that be good for the markets overall?
Right. That's the story that's emerging for Q3. Obviously, we don't have all the numbers yet in the U.S. or anywhere else, but here in the U.S. and also I would add in Europe, the households seem to be spending. We saw a lot of saving, even saving of the government stimulus transfer payments here in the U.S. But that money's being spent. The labor market's a little bit better than we thought it would be in this quarter, and then that sort of feeds into the confidence. So we're a long way back to recovery, but in terms of growth rates, we're thinking we could get something on the order of 30% annualized in Q3. As I think I argued the last time I was on your show, we should pay more attention to the levels. We're still below where we started the year, but we're potentially in a position to put up some pretty impressive looking growth numbers in the third quarter of the year.
Hey, Paul, I want to ask, we have this idea of stimulus still not coming through, the kind of back and forth relationship between the Democrats and Republicans. And then now we have this kind of comment from President Trump about maybe not having a peaceful transfer of power. I guess overall, where does that leave just sentiment on the future of the economy, especially at a point where we're trying to see this recovery start to really take off?
Yeah, Dan, we've been saying that the fiscal policy is key right now. So fiscal policy should try to cushion the blow, keep the labor market and the SME, the small medium enterprise sector, intact, and then lay the foundations for recovery. And there's a lot of uncertainty, as you noted right now, about the transfer payments, the PPP, some of the other things that are going on. So the risk is that that policy failure or the sort of the lack of delivery on the fiscal stimulus plans to the market could potentially slow the recovery. The Europeans seem to have this better than the US. We've seen Germany extend their plans into the second half of 2021, and there's a lot more certainty there. But in the US, the big question is going to be, given that we have this partial recovery going and given that we've got a lot of potential, disruption in the labor market, is fiscal policy going to come through and again, sort of cushion the blow and build the bridge? That's still outstanding. We'll have to see what happens there.
Yeah, and that's something that Jay Powell talked a lot about in his testimony this week, right? When lawmakers came to him and said, what more can you do? And he said, well, the ball's in your court now. And yet, when you look at some of the recent economic numbers, to Adam's point about spending, there was a lot of dire predictions that we would see spending fall off a cliff once those transfer payments stopped. And have you been surprised that they haven't? And so what makes you think there is still this potential for a real slowdown if we don't get another stimulus bill?
Yeah, but as I said, it's clear that the initial stimulus was partially saved, and the 600 a week was a big deal. We've still got an unemployment rate of 8 to 9%, so there's a lot of stress in the labor market. We've had a partial recovery, as I said, but we still have sectors that are running well below capacity. We still have parts of the labor market that are exceptionally weak. We've had people leaving the labor market. So again, you would want fiscal policy to keep that all together. I agree with Paul. The Fed's done about as much as it can. Policy rates at zero. The Fed's doing some QE, and it intervened in a whole bunch of markets, commercial paper, et cetera, to smooth volatility and kind of make the markets more stable. And we've seen financial conditions ease, but it's going to be a fiscal story. So on the policy front, the kind of make or break is going to be on the fiscal side, not the monetary side.
Adam, you just need to unmute yourself.
The button doesn't work. Paul, there's trillions of dollars sitting to the side. After the election, people are going to be looking to put that capital to work, not necessarily just in equities. Won't whoever wins this election get the boost of a massive spending and investment effort, and that will help this economy?
Yeah, well, there's obviously an overhang. There's money on the side. There's uncertainty about the virus, right? So I think the event that's going to unlock all of this is, the discovery of a vaccine or several vaccines, and then getting that to the broader population, which we think can happen, by the middle of next year. But you can easily imagine there's a lot of funds waiting on the sidelines to go in and invest, and also the economy is going to change. It's already changing, right? Away from person-to-person things like shopping and sports and et cetera. We're going to have more online stuff. We're going to have more health security. We're going to have less commercial real estate. So all of that restructuring needs to take place as well. But the big overhang here is the uncertainty around the path of the virus and when we get a vaccine. Things seem to be a little bit more optimistic than the last time we published and the last time we talked with you guys. That's probably a modest upside risk for us. But when we get clarity on that, sooner rather than later, all of us hope, that's going to unlock a lot of money and, hopefully really give a sort of a rocket boost to the recovery.
Paul Grunwald, S&P Global Ratings Chief Economist. Always good to get some time with you, Paul. Thank you.
Good to see you guys as well. Take care.
Let's now shift to the energy picture, or perhaps more appropriately, the energy global map. And with us is Daniel Yergin. He's IHS Markit Vice Chairman. He's author of the new book, which is called The New Map, Energy, Climate, and the Clash of Nations. He is also author of the Pulitzer Prize winning The Prize, also about the global energy picture. He's joining us from Washington. Daniel, it's good to see you. I want to begin with something on the map, perhaps. That's California, which just says now it's going to ban sales of new combustion engine vehicles starting in 2035. We've seen other countries also take similar moves. When you look at the narrative of the next decade or the next 25 years when it comes to the energy markets, is this sort of electrification going to be one of those big changing themes of the energy picture?
Well, certainly electrification and EVs have come from nowhere. I mean, the last time we had EVs was Thomas Edison, and now, of course, Tesla really got it started again. And also in China, which is very committed to EVs. And I think it's gathering momentum. You see the commitments of automakers like General Motors. The European automakers are under a lot of pressure from governments to move towards EVs. And I think this announcement in California is quite noteworthy, particularly as it coming right after the impact of the forest fires.
Daniel, useless trivia, but those original Edison electrics were badged as Studebakers. So you can use that in your next game of Trivial Pursuit. Let's talk about oil, because there was.
Let me just say, if I could just say one thing, I have this great photograph of Thomas Edison in his car and Elon Musk with his car, and it looks like Elon Musk is a reincarnation of Thomas Edison.
I'm not sure where to go with that, but let me ask
back to oil.
Let's go back to oil. There was a belief at one point we'd see a recovery in oil, but that now seems to be out. So what happens with the oil companies? They're making pledges of being carbon neutral by 2050, and oil companies saying that. What is their future?
Well, I think it varies among the companies. I mean, I think the European companies have all said we're going to be energy companies, and they're under a lot of regulatory pressure, and they're looking at how society's changed. I did a dialogue the other week with the CEO of Royal Dutch Shell, Ben van Beurden, and he talks about being in step with society. That's European society. I think the American companies are still, are focused on being efficient oil and gas companies and leaving wind and solar to other people. So you have a bigger spread among the strategies of the oil majors than I think we've ever seen before.
Daniel, I want to ask, in your book, you kind of talk about the geopolitical implications. So if we don't see oil kind of recover and we continue to see advancements in electrification, what does that do to the countries that rely on oil infrastructure and the sale of oil to keep their economies afloat?
Well, Daniel, I mean, that's a very important question, of course. I think we just talked about economics. I think we have to be a little cautious about generalizing about the post-COVID era because we don't know what kind of growth we'll see. We think U.S. will grow about 3.5% next year, but and GDP will have a big impact on demand. What we also see is the investment has been cut so dramatically in oil and gas development. That raises some questions about supply 2 or 3 years from now. But I think that the heart of your question is that I think particularly the Arab Gulf countries have gotten the message that diversification.
We seem to be having a little bit of technical difficulty, I think. Oh, Daniel, you're back with us. Apologies.
What?
We had a little bit of interruption to the signal, but now you're good. So please continue.
Okay. No, I was going to say, well, Saudi Arabia is.
Oh, looks like we've lost.
Less focused on diversification.
A choppy signal, Daniel. So let's try one more time, and then if it doesn't work, perhaps we'll try and get you reconnected.
Okay. Can you hear me now?
Yes.
Okay. And if let me know if it changes. I was going to say there's a difference between Saudi Arabia and Russia. I think Saudi Arabia has a diversification strategy. I don't think Russia does yet.
I want to pick up on the point that Adam didn't know how to handle when it comes to Elon Musk. It's getting harder and harder to be bearish on him, right? Especially when you see what's happening with Nikola and the other competitors potentially, the chasm growing wider and wider, perhaps. What do you make of these potential collaborations? You mentioned GM was getting very aggressive into this space, but if they're relying on a company like Nikola, do you think it's destined to succeed, or there are going to be continued problems and roadblocks along the way?
Well, obviously, Nikola is a particular problem. In the new map, I mapped out all these changing partnerships and relationships among big automobile companies, tech companies, startups, and everybody seems to be trying to figure out how do you play in this new world of EVs, of ride hailing, and of self-driving cars. And kind of the vision that I have in the book is something that we might call auto tech, when the large tech companies play a very important role in transportation.
Daniel, I'm curious, years ago, there was the book Flat, Hot, and Crowded, and it talked about climate change and the political implications of all of this. When you look at the things that are driving change, not only in the auto industry, but in the energy industry, do you see conflicts erupting, or because we're going to be less dependent perhaps on oil, that might let some steam off?
Well, there are two parts of that. One is I think we have moved from a pre-Paris world to the post-Paris world after the climate agreement, where people are all kind of congregating around these goals. I think what people are underestimating is the impact of the supply chains to get to a low carbon or net zero carbon future. And in fact, the other part of my book is about the rising geopolitical tensions and between the US and China, and who has a key position in the new energies. It's China. 70% of solar panels, the lithium battery supply chain. So I think over here is geopolitics, over here is moving to clean energy and low carbon. And I think could well be a collision between those two forces.
And I'm also curious, Daniel, where this leaves not just the traditional geopolitical powers, but also the traditional corporate powers. And I'm speaking of the likes of an ExxonMobil or a Chevron. There's now speculation that ExxonMobil's sort of fortress dividend might be under threat because the company shares have been falling. What does that do to the sort of world oil order? Or is it just a reflection of their irrelevance rather than will force them to change?
I think it's a reflection of what's happened this last year, what I call the new map, an economic dark age. Maybe now it's an economic twilight that is still, we still haven't recovered, and that's reflected in oil prices, which have been an economic symptom, really, of the virus. Dividends have been very important, obviously, for the companies and their following among investors, and you've seen some cuts by some of the majors. I don't know what the U.S. majors will do. They see it as very important. I think in general, the oil industry, and the shale industry needs to have a new social contract with investors. And that's even more acute for the shale companies to assure that investors actually get money back. It's not growth at any cost, it's growth at what cost?
Well, we'll see if that materializes. Daniel Yergin, thank you so much. Appreciate it. The new book is The New Map, Energy, Climate, and the Clash of Nations. Daniel's also the IHS Markit Vice Chairman. Thank you so much.
Thank you.
And I want to bring you a couple of stocks on the move as we take you to break. And these are actually somewhat related to the conversation that we've been having. One of them is called Tortoise Acquisition. It's one of these shell companies, appropriately enough. The ticker is SHLL. The shares are only off about 0.1%. They've recovered quite a bit. Earlier today, they were down in the double digits. This company is set to merge with the electric truck drivetrain maker Hyliion. And these blank check stocks, these so-called SPACs, had been falling after Jay Clayton, the SEC chairman, said in an interview that the agency is looking at the SPAC boom and is particularly focused on disclosures tied to SPACs. So we had seen a number of the SPACs fall. Also, we are looking at SPI Energy once again today. This company had a huge 1,200% gain yesterday. It had been trading at $1. It rose up almost to $50. Now it's up another 15% today. It launched a unit to design and develop electric vehicles and charging solutions yesterday. It's called Edison future. We'll see what more there is to it, because this is a tiny company. And even with those gains, it remains a tiny company. Well, coming up on a similar topic, we will be talking about Nikola and the latest on partnerships that look like they're no longer happening for that electric vehicle designer. We'll be right back. The latest Yahoo Finance Harris poll found that 2 out of 3 Americans are concerned about access to health care since the start of coronavirus. Perhaps not surprising, as health is first and foremost in many of our minds amidst this pandemic. Our Adriana Belmonte has the details on this poll. And again, not necessarily surprising when health has been so front and center for many people.
Yeah, so we conducted this poll for the past few days, and we found that about a quarter of or 1/3 of Americans are really concerned, like a lot more concerned about their healthcare since the start of the pandemic. Another third are just a little bit more concerned, and then some aren't as much. So that's a good majority who have at least expressed some concerns about access to healthcare affordability over the past few months. And I think just adding to this is the uncertainty of the election.
Out of curiosity, though, for years, Americans have been concerned about healthcare. So does the poll give us any new insight to that which we didn't already know?
I think a lot of it has to do with, there's been so many job losses that's come about because of this pandemic. And as a result, people have lost employer-sponsored healthcare. And so, some have had to rely on the Affordable Care Act, Obamacare special enrollment period to get healthcare coverage. Some have turned to Medicaid, and some are still uninsured. So, you add in these economic problems, and that's just, adding more fuel to the fire.
You have to wonder as well, Adriana, since you said the poll was conducted over the past few days, that this takes into account people's concern about the ACA ruling at the Supreme Court, right? And whether there will be a new appointee to the court. That case is set to be heard right after the election. So I wonder if that's part of the equation in all of this too.
So disclaimer, this was conducted right before Ruth Bader Ginsburg's passing. So, but there still is the fact that we did know that the Supreme Court was going to be hearing the arguments starting right after the election. So that still plays a major role in it. And, there's also the fact that President Trump has continuously said that he has a plan to replace the Affordable Care Act, and yet he still hasn't unveiled it. So I think people are wondering if this is overturned, then what happens to them? Do they lose their health care coverage? What is the backup that comes into play?
Adriana, what are they kind of thinking then when it comes to who they would elect? If people are concerned about what would happen if they, didn't have access to healthcare with coronavirus, are they looking then towards the election as kind of a means to address that, or what's kind of the line of thinking there?
Yeah, so also today came out this new Commonwealth Fund survey, which, honed in more on the specific candidates. And they found that, voters see Biden as more likely to address their healthcare concerns and needs, that Trump not as much. And it also has to do with, COVID-related healthcare issues. Again, they see Biden more as the person to do it. But if people are worried that Trump is going to be reelected, then they might have a lot more concern about their health insurance.
All right, thanks, Adriana. I appreciate it. We'll be keeping a watch on some of these numbers, and we'll have more results from Harris in the coming weeks. All right, let's take a look at Nikola as well today. Those shares are down about 3%, so falling once again today. The stock has really come under fire ever since that short sellers report from Heisenberg Research, as well as what we've heard from the Securities and Exchange Commission. Then today there's a report that talks that the company I've been having with BP to build hydrogen refueling stations. Those talks are now stalled. Dan, I guess it's not surprising when the company is under such fire that some of its partners are going to at least hold off, if not cancel.
Ooh, this is a fun story. Yeah, this is just, oh my goodness gracious. So I just, by the way, want to point out that Nikola was supposed to be working on hydrogen-powered trucks, and then the company that kind of, set off this whole firestorm is called the Hindenburg Research Group. So, kind of fits there, sort of, maybe, kind of. But I think really, a lot of what's going on now, and I'm surprised that the stock is, still where it's at. It plummeted a good amount, but it's not at zero yet. It's kind of seems like a lot of companies are hedging against the idea that Hindenburg is right in its investigations, that Nikola doesn't have any of its own proprietary technologies. What's interesting is if you look back at that GM deal, Nikola, again, was supposed to be producing its own propulsion systems using hydrogen power, natural gas, EV, using batteries. But with that GM deal, they brought nothing to the table. It was GM providing all of that stuff. They were providing the propulsion systems, their own proprietary systems that was then going to go into this Badger truck. And when that deal came out, the fact that there wasn't so much scrutiny, it was more, oh, look, GM is getting into bed with this company that could rival Tesla. And it just so happens to ape the name by using Nikola Tesla's first name rather than his last name. It just seems that there wasn't enough scrutiny behind it at that point. And then, look, the Hindenburg Research, yes, they are a short seller, and yes, they have a short position against Nikola, but they did a lot of research in this and point to a lot of interesting facts in here that, it's pretty damning when you look at it.
And Dan, to that point, as much as it was comprehensive and robust research, why didn't GM do that? And GM is claiming now and doubling down, saying that they did do their due diligence, and this is a partnership that they're going to continue pursuing. But I have a feeling that in the coming weeks, perhaps coming months, there will be some cold feet. It's impossible, Julie, to your earlier point, with these future partnerships that are already on cold ice. I don't anticipate that this GM deal, however it may manifest, will end up coming to fruition in the way that both parties on Yahoo Finance's programming sort of purported a couple weeks ago. And I do want to point out, Electric actually reporting this morning saying that Tesla is now claiming Nikola stole its truck design from a Rimac designer, and they're suing the company now for up to $2 billion in damages. This is just pouring gasoline into the fire, right? I know we're talking about EVs, but that's the best analogy I could come up with right now. And just thinking about the ongoing struggles, now it's the time for other competitors, namely Tesla, to really double down on attacking Nikola while they're down, right? It's a very easy target and culprit at this point. And then one last argument I want to bring up is Trevor Milton, who sort of branded himself as the nicer version of Elon Musk, the more palatable version, if you will. He also took to Twitter in the same way, sort of modeling after Elon Musk, right? responding directly to trolls. I do want to point out as of yesterday, his Twitter handle, Nicola Trevor, no longer exists. He doesn't have that physical, the digital footprint online anymore, although of course we know those tweets are archived and screenshotted everywhere on the internet. But I do anticipate that these sorts of tweets will come back to bite him. And we know that Elon Musk had gotten in trouble, right, for a lot of his sort of social media behavior. So it's fascinating to me that Trevor Milton, through this whole process had been using the same sort of tactic that actually led Elon Musk into hot water in the first place.
Yeah, I think when you look at, GM and how you mentioned that there's going to be some kind of backlash, it really, I think, just comes down to these companies trying to catch Tesla, trying to be that hot company that gets into the EV space. Look, they can't sell EVs like Tesla can. They don't have the cool factor, the sexiness factor. I mean, Elon Musk said some wild stuff on Twitter. He's gotten in trouble for it. But his vision, it's being executed at a level that the other old school automakers just can't touch.
At least not yet. All right, thanks, guys. Coming up next, we're going to talk Xbox with the Vice President of Gaming at Microsoft. We'll be right back. We have seen a gaming boom as people have been stuck at home, and they'll have a new option come November 10th. That's when the Xbox Series X and Series S will be launching. Joining us now is Phil Spencer. He's Microsoft's Executive Vice President of Gaming. Phil, thanks for joining us. I do want to start by asking you about expected demand for these products, and especially the sort of split between the two, the X being the more premium product, the S being a little bit lower priced. And especially given that we've already seen a lot of buying of gaming products during this pandemic, what do you think demand's going to be like for these new Xboxes?
Yeah, well, we just started pre-orders this week, and we sold out of pre-orders within the first day. So as you said, gaming's seeing a real boom right now with so many people stuck at home and looking for entertainment options in their houses. And gaming is just we're seeing a lot of engagement across the services. So feeling really good about demand this holiday. We just got to make sure we have supply to feed it all.
Hey, Phil, this is Dan here. I big gamer, got a Xbox One X next to all my other consoles. I want to ask you, in terms of performance, we have the X and the S. What does that do for gamers? Does it cause a stratification of gaming? Will it be similar to a kind of high-end PC or a mid-range PC? Will you get the same experience across both systems? How's that going to work?
Yeah, you nailed it. That's exactly right. And, I think you've seen even like the NVIDIA cards that came out this week. There's different performance levels for how big of a role gaming plays in someone's life. And we have the Xbox Series X, which is the most powerful next-gen console from anyone in the market. Feel great about that for 4K gaming for people who want premium. And then the affordable Series S option for people who look at kind of 1080p or 1440p. But it still has, at even the affordable price, it still has the next gen SSD and all of the CPU work and the kind of high performance work that's in the upper level device. It just had a different resolution. We think giving gamers choice about how they enter gaming, especially at a time right now with some economic uncertainty in the market, is really critical.
And you guys offer Xbox Game Pass with xCloud or Project xCloud, your cloud gaming service. That's $14.99 a month. That's still in beta, but that seems to be where gamers and game companies want to go. So I guess when you look at something like that, and Microsoft is, you could say objectively, it's been the most successful as far as getting this off the ground and not having issues with third-party publishers as much. Where do you see then consoles like the Series X and Series S down the line? Do you think once we get this cloud gaming going that we'll see another generation of hardware, or will it all be kind of a conduit for cloud gaming in the future?
Yeah, we're about putting the player at the center. It's not about the device in the middle anymore. And you see that in every other form of media. My TV is with me wherever I go. My music is with me wherever I go. I'm in control of the experience. And I think gaming is going through that same transformation, which is why, as you say, if you're a Game Pass subscriber, you can now play your great games on our Xbox console, on your PC, or now on your Android phone via streaming. One subscription gives you access to your catalog and your community wherever you go, giving players real choice. In terms of future hardware, absolutely, I think we're going to see more console hardware down the road. Just like in video, just like in music, it's not that streaming has cut off device innovation. I think we'll continue to see that, and that's absolutely what we're planning for.
Okay, and I got to ask you about, you guys recently acquired ZeniMax Media. They're the parent company of the storied studio Bethesda. They've made some games that I probably have spent way too much time with: Elder Scrolls, Fallout 3, one of my favorite games ever. I guess, $7.5 billion. Microsoft has been sucking up studios, producing its own first-party games. Two questions. One, what does this mean for Microsoft in the future as far as becoming an even heavier hitter when it comes to first-party studios? And two, and this is probably the question that a lot of people are wondering, what does it mean for first-party exclusives for something like an Elder Scrolls? Will we only see that on Microsoft systems, or will it go across other systems similar to what Microsoft has done with Minecraft?
Yeah, really excited about the announcement this week that we intend to acquire ZeniMax, an amazing studios there. Takes our overall first-party studio organization to 23 creative studios. Just a real big investment in content. And really, for us, Xbox Game Pass is the flywheel that we're feeding there. We have over 15 million subscribers now for Game Pass, and it continues to grow across console, PC, and now with streaming to phones. And we want to make sure that subscribers to Game Pass feel like they have a consistent set of games to go play. In terms of where games will show up, our commitment is that our games will show up in Game Pass and on PC and on console and be available in xCloud. In terms of other platforms, I think we'll take it on a case-by-case basis. But as the Xbox community, what they should feel is this is a huge investment in the experiences that they're going to have in the Xbox ecosystem. And we want the Xbox ecosystem to be absolutely the best place to play. And we think game availability is absolutely part of that.
All right, Phil Spencer, Microsoft Executive Vice President of Gaming. Thanks so much. Appreciate it.
Thank you.
And let's turn to a different side of tech right now and social media. Apparently, the Facebook Oversight Board, this is something that has been talked about, an independent oversight board, is going to be in place before the U.S. election. Melody, this is something that the company's talked about for quite some time that folks have been calling for. Ahead of the U.S. election, is it going to be in time to sort of stop some of the disinformation out there better than they're doing now?
I think you already know my answer, Julie. TLDR, no. And if it seems like a surprise that things are happening piecemeal. That's intentional, right, from Facebook's part, because they want this burst of positive press. Of course, a lot of the recent slew of announcements have been coming out through reporting from the Financial Times. It was just 2 days ago. We were talking about Nick Clegg, a VP of Global Affairs at Facebook, who did an interview specifically saying that they would be putting extra measures and be cautious about the election results and would be monitoring heavily a lot of that communication. So when it comes to this news about the oversight board, we don't really know exactly what the responsibilities and rights will entail. We know Zuckerberg still has a lot of control, voting rights within Facebook. So even in previous shareholder events, there have been things on the docket that have been brought up by average investors, and it was immediately shut down because Mark Zuckerberg ultimately has a lot of control there. So as much as we can say this is an independent committee, I just have to say it's a cautionary sort of tale saying not only is it too little too late, I think the entire ecosystem or infrastructure of that board, ultimately they'll be reporting to Zuckerberg to a certain extent, unless it's mandated in a regulatory manner from the federal government otherwise. So just taking everything with a grain of salt here.
Always good to do. Thanks so much, Mel. Appreciate it. Well, coming up next, looking lovely even amidst the pandemic, even if you're stuck at home, we're going to be speaking with the founder of Too Faced, the makeup brand. We'll be right back.
News on the move, a suspect taken into custody after allegedly shooting 2 police officers in Louisville, Kentucky, has been charged with wanton endangerment and assault of a police officer. Both officers are in stable condition at a local hospital. They were shot during protests that followed yesterday's announcement that a grand jury failed to indict any police officers involved in the shooting death of Breonna Taylor, although one officer was indicted on a charge of wanton endangerment. The officers shot last night were not among the officers involved in the raid on Taylor's apartment.
Eric Trump must submit to a deposition by the New York State Attorney General's office by October 7th. A state judge yesterday denied the president's son's request to delay that interview until after the election. The deposition, part of Attorney General Letitia James's investigation into whether the Trump organization improperly inflated the value of certain assets.
New York City's Times Square will be empty New Year's Eve, and the annual ball drop will be a digital event with limited live entertainment. City officials announced those changes yesterday. It will be the first time in 114 years that no crowd has gathered to ring in the new year. Organizers of the annual event issued a statement saying, quote, "We will miss everyone this year, but we will bring our celebration to you, whether you want to turn off and turn away from the bad news of 2020 or turn to the new year with a sense of hope, renewal, and resolution. You'll be able to join us virtually like never before."
Not sure if this next story will bring you hope and resolution. Maybe it would be more newsworthy if something was not getting pumpkin spiced. The latest victim, Kraft mac and cheese. Kraft Heinz is only making that product available in Canada to 1,000 people. There's a waiting list for the box of dry noodles with pumpkin spice flavored powder, classic cheese powder, and cinnamon to sprinkle on top. But lucky recipients do also get a coffee mug. All right, turning away from the world of food to the world of makeup now. As we've seen a lot of people stuck at home, are they still focused on making themselves look their best for Zoom calls, for example? Jared Blandino is joining us now. He is the co-founder and chief creative officer of Too Faced, which is now an Estee Lauder brand, but he started that after working at the Estee Lauder counter, actually. Jared, thanks so much for joining us. I know you have the brand has a big, and you have a big social media presence. What are you hearing from your customers and people you're engaging with since the beginning of the pandemic as to how interested they are in sprucing themselves up right now? I mean, a lot of people maybe aren't wearing makeup when they're at home.
You know, I think for a moment we all kind of took a pause and we're like, hey, we don't have to straighten our hair or put on a full face. But very quickly, I think we all missed it, because I think there's a beautiful pageantry about getting dolled up every morning. You know, you get to choose your outfit, get to choose your lip color, get to put on your mascara, and kind of reinvent yourself for that day to express yourself from the inside on the outside. And I think very, very quickly we all missed it. So it's really evolved into a kind of more personal kind of interpretation of where we are. So we'll see on some of my Zoom calls with my team, they're all wearing red lip. I noticed that they're all wearing like this bold red lip. And I said, what, you guys, did you all get together? Did you call each other? Where's my lip? You know? And they were like, no, we want to feel that power. We want to feel that, you know, glamour again. But also when you're on a Zoom call, there are very, you know, few features that pop. So your lashes, your lips, some highlighter, it makes you look ready for the day.
Jared, you might have a captive audience here because we have to be on camera for a living, I suppose. But it's interesting, you know, Estee Lauder, your parent company, they had been notoriously known for the lipstick index, right? To your point, in previous financial crises, especially the financial recession in 2008, there was this uptick in trying to feel beautiful in small ways. But now, actually, the executives are saying it's the skincare index, that people are much more concerned, especially because they don't need to go outside as much. Is that an existential threat to Too Faced as people are trying to do not only the more natural look, but also make sure that the underneath part is well taken care of?
Absolutely not. In fact, it's a really exciting thing. We've always integrated a lot of skincare ingredients into our makeup. In fact, our best-selling Born This Way foundation, I kind of based it on some serums that I loved and used. The fact that coconut water, I learned, is one of the closest things to blood plasma on the planet, so your body accepts it. So we've been doing that for a very long time. And I just think it's more about self-love and self-care. And when we're, you know, looking in the mirror, getting ready for the day or getting ready for bed, we want our skin to look the best. We want to feel healthy on the outside. So we feel healthy on the inside, because during this time, it's been very emotional. It's been very difficult, and it's not ending. You know, I think we all have this hope. A couple months we'll be out, you know. So it's kind of become our reality, and we're going to take care of ourselves. We're going to eat better. Hopefully, we're going to take care of our skin. And we're going to, you know, look for the positivity in life and look for the positivity in one another. Because I think unless we do that, just what are we doing here, right?
So, Jared, I was glad to hear you use the word glamour, because someone who's more comfortable in a suit, who likes to see people who get, quote, dolled up. In the evolution that our society is going through right now, is there a negative impact on companies like yours and on the Estee Lauders of the world, if women start rejecting the things that used to be considered, quote, glamour?
No, I think that the cool thing about the world is that in fashion and beauty is we're always evolving. So we're always redefining what it means to be glamorous, what it means to be trendy or whatever. And I think a brand like ours, we're at the forefront of that. We have to create trends. We don't follow them. So no, I just think it's really exciting and really beautiful that, it's almost evolving faster now because we're all on social media more. We're connecting with each other through our computers more. And no, I just think it's actually really exciting, and I'm kind of energized by it.
Jared, I want to ask, as far as sales go for makeup during the pandemic, right? I mean, I'm sure initially it just kind of, fell apart because, we were all in sweatpants. But it seems, as you were saying, a lot of people kind of miss the idea of being able to dress up and look their best. Do you see more people now talking about that and trying to put makeup on or trying to get themselves looking their best as far as when they get on Zoom calls or different types of meetings along those lines? Is it more coming back?
Yeah, I definitely think it is. I've seen it in my own life. I've seen it in my own meetings. I've seen it with my own friends and employees. Everyone's putting a little more effort in. And I just think we miss the pageantry of life. There was something so beautiful about fashion and about beauty and about just art and culture. And I think that we're having to work a little harder to make that happen. But I think that we're all feeling like we love it and we miss it. And it's a part of who we are on the inside. It's expressing yourself. You know what I mean? And Lululemon and t-shirts worked for a while. We felt good in it, right? But now it's time to put on your Yves Saint Laurent jacket and pull it together and straighten your hair and feel good for that moment. And there's nothing wrong with the next day putting your hair in a ponytail and leaving your pajamas on. But it really is just kind of feeling and expressing yourself how you feel in that moment and not forgetting to enjoy the fact that beauty is fun and fashion is fun. And we're all just here to just lift one another up and inspire one another to feel our best and to have a good time.
Jared, that's a beautiful sentiment. I mean, I have a leadership question. As we alluded to, Estee Lauder acquired Too Faced for about $1.45 billion about 4 years ago. When you think about how you've been able to maintain a very good role within the organization, what are some lessons to be learned as other startups try to get acquired? Because we know, Joe Malone, Bobbi Brown, they have left Estee Lauder after selling the company. How do you think about the way you can let go of your baby, but also stay part of the ecosystem?
Well, kind of my secret to that is you don't let go of your baby. You stay independent minded. You use the assets you have at hand, but you just continue on the path as you always have been. I say I want wings, not weights. So where they can give me wings, I'm totally about it. Where there's weights, I'm like, let's cut them all off. I feel like we all have individual companies and we built our brands in very unique ways. My last job was at the mall, okay? So I did not grow up in corporate culture. So truth be told, I don't really fit very well into corporate culture. Luckily for me, Leonard Lauder is this amazing artistic man who just gets it. And there are some other great executives within the organization who understand that I'm not a typical, corporate founder. I don't know what you would call that. But I've become even more focused on my artistic integrity, on my individuality, and on the heartbeat of our brand. Because for me, there is, like you said, maybe this feeling that you can let go a little bit or take your foot off the gas a little bit or go take an extra vacation or something. I've done the opposite. Jeremy and I founded this company. He's my husband. We've been together 25 years this year. And we're even more passionate about keeping that love and that heartbeat and that feeling going because it's more than makeup, guys. It's a movement. It really is about instilling self-esteem into these girls and guys now and really hoping to inspire people to feel their best. So they look at themselves in the mirror and they feel good. So hopefully they do better. They expect better. They're kinder. They're stronger, whatever that is. But it's my hope that through our brand, you feel the most yourself and then go out there and get the life you deserve or do your absolute best, meet your potential.
Jared Blandino, not just selling makeup for sure. Thank you so much and happy anniversary, by the way.
Thank you.
Co-founder and chief creative officer. Appreciate your time.
Thanks, guys.
Be well. All right, we'll be right back. It's time for Word on the Street, where we check in with our panelists, find out what stories they are watching. The Coalition for App Fairness. It's a new organization trying to challenge Apple's App Store fees. Dan Howley, you've been watching this through the fight that we've been seeing between Epic Games and Apple, and now they have some partners.
Yeah, they're kind of gearing up to really do kind of a full court press in Washington against Apple specifically, but also Google. This is interesting just because they really do hammer Apple in their site. They list how much money Apple has made from the App Store. And it really is coming down to, I think, the idea that Apple operates as a walled garden, whereas Google, you can get a third-party App Store downloaded and then download apps through that. That's something that Epic is now doing since Google banned Fortnite from their App Store, as well as from Apple's App Store. But this is, again, kind of smelling blood in the water. They know that the FTC is looking at Apple. They know that the FTC is looking at Google. The DOJ is looking at both. The House Judiciary Committee is looking at both. States Attorneys General are looking at both. So they really are kind of making sure that this message stays out there, that they're unhappy with the 30% commissions. On the flip side, they also, Apple will point out, and Google, I'm sure as well, that they provide access to all of these users and the technologies behind them. So it, I think, will come down to kind of almost semantics at some point, as which is offering more and which is getting more out of it. But certainly getting access to Apple's customers, which tend to spend more on apps, is nothing to sneeze at.
Yes, indeed not. Melody, you're looking at coronavirus fraud, which apparently has been pretty sizable.
Yeah, normally it's tax season we have to worry about, right, Julie, especially when it comes to elderly folks who are easy targets for scams here. But Americans have actually lost more than $145 million to fraud-related charges in the coronavirus pandemic. That's according to the Federal Trade Commission. The FTC received around 206,000 complaints from consumers between January 1st through September 22nd. Of course, the average loss was about $300, which during this period of time where so many folks have been laid off, lost their jobs, furloughed, that's a significant chunk of change, right? But the real number of fraud is likely significantly higher than federal figures are reporting, of course, because they don't reflect those scams that have been unreported by customers. We can anticipate there being a continued flurry of these, although the spike did happen earlier in the spring season.
All right, be careful out there, folks. Those are some alarming numbers. Melody, Dan, thank you so much. Adam, thanks as always. As we leave, we want to let you know that the Dow is up about 0.5% right now. The NASDAQ is gaining 0.8%. The S&P up 0.6%. Keep it right here on Yahoo Finance.
Welcome into live market coverage here on the ticker. Right now, stocks up across the board here and gaining some steam in today's afternoon session. Right now, the NASDAQ trading near session highs up by about 1%. The Dow up by about 0.2%. The S&P somewhere in the middle there, up by about 0.75%. And a few stocks of note to notice here as we continue to see what's going to happen today. We've been dealing with some choppy trading days as of late. The S&P 500 earlier today erased its gains for the year and looked like it was nearing correction territory. Still technically close to that, only about 40 points away should things turn back into the red, but gains holding for right now. Want to highlight some individual names we're seeing move here today as well as earnings continue to trickle in here. Darden Restaurants, one worth highlighting here, as shares were up more than 6% a bit ago after the parent company of Olive Garden beat earnings expectations for its fiscal first quarter. Darden generated 28 cents in adjusted earnings per share. That came in well above analyst expectations. The company also reinstated its dividend, which is important here as more stocks continue to slash those in the pandemic. Also want to highlight the action we're seeing play out for the major airlines today. All of those under pressure as COVID-19 cases remain in focus. And yesterday we got the update from Indiana's governor announcing a stage 5 reopening that would include bars allowed back at full capacity as well as nightclubs. We have not seen very many states at all try and move that far into reopening. Even Florida has bars capped at about 50% of capacity. Layoffs also looming for the airlines too, as federal support for that industry rolls off at the end of the month. We've seen billions of dollars in loans and support coming from the federal government to support airlines here as passenger traffic remains about 70% lower than what we saw last year around this time in 2019. All of those stocks under pressure in today's session. But first, want to start the show with highlighting the update we got from the Department of Labor looking at unemployment claims ticking higher slightly than what we saw last week. And I want to get to Yahoo Finance's Emily McCormick for more on those numbers. And Emily, I mean, we're still holding steady here above the highest weekly unemployment claims totals we saw even back in the Great Recession.
That's right, Zach. Just taking a look at the numbers we got from the Labor Department this morning, another 870,000 Americans filing for first-time unemployment benefits last week. That was an unexpected increase over the previous week when we had 866,000 new jobless claims. Consensus expectations had been looking for 840,000 for this week, so a step above that expected level. Now, taking a look at continuing claims for the week ended September 12th, those reported on a one-week lag. Those came in at 12.58 million, also above the 12.3 million that had been expected, but a bit of an improvement from the 12.75 million we saw during the previous week. Now, turning back to those new jobless claims at 870,000, today's figure was the fourth straight week now that we've seen new jobless claims come in below that psychologically important level of 1 million, but still, of course, holding high on a historical basis. Now, of course, we are down from that pandemic era high of nearly 7 million new weekly claims that we saw in late March, but really holding above that 800,000 level, really is showing some stagnation in terms of the pace of recovery now. And taking a look by state here, we had unadjusted new jobless claims in California, where we've seen joblessness due to the pandemic now being compounded with labor market stress due to wildfires, again at the highest in the country at more than 230,000. That was an increase of about 4,400 week on week. And then taking a look at other states, we had Georgia, New York, New Jersey, and Massachusetts, each reporting significant increases in new claims last week relative to the rest of the country. Now, most states did report an at least modest increase in new claims week over week. So another bit of discouraging sign there from the labor market. Now, finally, the last thing I want to point out here from this report was we did see the number of individuals claiming benefits in all programs for the week ended September 5th. That's the latest data that we have actually on this metric, coming down slightly following 3 straight weeks of increases. That now totaled 26 million, down from the near 29.8 8 million that we saw reported during the previous week. So that was the one upshot that I really saw here in today's report. Again, continuing claims also trending lower, but taking a look at those new jobless claims really holding at quite an elevated level. Zach?
Yeah, and Emily, I mean, when we back up and look at a state-by-state basis too, when you compare all these weeks and you put them all together, it's worth highlighting the Department of Labor breaks out states' insured unemployment rates, looking at the ratio of people on unemployment benefits versus the labor forces in those regions. And still, we are still seeing Hawaii lead the nation with the highest insured unemployment rate in the country. And that's been the case for basically since the pandemic hit. Nearly 20% the rate there in that state. California still remains at number 2 on that list, followed by Nevada. Nevada, of course, one of those hard-hit states when we think about tourism and how important that is to that state's economy. The numbers kind of match up with what we got last week in terms of the BLS breaking out their more traditional measurement of unemployment as well. When we think about the ratio of unemployed workers to the size of the labor force, Nevada notching the highest unemployment rate by that metric at 13.2%. So one of those economies that we're still seeing hard hit here. But always interesting to look at all that and the way that this recovery has hit some of those states differently in this and how the recoveries are pacing at very different speeds. But Emily McCormick, I appreciate you bringing us that update. Meantime, I want to stick with the idea of this recovery maybe losing some steam as we brace for what the next jobs report for the month of September might look like. We got an interesting update from the Census Bureau, the household pulse survey coming in there, showing that employment jobs gained 1.6 million. That was the headline number, but it kind of hides what's happening in terms of hiring at larger corporations versus some smaller businesses. And for more on that, as well as more on how this recovery is shaping up in the final months of 2020, we're joined by Thomas Phillipson, former chair of Council of Economic Advisors under President Trump. And Mr. Phillipson, appreciate you taking the time to chat. I guess first, just your reaction to those numbers that we're seeing here on unemployment claims still staying stubbornly high above 800,000. What's your take on where we're at now?
Well, we're doing a lot better than expectations were back in the, April, May, where people were a lot more pessimistic about the labor market. So the way I want to think about that, having partly been part of setting up the great labor market before COVID, is that you can think of it as the economy basically surviving COVID because it didn't have any pre-existing conditions in some sense. And I think what's going on right now is that there's a very sort of repeated pattern here from many other infectious diseases, which is true for COVID, which is kind of like a deja vu experience when you look at previous history of other infectious diseases. You will see these cycles, which is pronounced both in the US and other countries as well, and also across states in the US, partly being responsible for these state numbers as well. But what happens is that basically when the prevalence of the disease goes up, prevention goes up, and that knocks down the future of the disease, and people become comfortable, and then prevention slacks off, and then back comes the disease. That's very typical for infectious diseases. And when economic, market behavior is tied to prevention, which it is for COVID, obviously, you will see sort of differential sector effects across the economy, depending on how dependent the sector is on prevention against COVID. So if you look at cars and homes, et cetera, it's not only interest rates that are driving them to basically boom right now. It is also that they're sort of safer industries relative to group consumption industries, I call them, where you have to actually consume stuff in groups like entertainment, travel, restaurants, etc.
Yeah.
And the Hawaii numbers you talked about, the Nevada numbers, are you sort of reflecting that those industries are much more sensitive to these prevention cycles going on. So I think that's kind of what's holding back in it, but it's not necessarily surprising, I would say, that we see these cycles going on until we get a vaccine.
Well, I guess the concerns here, too, would be the slowing of the recovery, too. And as you highlight, I mean, we are a service-based economy here, and a lot of those hard-hit sectors, you talk about hospitality, entertainment, still are dealing with the concerns and the overhang of an uptick in cases that we're kind of seeing start playing out right now, potentially could be that second wave that has been feared. But when you look at that, I mean, just in this household pulse survey, I mean, we saw jobs being added by large corporations and government agencies, but small businesses posted a loss of about 500,000 jobs, which would seem to support calls that we're hearing on both sides, praising the Paycheck Protection Program and benefits and stimulus here for small businesses. If you look at the survey for September, the jobs report there, economists are expecting 900,000 jobs, which would be the third straight monthly decline we've seen in that headline number. So what does that maybe say about the call for more stimulus here and why more might need to be done to continue to support some of those hard-hit sectors we're talking about?
Yeah, I mean, there's a couple of lessons I think that we learned from CARES, the first stimulus effort, that I think the proposals on the table currently has not learned in some sense. And one has to do with liquidity and one has to do with incentives. Obviously, CARES was very useful for liquidity, but I'll come back that it could have been a lot more useful for those really hurting. I think it was too broad. But in terms of incentives, I think, everyone understands that labor market supply has been affected adversely here. But, the discussions on the table is to reduce it from 6 to 300 flat fee on top of it. That's still going to have a majority of the labor force facing an implicit tax rate of 100%, meaning you earn less if you work than if you don't work. And some economists even have said that doesn't matter, which I think is it's just a sort of fantasy world. It does matter. Otherwise, you could start a company and hire people by, having them pay you as opposed to you paying them. And no one thinks that's feasible. And I think, once you tax earnings more than 100%, you're going to slow down labor supply. In fact, the CARES Act basically had 20 times the load on the Obama flat fee, which was about $25. So inflation adjusted is about 20 times. And we were very concerned about a slowdown from that $25 back then.
Yeah,
Some people have argued that it's not labor supply, that it's actually labor demand, but I think that's misguided because wages are going up. So whenever you have quantity and price going up in a market, in this case, employment and wages, you would think that demand must be responsible for that. It's even more indicative of that because there's a composition effect that we're pulling in low-wage workers into the economy. So that should drag down wage growth. But we've seen wage growth despite that composition effect, which I think is important. Also, we see in JOLTS that there's a lot, jobs openings are sort of at the level of December 2019 right now. So I think the incentive story is an important story that hasn't been learned in what the discussions have to offer right now.
Yeah, I mean, I think it's a complicated discussion to have too, because obviously we're dealing right now with even the economy. You look at the unemployment rate, all kinds of metrics with businesses reopening. We're at a very different stage than we were back in March and April. And on the discussion of the additional benefits here, I think that's another thing that economists still are trying to figure out in terms of what it looks like when people got that and whether or not they thought it was going to be a temporary addition and whether or not they would still prefer to have a job that's much more dependable when we think about money coming in. But I think that is one of the questions that becomes so important here when we think about where we go from here and what the next round of stimulus might look like, because you have people disagreeing on the underlying problem at hand, which is still the pandemic. We're seeing cases rise in some states. There are concerns that other people out there are seeing what's happening in the UK and Israel with return to lockdown, that could happen here. We heard from your former compatriot here in Larry Kudlow talking about how he would not support any more shutdowns to deal with that here in the US. But I mean, when we think about that being a possibility and the idea that Republicans and Democrats would not pass stimulus here as we get closer to the election, does that not concern you that we might deal with another shutdown without the support we saw in CARES?
So a couple of comments. If you look at the CARES Act, and this is what I think it missed helping those in need the most, which is really what we care about in terms of liquidity. What happened with the CARES Act was that the personal disposable income, which is government transfers plus your private income, went up 45% in Q2. That's, in a boom and an expansion, we're lucky to have a 10% annualized growth in a quarter. And personal income, disposable income went up 4 times of a good boom in one of the greatest recessions we've seen since the Depression. So that's telling you something, that this was not a focused effort enough to help
I mean,
those truly.
I think you made your point there too, and we talked about that being potentially, you know, in those months we saw that, but this rolled off since the end of July, so we are now back to where we were, with a few states still paying out $300 in, you know, half of what they had under CARES. But I think one of the questions too on all this would be, you know, what we're seeing play out in the politics of this too, because it's clear that a lot of people don't necessarily agree on where the pandemic is headed, what measures should be put in place as we see Indiana moving forward with a full reopening. And one of the questions that I have for you, since you work for President Trump, looking at this from an economic lens, as we get closer to the election, there's still a lot of fears about what could happen in terms of this transition of power. And we heard from him talking about not committing to a peaceful transition of power should he lose re-election here. A lot of people are saying that's not great when you think about how much investors have to grapple with around volatility we already had in 2020. And what that could say about it here. I understand the idea that you don't want to give in to the idea you could lose re-election, and you don't want to talk about that maybe, but what does it say about adding volatility now, and why the president might not agree to that?
No, I won't comment on any things that's outside of economics. But what I can say is that you usually get a dampening of basically investment around elections, because you basically have, you know, investment uncertainty, or investment is very driven by uncertainty, or held back by uncertainty. In many elections, you don't know where it's going to go. What's unusual about this election for affecting investment and therefore labor demand is that there's such extreme position. Usually in an election, competition by parties for the same voters tend to make the parties look the same. Sometimes in the past, it was hard to tell what the Republican platform and how it differed from their Democratic one. But this election is such a stark difference in the platform that I think the uncertainty is even larger. And I think that actually is bearing down on some of what we're seeing on companies not wanting to make decisions until, you know, 45 days from now, or after November 4th.
Yeah, we'll see how it all pans out, but clearly a lot still up in the air for the time being. Appreciate you coming on to chat all that. Thomas Phillipson, former chair of Council Economic Advisors under President Trump. Thanks again.
Thank you.
All right, we're going to take a quick break here. On the other side, digging into the latest Fed thinking here as we continue to hear from Fed Chair Jerome Powell on day 3 of congressional testimony. He's not the only person at the Fed weighing in on this recovery. We'll chat that on the other side. Stay with us. Welcome back to the ticker. We're continuing to see stocks move higher here in the afternoon trade. The Dow now up by about 1%, trading at new session highs. We'll bring you those updates as we get them. But meantime, for the third consecutive day, we're hearing from Fed Chair Jerome Powell reiterating here that more needs to be done in this recovery. And it's not just him. Yahoo Finance's Brian Chung just caught up with the Federal Reserve's president and CEO of the Bank of Boston here. And I want to bring him on for more on that conversation. And Brian, I mean, we continue to hear the idea that more needs to be done here, not just from Chair Powell.
Well, Zach, as you mentioned, I had the chance to chat virtually, of course, this morning with Boston Fed President Eric Rosengren, who talked to me a little bit about the balance between monetary and fiscal policy during this time. Rosengren saying really that the Main Street lending program, which is supposed to target those small and medium-sized businesses, might not be the best fit for the current needs of small businesses. Here's what he had to say this morning.
I don't think the Main Street program is particularly well designed for really small businesses. I think the PPP program is much better designed, and I don't think we should let fiscal policy off the hook just because they're having a political roadblock.
Fiscal policy off the hook just because they're having a political roadblock. I can tell you for a fact, Zach, that that's about as aggressive as you'll hear from a Federal Reserve policy official regarding what should be done in these times. Now, the Federal Reserve, for its part, has tried to distance itself from fiscal policymakers, but the urgency is very clear right now that with monetary policy already backed up to near zero rates and a bunch of liquidity facilities, it's really on things like the Paycheck Protection Program, maybe more stimulus checks, help to local and state governments that really needs to be done. And that's on the congressional side of things down in DC.
Yeah, and again, we continue to hear everyone at the Fed really pushing for Congress to do more here. As to be fair, they've tapped a lot of what they've done, and they're already turning on their own Main Street lending program here, saying that it might not be the best avenue. But Brian Chung, appreciate you bringing us that update. Let's continue this conversation, though, because there are a lot of questions about what more needs to be done here as we approach the end of 2020. More months of lost $600 at the federal level for unemployment benefits. And here for more on that, joining us is Maddie Doppler, National Taxpayers Union Senior Fellow. And Maddie, it's good to be chatting with you again. I guess just to continue that conversation here on the idea that more needs to be done. In his third day of testimony, we just heard from Fed Chair Jerome Powell talking about how households might be starting to see some risks here, or at least down the road. When we think about maybe defaults and paying mortgages and questions around that, the longer we get further into this recovery without additional stimulus measures. So what's your take on how some of those fears might be looming?
Well, Zach, I've been arguing for a while now that September is a very tricky month for policymakers. Now, over the summer, there is no doubt that we've seen more resiliency in the economy than was expected. Fed Chair Jay Powell admitted that in his testimony this week, that the summer months certainly were better economically than expected, but not necessarily better from a public health standpoint. And remember, that's the whole reason we are in the economic circumstances we're facing today. It's because we're in the middle of a global pandemic. And some people seem to have forgotten this. You had Stephen Moore, an unofficial advisor to the president this week, say the quiet part out loud that maybe fiscal stimulus isn't needed because it wouldn't go into effect until past the election. The politics of the moment are quite different than the reality that most Americans are facing. You heard Brian Chung talk about with the Boston Fed chair about the Paycheck Protection Program. The problem with the PPP is the SBA authority ran out to continue lending under that program. It needs Congress to re-up that authorization. So there's a lot of pressure right now. We've heard from the Federal Reserve talking about what it's been able to do on monetary policy, but the comments coming from Fed officials really are extraordinary, talking about how they're almost at the end of their toolbox and Congress needs to step in here. Things like continuing PPP lending authority, but other elements as well. You know, the CARES Act increased support for airlines, that runs out at the end of the month. So those airline payrolls are certainly going to be under pressure. And then, of course, those extended unemployment benefits. There's a lot of debate about where those should be, considering that the economy has recovered somewhat, but certainly we are not out of the hole yet. And as we wade into these winter months, the public health circumstances could get worse, making the economic circumstances that much more dire.
Yeah, not just over the next couple months, but too, I mean, when you look into next year and GDP forecasts, Wells Fargo is out with a new report looking at two scenarios here in whether we do see a return to some of those unemployment benefits or if they roll off entirely and what that could mean for growth moving forward. I mean, there is a case to be made maybe that the CARES Act and the support here on unemployment benefits maybe did go beyond some people's wages when you think about that. But I mean, it was only for a few months, and now those benefits rolled off since the end of July. So I mean, when you think about weighing what could happen here in the back half of 2020 and the pain you're talking about for those who have lost their jobs, I mean, does it seem like it's you're talking about hundreds of dollars a week? I mean, it doesn't seem to me to be that large in the grand scheme of things.
Yeah. Yeah, Zach, I agree with you entirely. I mean, the conversation at the beginning of the spring when we're talking about paying a server who's out of a job a couple $100 extra a week seems tone deaf to me. And particularly now, certainly we should be being careful given the amount of debt that the federal government is continuing to run up about what our fiscal policy is. I'm not arguing that we shouldn't continue to make decisions based on prudent policymaking. But the argument that, that is what should stall the entire conversation on Capitol Hill, I think is really depressing to say the least, given that political leaders actually aren't that far apart. Republicans and Democrats have been talking about extending UI in some shape or form. That's why the president came out with an executive order that does do that, even though the mechanics of that are very difficult. Some form of state aid to state and local governments, both Republicans and Democrats have talked about how that's important. Of course, the top line number is what the sticking point is, which I think is a little bit of a red herring for actually getting to the negotiation and agreeing to something. And then, of course, what you do for businesses. I mean, a number of small business closures as we move through the next couple of months, that's the critical data here that I think people should keep their eye on. Because if those businesses close, those workers don't get their jobs back. Right now, we're still at a point where a lot of workers who are on temporary furlough think they're going back to work. If that starts to change, that's where we really start to see permanent scarring on the economy. And that becomes a lot harder to recover from, no matter what happens in November, no matter what the political makeup here is in Washington, D.C.
Yeah, and when you think about the unemployment rate and where the Fed sees that coming in at year end, I mean, we saw that come down. We've just been pacing ahead of a lot of expectations in this recovery over the last few months, even after we saw the roll off of these benefits that we're talking about. But when you think about what the expectations are for this upcoming jobs report, the September jobs report, it could be the third straight month, if you believe the surveys right now, third straight month that we've seen that headline number come down, which would seem to support the idea that the steam is coming out of this recovery. And 7% unemployment at the end of this year and next year seems rather high compared to where we were before this pandemic hit. So when you piece all those things together, I mean, the expectations for a slower and longer drawn out recovery does not seem to be one that either party would stand to support, regardless of who comes into power in November.
Yeah, Zach, you really have got to keep a careful eye on this employment data because, each side is using it to craft a narrative that may or may not be the case. But I think the things that your viewers need to focus on, there's three things here. One is that permanent job loss number, that monthly data that we get that we're going to get next Friday. That'll tell us how many people are moving from temporary unemployment, people who are furloughed or thinking they're going back to their job, to permanent unemployment. That number has continued to rise over the summer. I'm really worried about that number continuing to go up. But secondly, this whole idea that wages are rising. Wages are rising because we had to lay off the least paid workers the most when the crisis started. So that means as people can start to come back online, they're starting to get more hours, they're starting to get paid more, but that doesn't mean we're back where we were in January. And lastly, just looking at the labor landscape overall, yes, job openings and labor turnover looks pretty good, but it does not look as good as we looked in February. I don't think we're going to get back to where we were at the beginning of the year, but what we need is support to bridge that gap to make sure we're closing all of the uncertainty loops that in particular small businesses are facing right now that they don't have PPP, now that some states have a really uneven experience with coronavirus infection rates, and now that we're looking at political uncertainty as we wait into November. I think having some kind of act of Congress that gives a little more certainty to the employers in this country could go a really long way.
Yeah, still a long way to go in all this. And still, obviously, the underlying problem here at hand, as you noted, the pandemic, a lot of questions about where we're headed on that front. We'll see how cases play out here in the end of 2020. But Maddie Doepler, National Taxpayers Union Senior Fellow, appreciate you coming back on.
Thanks, Zach.
All right, we're going to take another break here on the ticker, but when we return, digging into the potential $9 billion boost to the U.S. cannabis legal market here as more states weigh legalizing on the ballot this November. We'll chat that right after this. Stay with us. Welcome back to the ticker. Cannabis enthusiasts will have to wait a little bit more here to see discussions about legalizing at the federal level take place in the House. A vote was originally scheduled for the MORE Act, which would move to legalize cannabis at the federal level, as well as expunge some criminal records for people tied to cannabis offenses. It's mostly a symbolic vote, though, as the Senate remains Republican controlled. Not a lot of expectations for that to move past Senate Majority Leader Mitch McConnell. But states themselves have quite a bit of power here to grow the U.S. legal cannabis market. 5 states in particular will let voters decide on that this November. And one firm watching this play out says that it could add a total of $9 billion to the U.S. cannabis market. And here to chat that with us is New Frontier Data's Chief Knowledge Officer, the man behind the report, John Kagia, joins us now. And John, it's good to be chatting with you again. I mean, $9 billion is a lot of money to boost here to the market size of cannabis here in the U.S. Talk to me about what you're expecting should these ballot measures get voter approval.
So I think there's a couple of reasons why we think this is going to be such a consequential year for cannabis in the U.S. One, the fact that we have 5 states on the ballot, 6 initiatives that are going to be voted on this November, makes this a pretty milestone year in terms of voters getting a voice in the status of cannabis in our society. And there's a couple of states which we're paying particularly close attention to. We think Arizona's adult use initiative is particularly important. Arizona tried 4 years ago to legalize adult use. The vote lost by 2%, by 2 percentage points. And so this is going to be a return to the ballot. And with the demographic changes that we've seen in the state, the polls are actually looking better for legalization this year. Second is New Jersey. New Jersey is going to be a phenomenally consequential market for the East Coast. If you think about the proximity of the state to New York, Pennsylvania, Maryland, and other mid-Atlantic states, we think in and of itself, New Jersey is going to be a huge market. But once you add in that regional element to it, the state could be earning nearly $2 billion, $1.8 billion by 2025. So a huge market and a huge marker for the East Coast. And then a third state that I think is interesting to watch, because we've never seen this happen before, is South Dakota, which is the first state that we have seen that is putting on the ballot both a medical and an adult use legalization initiative at the same time. And what that tells us is, while we have historically seen pretty long lags between the presentation of a medical measure and then that state transitioning to adult use, South Dakota is the first state which is trying to do both of those at once. And I think it just reflects this kind of growing momentum, social acceptance, and public shift in attitudes that we're seeing around this issue.
It's also a red state, and a pretty confidently put red state. I mean, we've seen that state go red. You can go back a long time. Decades we're talking here in terms of how red South Dakota is. But I mean, talk to me about maybe how that represents the shift here in cannabis as well, because in this pandemic, we've heard from a number of analysts talking about how states are desperate to make up lost revenue, and how cannabis in a lot of these states would represent a pretty big opportunity here to bring that in. I mean, how much does that pressure, along with a lot of the criminal justice reform aspects we've been discussing here in 2020. When you put those two things together, talk to me about the momentum that you've seen play out over the last couple of years on that front.
That's a great question. And I think a really important part in understanding why we're seeing these dramatic shifts. So historically, cannabis has been viewed as a largely liberal issue. So you saw legalization happen first in the Western states, which have historically been blue, and then in the Northeast, which is also a historically blue region. But what's notable about this election cycle is we're starting to see, or we're continuing to see this momentum building within traditionally, historically conservative states, whether that's Arizona, Mississippi, Montana, and South Dakota. And it's that convergence, the general public's acceptance now that medical cannabis is broadly perceived to have therapeutic value. I think that is largely settled in the American public opinion. About 90% of Americans believe medical cannabis has value. So this is much less of a left-right issue, but I think the science has affirmed support for it. Second is the growing public awareness of the inequities in cannabis prohibition. The ACLU recently updated its Cannabis in Black and White report, which shows the racial discrepancies in prohibition enforcement. And Black cannabis consumers, even though they consume at the same rates as white cannabis consumers, are still nearly 4 times more likely to be arrested for cannabis offenses, and in some states, nearly 10 times more likely. And as folks are looking at those numbers, it just, the inequity of that, those prosecutions, particularly given the national debate that we're having right now on policing, I think is ringing loudly or resonating loudly with a lot of people.
Sorry, go ahead.
The economics of cannabis. At a time when COVID has so acutely hurt state and local budgets, there's a lot more open consideration for things that might historically have been problematic. And so I think you're seeing much more receptivity to the idea of legalizing cannabis when you look at a state like Colorado, which in its first 6 years of legalization generated nearly $8 billion in sales.
It's very true. And I mean, it's evident in the way that we've seen President Trump shift his policies. You can remember what Jeff Sessions represented there. And even on the left, Joe Biden going from talking about marijuana as a gateway drug, quickly attacked by the left. And now Kamala Harris is his running mate, a sponsor of the MORE Act, which, as we opened with, would be one of those things that would expunge criminal records for cannabis offenses. Just shows you how far we've come. But exciting to watch. It might not just be the MORE Act here setting up 2021 to be a banner year for cannabis, but also what's happening on the state level. But John Kagia, New Frontier Data Chief Knowledge Officer, appreciate the chat. Be well.
Thank you.
We're going to take another break here on the ticker. When we return, digging into food costs rising for a lot of Americans, the percent increase to the average grocery bill. Maybe you've noticed it. We'll dig into that. Stay with us. Welcome back to the ticker. Since this pandemic has roiled the economy here in the US, we've noted a few things in the way that Americans have been changing their spending habits. And one of those has been a result of rising grocery costs as more Americans are eating at home. And we've seen production restraints here, specifically when it comes to meat, also playing a factor in all this. So let's dig a little bit more into that. Our next guest is the CEO and founder of Cook's Venture. Matthew Wadiak joins us now. The company is a next generation ag tech and food company committed to regenerative agriculture and supply chain transparency. And Matthew, I mean, we've been discussing this problem on the meat front. I mean, myself as a meat eater, I've noticed prices rising, but when you back up and look at the costs of all these things, C+R research surveyed, I think, more than 2,000 consumers and noted that 85%, a majority of American consumers, say that they've been spending more on groceries. The average weekly bill, $139. So talk to me about what you're seeing play out here as some of these things get more costly.
Yeah, well, that makes perfect sense. We've seen obviously, folks who are dining out decrease and people cooking at home increase. So it's only logical that folks would be spending more at the grocery store to get the equivalent amount of food. So those prices have increased, but the price of meat is also increasing, primarily due to the fact that cost of processing is increasing. Taking considerations around spacing folks out who are working in food manufacturing and fulfillment. Trucking is obviously increasing with scarcity of resources available on the market. And as we've seen, just the general variable costs associated with fulfilling to grocery demand and meat specifically increase, that's going to get passed on to some degree to consumers.
Yeah, I mean, whether you look at beef, poultry, eggs, water, pork, those are some of the largest increases reported in this report. I know you guys are focused a lot on poultry. You guys work on that a while here. Talk to me about some of the production side elements of this too, because you're a business, you see this, you have insight into how hard it is to work on that front. We've seen and we've covered the issues in some of these larger scale meat processing facilities having to deal with PPE problems as well as outbreaks in all this. I mean, how hard has it been to keep production up?
In our case, we haven't had the same kind of problems that some of the larger facilities have had nationally. And I think a big part of that is, we're part of a regional food system and we support regional food systems and quality jobs. So on our end, we've had very, very low, issues of absenteeism or problems with health. And I think that is also partially attributed to the fact that going into the pandemic, utilizing PPE aggressively from the start, doing a lot of the sort of like obvious stuff that we know today early on was very preventative. And it really does work in the kind of environments where we're focused on manufacturing. In the industry, obviously, we've seen widespread issues which have led to a lot of absentee issues and health issues across the board, which, of course, when you're short on staffing in a large, meat processing facility, that trickles down to the actual animals themselves that are on the ground. And if you can't process animals because you're short on labor, they're, stuck in barns and have to be euthanized. So that's been some of the issues with meat scarcity early on, is just, the fact that we've been euthanizing a lot of animals.
Well, it seems like that happened right when the pandemic hit, but in the weeks and months after we saw that first happen earlier in the spring, it seems like the industry itself got a better handle on it. But when you think about what Americans are bracing for prices potentially still rising in the latter half of 2020, but then also next year, a lot of them on the same survey reported eating less meat, seeking discounts, eating less poultry, avoiding organic items, and buying in bulk. So, when you look at it and think about maybe the industry adapting to some of those issues, what do you see in terms of maybe supply and demand coming back into equilibrium here starting next year? What should we expect?
I think some consumers are focused on those things, certainly, but we've also seen an inverse trend in e-commerce spend over the course of the last few months during coronavirus, and an influx in about 125% increase in e-commerce spending for meat, specifically for higher margin items. So there's a little bit of a disconnect in what folks are saying and kind of what consumer behavior is actually happening in the marketplace. And we have some data from the 2008 recession, and it showed that during times of recession, when people are focused more on staying at home, even during low income, the thing that people spend most on is actually food and alcohol. So high-end food and alcohol, which is a little counterintuitive, but I think some of those creature comforts come back to us in the home as we're sort of bracing for the next winter.
Filet mignon and Cab Sav, maybe sometimes you can't cut them out of the budget completely. Matthew Wadiak, appreciate you taking the time to join us. Appreciate it. Be well.
Thanks so much, Zach.
All right, we're going to take another break here on the ticker, but as we go to break, just want to highlight the moves we are seeing play out right now as the NASDAQ reaches a new session high in all 11 sectors, well, almost all 11. Healthcare still in the red right now, but we'll be chatting healthcare specifically, some new opportunities there right after the break. Stay with us. Welcome back to the ticker. Right now, nearly all 11 sectors in the S&P 500 are in the green right now, except for one of those 11, healthcare, barely at break even right now. And today I want to focus in on some opportunities in healthcare as the pandemic has made that a focus for investors. And one new startup here, I don't know if it's a startup, we'll get into that in a second, but one new company out there just raised $100 million here to focus in on the opportunity in that space. Within3, a software as a service company that enables clients to have secure discussions and inviting specific audiences here to focus on a lot of the issues that pharmaceutical companies are focusing in on right now, including COVID-19 vaccine trials. The company already works with 20 of the top pharmaceutical companies and has users in more than 150 countries. And joining us now to discuss that opportunity and the growth there at Within3 is the CEO of the company, Lance Hill, along with Yahoo Finance's Anjali Kamlani. And Lance, thanks for coming on here and congrats on the raise. I guess just to explain it in context of maybe one of the problems a lot of people are focused in on right now and how you guys solve in that problem. Talk to me about how maybe some of these pharma companies working on COVID-19 vaccines would use your platform to help get things done.
Sure, yeah. As you can imagine with COVID, it's just an unprecedented set of stakeholders, from physicians to policymakers to payers to scientists to economists, all working together all the time, trying to accelerate vaccines to market at a speed that is really unheard of in the industry. And that creates a very difficult communication challenge to coordinate all of those stakeholders, all that information, make decisions along the way. And what we do as a company is allow our clients to do all of that much, much more effectively and much faster. And even beyond the vaccine side of it, you know, another aspect of it that is not always obvious is, let's say you have a chronic illness or a condition. And now COVID has hit and it's affected your ability to get care, to receive treatments in the way that you're used to. So life science firms all around the world are having all sorts of discussions trying to figure out, in the reality of the new pandemic, how can they better serve patients? And our platform is being used very heavily around the world and for that as well. I think at this point we have over 80 different COVID-specific programs running on Within3 among our global client base.
Well, Lance, I know that one of the things that has become really prominent is the general public now being really aware of preprint servers and the information that comes from that. I'm sure that's a key part of what your company provides. But this is coming, at a really an unprecedented time when you talk about digital health services and the market interest in that. Do you feel like there's just a lot more attention on this solely because of COVID? And what's the long-term sort of, outlook for the company just based on that alone?
Sure. Yeah. No, it's a great question. So as a communications company, and a virtual communications company at that, COVID has certainly been an accelerant. For us, we were already growing year over year. We were up triple digits in Q1 before any travel restrictions from COVID ever hit. So our business was really accelerated off of really a fast moving target already. What COVID's done, and not just for life sciences, but I think for healthcare and maybe industries more broadly, is forced organizations to look at how can I adopt virtual means of collaborating and communicating, and really pull that forward. And the good news for our company and what we do is because the results are so good. We expect that even in a post-COVID world, whenever that may be, and hopefully sooner rather than later, we'll continue to see the acceleration that we've been seeing.
And on that front, I mean, you guys obviously raised $100 million here, Insight Partners leading the round, but that's much more than what you've raised in the last, from 2008 to 2012, you guys raised 20 million. So a huge step up here. What do you plan to use that money towards? Because I know that there are some big competitors out there. When we talk about compliance, even Google, HIPAA compliant in doing a lot of things that you guys do. So how do you plan to put those funds to use?
Yeah, it's really on innovation and scale. And that was really our goal in doing this round. Today our platform, what we're really doing is looking at specific processes inside of life sciences that are slow, cumbersome, redundant, and building tech to address those and make them much more efficient. And today we support over 60 different business processes in our clients around the world. We clearly see the next 60. And part of this funding is going to allow us to innovate, to go after more places that are kind of locked inside of life sciences, where there's just a lot of unnecessary delay and waste. So that's one part of it. The second part of it for us is we are a global company. And so while we're based in the US, our clients tend to be global, their operations tend to be global. And we have staff today in Latin America and Europe and Asia and the US. But we see a great opportunity to really expand our sales and marketing, capture the marketplace in front of us.
I mean, it's exciting times when we think about how much is being done here in the pharma space in 2020, and you guys right there with the front row seat. But Lance Hill, Within 3 CEO, and Yahoo Finance's Anjali Kamlani, appreciate the discussion on that front. We're going to take another quick break here on the ticker. We'll be right back after this. Welcome back to the ticker. Earlier in the week, we got data that showed the housing market continues to boom here in the pandemic when we saw existing home sales hit the highest mark that we've seen since 2006. And now new home sales matching that with the largest surge in sales for the month of August that we've seen in 14 years. Joining us now for more on the boom in housing is Yahoo Finance's Sarah Painter. And Sarah, I mean, things are hot in the housing space right now.
Yes, they are. So new home sales were up almost 5% in August, and that's after they were up almost 14% in July. So a lot of people are ordering new homes, and that's in part because there aren't enough existing homes on the market. So existing, new, they're all in really big demand because a lot of people are looking for more space and moving into new places right now. And so we're finding that home builders actually are seeing record demand since they haven't seen since the housing bubble of 2007, 2005, and really hitting new records. And they actually can't keep up with demand.
Yeah, I know we've seen inventory falling here and the supply of new housing and existing housing already stretched here. But how are home builders grappling with all that if they know that there are so many buyers out there fighting with each other to get into these things?
Yeah, so in July and beginning of August, home builders were just so excited to see activity picking up that they started burning through their inventory and trying to meet home buyer demand whenever they had orders. But as the quarter went on, they started to realize that it wasn't sustainable for them to continue to meet orders this way because they have to continue to sell homes in 2021. And they're expecting that sustained demand to continue into next year. So in all their earnings reports, builders are all emphasizing that they're starting to pace their sales so that they can keep on based on the number they can actually build. And I have economists telling me actually builders have set a cap on the number of sales that they're going to do in a month. And if it reaches that number, they're just going to stop selling. Another way that builders are doing that is by raising prices, which strikes a lot of buyers because we're in an affordable housing crisis, as we have been for a long time, and prices are continuing to raise. So it just continues to show the disparity between really high earners during the coronavirus who are able to buy those homes and able to meet those prices that are getting higher and higher.
Yeah, it's just crazy to think back up a few months and where we were at in this pandemic and how shaky things look to where we are now and how there's such a shortage here for all of these homes out there. But Sarah Painter, appreciate you bringing us that. That'll do it for us here in the 1 p.m. hour. Stay tuned. We got much more market coverage coming your way as the NASDAQ again trades near session highs, up by about 1.3%. On the other side, we'll be digging into the boost here in athleisure and the retail industry. The CEO of Athleta will join us with a focus more on that. Coming off the heels of Nike's shockingly good quarter. Stay tuned. Much more coming your way right after this.
Welcome to the ticker. I'm Akiko Fujita, and we are seeing the market staging a rebound today with 2 hours left to go in the trading day after that sell-off we saw yesterday. All three major indices firmly in the green. Doing a quick check here, the Dow is up 251 points, the S&P 500 up 31, and the NASDAQ up 116. Stocks climbing on reports that Treasury Secretary Steven Mnuchin is looking to restart negotiations on that stalled government stimulus bill. Mnuchin testifying before the Senate Banking Committee, saying that he has been in touch with House Speaker Nancy Pelosi to restart discussions about a follow-up to that CARES Act. Also helping fuel the rebound today, the latest data we got on new home sales pointing to a big jump in August. Sales of new single-family homes hitting a 14-year high last month, passing an annual rate of 1 million, though there are increasing concerns about the limited supply that's on the market. We also got weekly initial unemployment claims, the number rising 4,000 to 870,000 last week. Continuing claims moved lower to 12.6 million. We should point out those total initial claims still 7 times higher than they were in the pre-COVID era, pointing to the long road ahead in the economic recovery. In terms of sectors that we're seeing lead the gains, utilities and tech, the biggest movers in the market today. Individual stocks we're watching, Goldman Sachs and Darden Restaurants. Goldman up nearly 6% after UBS upgraded the stock from buy to buy from neutral, citing the potential election-related volatility, saying that could be a tailwind for Goldman and its trading revenue. Darden Restaurants rising more than 8% on some strong earnings. We're going to get to those numbers in just a bit, a little later in the show. And then we've got Nikola. We've been tracking that stock for several days now. It is continuing its fall, down about 3.7% on increasing concerns about the company's growth amid that investigation into fraud allegations. The author behind the Hindenburg report now saying that more bad news is coming. And we should point out Nikola off about 80% from that high we saw back in June. Let's bring in our first guest for the hour. We've got Jimmy Lee, who is the CEO of the Wealth Consulting Group. He's joining us from Florida today. Jimmy, you have said that you remain bullish despite some of the choppiness that we've seen in the market. There's plenty of opportunities, you say, for long-term investors, but when you look at the kind of data we saw today, particularly on those initial unemployment claims, how do you process that at a time when we are increasingly seeing that data pointing to a slowdown in the economic recovery?
Well, I think we have a long way to go in jobs, Kiko, and so that's going to be month to month. And so I wasn't surprised at that number today, but I do believe that these pullbacks are opportunities for long-term investors to buy on these dips. And so I am one of these buying the dip people here. With the stock market being led by big tech on days like yesterday, when you get the big sell-off in tech, investors are thinking about potentially rotating into value and more cyclical stocks on the opposite days. And so I think in the long run, investors need to be diversified with both, FANG plus Microsoft has led the market. And I don't think that run is over yet until we do get a vaccine or a treatment, but people should be positioned with value names and cyclical names for that to happen.
Yeah, I know you've mentioned that before. Earlier this month, we were talking about where big tech is going. You said you expected the sell-off to be triggered by some kind of vaccine or just a significant movement, at least on getting this virus under control. And yet we've seen Apple down about 20% this month. I was looking at Netflix down 16%, Amazon off as well. What do you think has been the trigger for that pullback? I mean, you're arguing that the valuations are still very high, and yet it seems like the rate of the pullback has been pretty noteworthy.
Well, the returns on those names, the big tech names, maybe 4 times greater than the rest of the S&P 500. So if you're an investor thinking about risk coming up with the election, potentially higher capital gains taxes, not a bad idea to take some chips off the table. So I think you're going to get some selling due to election risk and a lot of other worries about the coronavirus coming back and maybe the economy taking longer to get back on its feet. But with that said, the rotation to the more value and cyclical sectors has already begun. Industrials and materials are leading the market lately. In the last 1 month, I believe that materials is up 7%, more than S&P 500 in the last 3 months, 10%. So we're starting to see that already. And by the time we get a vaccine, a lot of the beaten up sectors, including financials, will have probably recovered quite a bit since then. So I think that rotation has started, but I don't think it'll really fully take into effect until we get a vaccine or a treatment that allows people to be comfortable being in large gatherings again.
So taking some chips off the table in tech and rotating into value, but you've talked about this barbell approach before. What does that look like for you right now?
Well, we still are overweight tech as an overall equity portfolio, but we've added to sectors that have been beaten down. So like I said, materials, industrials, even some financials. And I think that those are the kind of sectors. And if you want to take a little bit more risk than that, in the travel and leisure and gaming industries, there are still a lot of companies that are way off their highs. In fact, I think, over half the companies in the S&P 500 are still off their highs. There are still many stocks that are in the bear market. So I think you can find value in some of those names. Right now is a really good time to be an active investor so that you can scrub the balance sheets to make sure that if companies are taking on more debt, what their earnings are going to look like into the future. So as many retail investors, the common investors investing through index investing, such as ETFs, they think they're diversified across, for example, an S&P 500 ETF. Well, what they don't know a lot of times is that 23, 24% of their money is in the top 5 holdings, all tech related. So investors really need to look underneath the hood of their portfolio and make sure that they're diversified. And like I said, have some positions in value type sectors because the economy will reopen.
How big of a risk are additional restrictions for you? We have heard the president say that there is no new national lockdown coming. And yet we saw the headlines out of Europe earlier this week with the UK particularly looking to reimpose new restrictions. And we saw that weigh on the market here. So while we may not expect a national lockdown in the way we saw March and April, how much of the potential of that should investors be factoring in right now?
Well, of course, in the United States, it's state by state. As we were talking about at the break there with the doctor, what's going on in certain states is way different than other states. And so I think it really depends on where you live. But from an economic perspective, I believe that, our country is consumer led. And so 60, 70% of the economy being consumer spending, and people are spending, so we talked about the low inventory on real estate, for example, what's driving housing prices, and people are trying to get out of the cities to move into the suburbs. And so I don't think that trend's going to stop. Of course, that's going to rotate back when things get back to normal a little bit, but a price adjustment in real estate is probably something we needed in some of these metropolitan cities anyway. But I'm bullish. I think that, the economy will reopen. I'm very hopeful for a vaccine and or a treatment in record time. I think a lot of the news that we get around the medical side of this has been politically motivated. And so, I think we need to stick to the facts and hope for the best on the medical side. But I think we will reopen and the economy and the consumers will spend.
How big is the political risk for you from an investment standpoint? We heard from Secretary Mnuchin today, which seemed to suggest that there are ongoing talks with the House Speaker and there is potential for renewed discussions. And yet now you've got the potential for a very contentious Supreme Court nominee fight in Congress. The thinking here being that could maybe push back the stimulus discussions until after the election. Has the political risk calculation changed for you at all over the last few weeks?
It has. It's definitely risen. I mean, it's up there with the virus even. And so right now, I think today the market's a little bit bullish because of Secretary Mnuchin talking about the possibility of another stimulus check, which we desperately need in this country, I think, even though I hate debt. I think we need it. A lot of people are still out of work and need the money. And of course, the scenario of a change in the White House and the Senate is bearish for a lot of investors. One of the reasons being that, thinking that taxes will go up at some point during the next term if that were to happen. But with that said, I think it's up in the air right now what's going to happen on the political side. So a lot of uncertainty, and certainly, if there is a change in the White House and the Senate, I think we can look back to the Obama era and slow growth, but still growing. And so I think equities will still be okay. Certain sectors will be better than others. And I would expect a correction in the equity markets if we do get a change in the White House and Senate, but slowly climbing back. So I don't see any disasters out there, but certainly political risk is high, and a lot of investors are very worried about what's going to happen during the election.
And we have seen that reflected in the choppy trade we've seen so far this week. Jimmy Lee with the Wealth Consulting Group, always good to talk to you.
Thank you. Good afternoon.
Well, there are new troubling signs in the fight to contain the coronavirus. Nearly 24 states have now reported increase in COVID-19 cases this week. 7 of those states, including Colorado, Utah, and Arizona, saw their daily infection rates jump 60% over the last week. Let's bring in Dr. Seth Truger. He is an emergency medicine physician in Chicago, joining us today. Dr. Truger, it's good to talk to you. Let's talk about the spike that we have seen. I'm not sure we ever exited the first wave, but this wave in the fall is something we have expected for some time, given the overlap with the flu season. What do you make of this uptick that we have seen in nearly 24 states? And how troubling is that when you compare it to the trajectory of the virus over the last several months?
Well, thank you, Akiko. This is really troubling, but unfortunately, as you said, it's not really unexpected. What we're seeing is, a combination of a number of things. As the weather gets colder, people are going to spend more time inside, and we know that indoors transmission is certainly higher than outdoors or in other places, especially as people spend more time with each other. Additionally, this is hard for all of us. We've been doing this for months, and it's really easy to let things slide. It's really easy for that fatigue to set in where, do I really need to wear my mask? We've been doing this for so long. Is it time to have my kids do play dates? Is it time to go out to bars? And, just because we're all exhausted from it doesn't mean that it's safe to do it. And, additionally, a lot of states are starting to do things like barge ahead because, they want the economy to rebound. They want people to be doing better. But unfortunately, until we get the virus under control, it's not going to be safe to open things up.
That indoor component you talked about, is that what's driving the transmissions right now when you look at these individual states that have seen a significant spike over the last week? Or are we starting to see a change in the virus itself?
It's really hard to know. I'm reluctant to assign any of this to a change in the virus itself. It almost certainly is driven more by our behaviors and, just how we're interacting with each other. There's a number of things. Like I said, there's the fatigue, there's people spending more time inside because of the weather. There's also a lot of things where schools are opening up. Remember that basically for the first 6 months of the virus, everything we knew about transmission was based on schools being closed and kids being at home. It's a very different time right now. So as we see, the combination of all these different behaviors, it's all going to be very, very different. And we don't know exactly what's going to happen. I'm hopeful that schools that are opening are doing it safely. Kids are wearing masks, pod sizes are small, everyone's doing hand washing, and people are being responsible at pickup and drop off, and more importantly, outside of school. But, we really don't know what's going to happen because we haven't had this pandemic with schools open for a while yet.
And Doctor, you're coming to us from Illinois today. Your neighboring state, Indiana, is preparing to enter that final stage of the reopening process this Saturday. So we're talking about full capacity in restaurants, bars, and gyms. Yep. Number one, is Indiana in a place to be doing that right now? And as a neighboring state that still has restrictions in place, what's the knock-on effect you're concerned about?
Yeah, ultimately, I'm not going to pretend I'm an expert and I know all the different things about the numbers and how to reopen. But looking at the numbers, just simple stuff you can look up online with the reliable information from Johns Hopkins and other places. Their positivity rate is closer to 10% than it is than 5%. It's higher than it is in Chicago. Everyone wants to reopen. Everyone wants to go back to normal. Everyone wants, to have people employed and going to work and have kids in school and doing well. But it really doesn't look like that's going to be safe. And we're going to pay the price for this down the road. And,
how do you counter that, though?
Yeah, it's really tough. The bottom line is there's political reasons and economic reasons why people want to open, but this is very different from normal economic circumstances where there's something like a housing bubble where it's, an economic problems or an economic bubble that's driving an economic downturn. If people can't go to work, if it's not safe for people to go to work, then people can't work. The economy can't rebound. It's the kind of thing, we're doing a little better than we were before. There's still 800 Americans dying every single day. That is unacceptable. And it's just certainly not safe right now for all of us. And you see, you said, as you mentioned, Indiana is a neighboring state. A number of the people I work with every day drive in from Indiana. State lines are porous. We're one big country. We're not 50 separate states.
A lot of this, in terms of getting the economy back up and running, is really about confidence among consumers, feeling confident and comfortable going into restaurants, traveling again. And on that front, we heard from United Airlines talking about how they are now looking to offer rapid tests for their Hawaii-bound planes to passengers. Now, the specifics unveiled today, they're talking about $250 for that test itself, but it does give passengers an opportunity to get tested before they board the plane. And more importantly, for another state, in this case, Hawaii, to feel comfortable enough to accept those tourists into their state. Is this the kind of blueprint we're looking for to get travel going again? How effective do you think that can be if the onus is on the passenger to pay for the test?
Yeah, I mean, there's a number of different issues here. Ideally, this is the kind of thing that if it's done well, once we get things largely under control and the prevalence rates are pretty low, this is the kind of thing where it may be safe to travel again someday. And this might be part of how we, reopen tourism and start, re-engaging those parts of the economy. But we're pretty far from that being safe. Additionally, as you mentioned, people paying out of pocket, $250, that is not a small amount. Obviously, if you're spending money to be able to fly to Hawaii, that's already selecting people who have some money to do it. But this is the kind of thing we're already seeing. It's the hardest hit communities that are getting hit hardest. It's people of color, people of low income, people who can't work from home because they work in the service economy, people who work at restaurants, people who, mop the floors. And these aren't people who are going to be able to spend $250 to go on vacation. And, whether or not we feel comfortable about it, is only one small part of what's happening with pandemic. And if anything, feeling too comfortable when it's not safe to travel is going to be more dangerous for the community and people around us.
And the other question being that, is that going to be prioritized when there's still not enough tests in place to get everybody tested as well? Dr. Seth Truger, good to talk to you. Appreciate your time.
Great, thank you.
Coming up, the athleisure boom, sweatpants and yoga tops helping the beaten down retail sector. But can this strength continue beyond the pandemic? We're going to be speaking to the CEO of Athleta, Mary Beth Lawton, after the break. Welcome back to The Ticker. Athleisure has been a rare bright spot for the retail sector during this pandemic, with sweatshirts and yoga pants becoming the new office wear with so many people working from home. While overall apparel sales fell 34% between March and July, we saw sales of athleisure rise. And for Athleta, that boost in sales have meant a 6% growth in their sales in the most recent quarter. Let's bring in Mary Beth Lawton. She is the CEO of Athleta, and she joins us from San Francisco today. Mary Beth, it's great to have you on today. You're just coming up on your 1-year anniversary here, and you were just saying that it has really been a whirlwind, especially over the last 6 months. Walk me through the kind of behavioral changes you have seen in consumers on what they're buying and where they're buying, how that has shifted over the last 6 months.
Yeah, it has been a whirlwind for but I would say, our product has been so relevant for her. As you said, she's working out at home, she's working from home, she's homeschooling her kids. And what we've seen, our customer really loves product that is comfortable, but also really versatile so that she can wear it on her calls, but then also go out with the workout at her own time. So I think the versatility has been something we've seen and will continue as people's lives continue to evolve during this pandemic. And then, how she's behaving is I think she wants connection more than ever. She wants to be able to still connect with people like her and other customers and our associates. And so we've been focused on how can we provide her choice and convenience, whether that's shopping online, which she loves, or coming into one of our stores. We just opened our 200th store this month. Or we've started services like a virtual concierge service where she can get one-on-one personal service from the comfort of couch on her phone with our store associates. So I think that's something that is really important to customers during this time.
Let me get back to that growth story you just pointed to. I mean, the expectation here is that athleisure is here to stay. It's not a trend. And yet the rate of growth has just been incredible over the last 6 months. We just pointed to that 6% sales growth you saw in the last quarter. How sustainable are those rates, you think? Inevitably, people are going to go back to the office. They're not going to be, one would presume, be wearing yoga pants when they go back. How much of the demand during this period you think has already been pulled forward?
I see consumers having shifted, brands like Athleta, but also really can be professional and appropriate for the office and really versatile, as I mentioned. So things like our wraps are something that's a beautiful product that, she can wear comfortably in her home, but also can wear into the workplace. So I think people are going to continue to want to wear comfortable, versatile clothes. They've gotten used to it during this time, and they're going to want to kind of continue. And I think that's really going to help us continue to see the growth.
You pointed to the new stores you're looking to open. We're looking at bricks and mortar stores at a time when a lot of other retailers are doubling down on their online strategy. Where do you ultimately think that the sweet spot is for Athleta? Is it 70% online, 30% in store? Where do you see that breakdown?
Yeah, we are fortunate with Athleta that we have a strong online business, even pre-pandemic. You saw in our Q2 results, online business was up 74%. And there's no doubt that customers are going to continue to want to shop online. But, we did open 8 stores since March. And, we, like I said, just opened our 200th store. So we are really focused on just providing options for our customer. And I think, retailers of the future are going to need to focus on offering, options for the customer wherever she is spending her time. And sometimes that's online, sometimes that's on a mobile app, sometimes that's in a store, or sometimes it's a combination of both with, the ability to digitally connect store associates with customers at their home. So I think, that's going to be a focus for us, just to continue to meet her wherever she is and offer her a great experience.
We've seen athleisure become an increasingly crowded space. One of your biggest competitors, Lululemon, has really been aggressive in expanding its brand, not just to women, but offering menswear, as well as going into shoes. They recently acquired the fitness startup Mirror. And yet Athleta has really doubled down on women and this message of inclusion you've talked about, not just for skinny women. You've talked about women of all shapes and color. What is the market you're trying to address? I mean, why double down there? What is that potential that you see you can still tap into?
Yeah, I think, for Athleta, what we recognize is that it's more important than ever to really focus on our mission and be authentic. And I think customers these days are really valuing brands that lead with their mission and stay committed to who they are. And that's certainly what we're focused on at Athleta. We're all about empowering women and girls, making them feel confident and great. In fact, we're just announcing a new Power of She fund that we're launching, a $2 million commitment we're making to really fuel confidence in women and girls through connection and through sport. So we're really excited to just continue to focus on, doubling down on our mission, which is, I think, really important for women and girls at this moment.
How do you see that $2 million being distributed? To your point, in this message of empowerment, what are some initiatives that you're looking to? What are some organizations that you think can really go well with the Athleta brand?
Yeah, so our plan for this fund is to launch our first set of grants later this fall, but we're partnering with the Women's Sports Foundation, and they're really going to help us narrow in on organizations that do fuel confidence in women and girls. So that'll be a very clear criteria. And I think what's so great about that is there's so many organizations that really help elevate women and girls in that way. So we'll be focused there in partnership with the Women's Sports Foundation.
Okay, we'll be watching that initiative very closely. Mary Beth Lawton, the CEO of Athleta, great to have you on today.
Thank you.
Well, it's Thursday, which means another episode of Influencers. And this week, Andy Serwer sits down with the founder of The Honest Company, Jessica Alba. She talked to Andy about how COVID-19 has affected her role at The Honest Company. Take a listen.
I am involved in a lot of the day-to-day, and since the COVID situation outbreak, prior to COVID, we were seeing, over 25% growth with the company, and we've expanded our margin. We're really, really focused on making sure that we grow the business in a healthy and sustainable way, even when we are expanding into new product categories. And then when looking, around at this, new world that we're all living in, we have that direct relationship with the consumer, and they're asking for better solutions for their families when it comes to disinfecting and sanitizing and whatnot. So we were able to quickly innovate and create a solution for a disinfecting spray, a sanitizing wipe, and obviously we already have our hand sanitizers and masks.
And you can catch much more of Andy's conversation with Jessica Alba on the full episode of Influencers tonight. That's at 5 o'clock Eastern time on Yahoo Finance. Coming up, taking the fight to Apple, the latest company is calling for a shakeup in Apple's App Store policies. Could this derail Apple's growth in services? We'll tackle that question after the break. Welcome back to the ticker. Doing a quick check of where markets stand right now with 90 minutes left to go in the trading day. We are seeing the Dow up 175 off of its session highs, but certainly still holding there. The NASDAQ up 78 and the S&P 500 up 21. We've been tracking Amazon stock very closely as well. Shares there up about 1% on the back of a slew of new hardware. Their new devices the company announced just a short time ago. Dan Halley is here to break down the announcements for us. And Dan, we're talking about a new Ring security camera drone. Walk me through how this works.
Yeah, this is called the Ring Always Home Cam, and it is a drone that flies around your home. It'll dock in its charger, take off when it hears something, or when your Ring security system hears something. It'll fly in that direction. And then it'll investigate, it'll make a loud noise while it's flying so people aren't hurt. And then once it's done doing its kind of reconnaissance, I guess, you can then have it set itself back down onto the charger. And it's, something that's surprising only in that it's a drone inside the home. And so what Amazon or, Ring, parent company is Amazon, but what Ring's doing is encasing the blades entirely so that nobody would potentially get struck by them or they don't strike anything and the system isn't damaged itself. It's a little over $200 for this, which isn't too expensive when you consider that it's a drone for inside your house. It's a pretty wild device. Amazon also launched new versions of their Echo devices. Those are no longer those tall cylinders. They're actually making them sphere-like now. And they're still going to have versions of the Echo Dot and Echo Dot with its built-in clock. Those are also going to be spherical as well. So they rolled out a slew of new properties, including a new cloud gaming service called Amazon Luna. That will be $5.99 a month. It's in early access now, so you need to get an invitation to try it. But it's part of Amazon's bet to jump into the $160 billion gaming industry. They have tough competition, though. Microsoft has cloud gaming coming out, or that's out now. Google has cloud gaming that's out now. NVIDIA has cloud gaming that's out now, though Google and NVIDIA really kind of struggling in this space. But Amazon is trying to put its foot down and become a huge member of the gaming community. And they already have a secret weapon in Twitch, which is going to be a part of this cloud gaming feature. So it's a really interesting day out of Amazon.
Yeah, I mean, there's a lot of competition in that space, to your point, Dan. Let's talk about another stock that we've been watching closely. Apple shares there up about 1.8% there, even as as the company faces more pushback on its App Store policies. We've got Spotify, Match Group, and Epic Games, now the latest company to join this nonprofit group, Coalition for App Fairness. So what specifically are they calling for in terms of the changes in the App Store? And the larger question, how significant an impact are they likely to have?
I don't think this is going to have as large an impact as they may like. They're really calling for essentially a drop in the commissions that Apple and Google charge, though their website specifically targets Apple a lot. And that's because, they were just $2 trillion. They're one of the largest companies in the world. And also, the only way to get access to Apple apps is through the App Store, whereas Google has its Google Play Store, but you can also still download third-party app stores and get apps onto your device through there. So that would explain why they're going after them. But I think that this is basically, I've said this before, they smell blood in the water from the FTC investigation, the DOJ investigation, the State's Attorney's General investigation, the House Judiciary Committee's investigation, all those, fun investigations that are ongoing. And they want to basically put a stamp on that and say, look, we know that Apple is in trouble. There could be issues with antitrust going forward. So why don't we just ensure that we get our point across a little bit more with this handy lobbying site? And that's exactly what they're doing. They're based out of DC. It's going to be, it's a nonprofit, but it's a lobbying group essentially, basically on behalf of these app companies that have a problem with the commissions that Apple and Google charge.
Yeah, certainly strength in numbers, at least, no doubt. That's how these companies see it. Whether that leads to actual charges of anti-competitive behavior is something that we'll continue to watch. Thanks so much for that, Dan. We've got much more market coverage ahead here on the ticker. We'll be right back. Welcome back to the ticker. Some positive economic data helping fuel the rebound we're seeing in the market today. The latest data on new home sales pointing to a 14-year high in August. But we also got those initial unemployment claims on the week. Last week, we saw the number actually rise 4,000 to 870,000 last week, pointing to potentially some stalled momentum in the labor market. Let's bring in Brian Jacobson. He is with Wells Fargo Asset Management. He's a multi-asset strategist there. Brian, just give me a sense of what's your read was on the weekly claims that we got today. I know we don't want to make too much of 1 week, but it does feel like we're starting to see a bit of a stalling here on those job market, especially because we haven't gotten any indication of additional stimulus coming from Congress.
Well, yeah, you make a very good point there. It does look like some of the economic data may be pointing towards a bit of a labor market stall. And I think that's where investors need to really look at the whole picture about it's not just the labor market improvements, which maybe the pace of improvement is going to slow, but we're seeing that housing data pointing towards a housing market that is just on fire. It seems like, that's really charging ahead full steam. We also have very good data out on consumer confidence, and then also with business investment or business activity, especially like the ISM manufacturing and non-manufacturing indexes. So yeah, the labor market, the jobless claim is a little bit worrying, but when you're looking at like the mosaic of the information that's out there, to me, it does point to an economy that's continuing to plow ahead. But then the stimulus talks, that can be really hit or miss depending upon the time of day, it seems like.
How much of the momentum in the market you think is contingent on getting that stimulus bill? It seems like the expectation is largely for some kind of bill to come forward after the election. And yet I have to wonder what you see in terms of what's actually already been priced in.
Yeah, it's really tough to read that. When we're monitoring the daily data and intraday data, looking at, what's going on with the headlines, and then as far as what the market moves, it seems like, the two really big items out there are about what's the probability of there being a vaccine sometime soon, meaning probably before the election or around the election, and then what's the probability of there being some sort of fiscal stimulus. Now, I think that it is encouraging that despite a lot of the apparent dysfunction in Washington, D.C., that they were able to pass a stopgap funding bill to fund the government through December 11th. So maybe they can, walk and chew gum at the same time. And so maybe they can come to terms with fiscal stimulus. But for my team, we're not really banking on that idea, though. It would be a nice to have, and there would likely be a market move lower if it seems like the talks completely fall apart. But when we're taking that longer term view, we're not convinced that we necessarily need that additional stimulus to maintain the economic momentum. So it's more of affecting the shifts in sentiment that we're seeing on a daily basis, as opposed to really affecting the fundamentals of the economy, which we think are continuing to improve and heal.
And Brian, what does that mean from an investment standpoint for you? We had a guest on earlier who was talking about the rotation that's already begun outside of growth into value. And yet he said at the end of the day, he was still overweight tech. And so I'm curious where you're putting your money, whether you're shifting up your allocations, just given some of those headlines that you just pointed to that are expected.
Yeah, well, as far as the way that we're positioning portfolios, we do have more of what we're referring to as like a reopening trade on, which is the expectation that economic growth is going to get more traction as we go on. And so that would tend to favor what your previous guests had talked about, a more bias towards value as opposed to growth. We don't like to think about it in terms of necessarily growth versus value, because there can be, value stocks that represent good growth opportunities and growth stocks that are good value opportunities. And so we like to think about it more in terms of cyclical versus the non-cyclical. And so the cyclical would be more like, say, industrials, financials, materials, those types of sectors that you expect to do better if the economy is getting more traction. And so those are the areas that we've begun to overweight. That and emerging markets, because emerging markets are almost like a cyclical play, but multiplied by 2 as far as just how sensitive those stocks can be to an improved global economic outlook.
Yeah, we have had a number of guests who've talked about the opportunities they see in EMs. I mean, what particular markets are you looking at, and how much of that opportunity and the potential growth in emerging markets is contingent on where the dollar goes?
Well, yeah, good point. As far as the stronger U.S. dollar does tend to make it more challenging to invest outside of the United States, because you've got that little bit of a headwind coming at you from the currency moves. But we do think that within the emerging market complex, if you break it up into 3 sections, you've basically got Asia, you've got South and Latin America, and then you have everything else like Europe, Middle East, South Africa. The areas that we actually like more are, say, in South America with Brazil. We think that that area has been beaten down. Their currency came under a lot of pressure, and so perhaps we could see a bit of a rebound there. And then also in emerging Asia, even outside of China, because if you're investing in emerging markets, it's hard to escape China as far as a large allocation. So we want to be a little bit more nuanced there, favoring some of the other areas like, say, like Indonesia and even India to a certain extent. Now, one of the big challenges with emerging markets, of course, are all the political issues that can pop up. But I think that over the last couple of years, we've proven that even the developed markets, we can't escape those political issues.
Yeah, it feels like you can't escape politics anywhere in the world today. Brian Jacobson, good to talk to you. He's the multi-asset strategist at Wells Fargo Asset Management. Coming up, extreme climate and the impact to some of the world's largest companies. A new study points to the alarming risks businesses increasingly face with wildfires and hurricanes battering different regions of the country. A conversation with Richard Madison from Trucost is coming up after the break. "2020 is on track to become the second warmest year on record. From wildfires to hurricanes, the extreme weather is starting to have a material impact on some of the world's largest companies. S&P Global recently crunched the data of more than 500,000 corporate assets to examine the climate risk to investors. Let's bring in Richard Madison. He is the CEO of TrueCost, which is a division of S&P Global, and he joins us from Edinburgh today. Richard, this is just kind of a fascinating study that you have done about the risks that are present to these companies, and you've kind of divided into the physical and then the transitional risk. So let's talk about the physical risk first, because there's a number here that I think is quite alarming. Almost 60% of S&P 500 companies hold assets at high risk of physical climate change impact. How do you measure that risk?
Yeah, so it's actually something that has historically been very difficult to do. What we did was we looked at the S&P 500 companies, and within S&P Global, we actually have data on the types of assets those companies own and where they're located. So, for example, it could be a mine or a power station, could be some real estate, various different types of assets that we examined. And we mapped those assets to their owners in the S&P 500 companies. And then on top of that, we layered on top 8 different types of natural hazards that could affect those assets. So, for example, floods, droughts, wildfires, rising sea levels, hurricanes, heat waves, those types of physical impacts of climate change we mapped on top of the assets. And we looked at 3 different scenarios out into the future that the IPCC, the climate change governing body, has formulated. And we found that for S&P 500 companies, nearly a third of the companies in the S&P 500 have assets at very high risk of the physical effects of climate change under a business as usual scenario.
And so, Richard, when you talk about sectors, who's most exposed here? We tend to think about the energy sectors, especially because we see the impact from the hurricanes in the Gulf Coast, or the fires as a result of the utility companies. I mean, is there a sector breakdown where, certain sectors are more at risk than others?
Yeah, we do find some sectors are more at risk than other sectors, but it really does depend on the specific type of hazard. So when you look, for example, at rising sea levels, and some of the predictions would show that beyond 2100 sea level, could rise beyond 1.5 meters, that would really be the larger part of Lower Manhattan, which actually would mean the real estate sector obviously would be significantly affected. If you're looking at things like heat waves, actually that can have a serious impact on power provision and electricity producers, as can wildfires. And when you're looking at floods and droughts, well, it really depends on where you are in the US, but power stations need water, as do farmers, as do many others, right? So it really depends on the type of hazard in terms of how the different sectors are affected. But I would say that there's a much broader set of sectors that are affected by the physical effects of climate change than the sectors that would be affected should there be action on climate change.
And so when you highlight those risks, how much of that is already reflected in equity and bond valuations? If you're talking about the equity valuations for particular companies, let's say in energy, how much of that has actually been factored in right now? And to the larger question, what more needs to be done so that investors have a little more transparency on those risks?
Yeah, I mean, I think I would say that very little has actually been priced into some of those valuations. And the reason why is because this information is actually quite hard to come by, and which is the reason why we put it together in the first place. It's not historically been available. So, when you're looking at the extent to which, for example, a municipal bond is priced, people really haven't had the right type of information to be able to look at physical risks over a long duration of time. And actually, we collaborated with our colleagues at S&P Global Ratings, and we examined the extent to which municipal bonds could be affected by looking at every single county in the US. And what we found that when we looked at all of the counties and we looked at one risk, which is water scarcity, we found that 38% of counties are at risk of water scarcity, again, out under a business as usual scenario. So, those who are issuing municipal bonds and those who are evaluating those bonds, really, this is new information to allow them to examine the risks of the types of infrastructure and other types of investments those bonds are funding. So really, it's not been well priced by markets in our view, and that's the reason why we provided the information.
And very quickly, Richard, I've heard you say business as usual scenario a few times. I know you ran these models through climate change through 2050. What's the likelihood of that business as usual actually playing out when you look at where climate or global warming has gone over the last several years?
Yeah, I mean, that is the most likely scenario right now. So what everyone is pushing for is a scenario which is 2.5 degree warming or less. But the most likely scenario currently is tracking close to 4 degrees or more. And so it's called the RCP 8.5 scenario, to get technical, but that is a scenario that's most likely to happen at the moment without further action to sort of flatten the curve.
Richard Madison, the CEO of TrueCost. Great to have you on today.
My pleasure.
We'll be right back. Shares of Darden Restaurants seeing a big pop in the session, up 8.5%, despite the company seeing net sales fall by nearly 30% during the most recent quarter. Sabeel Marcellus is breaking down the numbers for us. So, Sabeel, what has investors so excited? A 30% drop seems quite significant.
Well, it's the dividend. Olive Garden's parent company, Darden Restaurants, is reinstating its dividend. It will pay out 30 cents per share for this quarter's results. Now, when you look at the financial picture of the company, now they reported their quarterly results, and you look at revenue, it fell 28%. Same-store sales in its fine dining business down 39%. And to give you a sense of how much their business is hurting right now, for example, Olive Garden, which accounts for half of overall revenue for Darden Restaurants, they have a location in Times Square. It's the most profitable location in the chain. Well, because of the coronavirus pandemic, they have seen their sales drop 94%. Now, on an average year, if there was no coronavirus pandemic, they'd be bringing in $15 million per year just at that one location in Times Square. Now, because of the coronavirus pandemic, what they're seeing is that they're losing about $300,000 per week and only bringing in about $18,000.
Wow, that is a huge drop there. Thanks so much for that, Sabeel. And just a reminder, a programming note, Sabeel is going to be hosting the 2020 A Time for Change, our regular special on Thursday night here. It starts at 4:30 Eastern. Today, she'll be speaking to New Jersey Senator Bob Menendez. That is coming up at 4:30 Eastern right here on Yahoo finance. That does it for us here on the ticker. Coming up, we've got the final round that will take you into the close.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a look at the markets here with about an hour to go in today's trading session. Right now, we do have all three majors higher for the day, but not the most constructive day of trading, especially if you wanted to kind of see the bulls take control of this market. Right now, we've got all three majors up just about 0.2%, well off session highs, where we saw the S&P up better than 1% at its highs this session. We'll get into sort of what went into that intraday reversal with Jared Blickery in just a bit. But again, in a market that has been kind of listless here, actually, that's probably the most positive way that we can say it, a market that's been in a corrective phase and has tried to maybe repair itself over the last few sessions, but just can't really seem to get off the mat. Another day of kind of discouraging market action on that front. Just taking a look quickly at what's happening on the economic data side. Weekly, speaking of discouraging, weekly jobless claims, 870,000 last week. We still have claims. I guess the number is about 150,000, 200,000 higher than the record high we saw during, or the previous high we saw during the financial crisis. So the labor market continues to be in a deep amount of distress, some 6 months into this crisis. And then over in the housing market, new home sales printing their best numbers since 2006. So again, the K-shaped recovery, really the consensus view, I think, at this point. We see it once again on a Thursday, where every Thursday we get the jobless claims data. Every Thursday they continue to be discouraging, and then we sprinkle in, especially when it comes to the housing market, you sprinkle in some of that more positive data to once again fill out what I think is a clear picture of kind of how things have proceeded, again, 6 months into this crisis. All right, I want to bring in my co-host Shauna Smith for a bit more on what stands out to you, Shauna, during today's trading action.
Hey there, Miles. So, I mean, it's interesting when you take a look at how far we've traveled just today. I mean, the Dow has had over a 500-point swing today. It's been a very volatile past couple of days. When you take a look where the S&P has traded over the past 2 days, it's traded in a 100-point range. So there's a lot of volatility out there in the market. The S&P right now today is in the green, but we're not too far from that correction level that we were so closely watching into the close yesterday. So the S&P would need to close at or below 3222.76. So we're not too far from that level. We're barely holding on to gains today. So, of course, that is something that I think a lot of traders are keeping in at the back of their minds, just in terms of some of those critical levels to watch. In terms of today's turnaround, some of the leadership that we saw this afternoon is being led by some of those big tech names: Apple, Microsoft, Alphabet, Amazon, all in the green today. Microsoft, Google, and Apple all up just around 1%. So we're seeing those big tech names come back into favor here amongst investors finding a reason to buy some of these names as they remain just around 10% or more off of their recent highs. Another outperformer today is Goldman. It got that bullish call from UBS. They upgraded the bank to a buy. And it was an interesting call just because they were saying that Goldman is in a position to really benefit from the potential volatility that could be caused from the US election. And therefore, it would set them up to have a pretty solid fourth quarter. So I think that kind of contrasts a lot of what we've been hearing from some of our market guests. I think a lot of our market guests have been a little bit critical, a little bit weary of the financial sector going forward, but UBS saying that they actually think that Goldman is in a position to have a pretty strong fourth quarter. So that's a standout in the market today. It's a leader in the Dow with the stock up just over 4% right now. And Miles, you mentioned the two big econ data notes that we got out today. And I think that's interesting because I think investors are trying to wrap their head around the market and really weigh the concerns with the pandemic, the it is a contentious election, and what the possibility, what the outcome will be there, and weighing that against what we're seeing in the econ data, and specifically in that housing number that you mentioned. New home sales hitting a 14-year high. Jobless claims, not a strong number this week, right around 870,000. So some weakening there or stalling in the labor market. But the outperformance in real estate, I think, is something that people are trying to wrap their heads around, trying to understand, trying to gauge how long momentum like this it can last, and also how much the strength in housing is going to be able to offset some of the weakness that's out there in the services sector. So because of all that, I think we're not too far from the flat line today. But again, I think the point travel, the distance that we've gone today is something that we need to mention when we talk about volatility here over the last couple of weeks and really to come most likely over the next couple of weeks as we do lead up to that election with the Dow, again, a 500-point swing in the market today.
Yeah, a phrase we went back to so many times during the beginning of this phase is that in a volatile market, you can have volatility up and down. It doesn't mean you have to go down every day. So again, the kind of range we're seeing today certainly speaks to a more volatile environment. And it's funny, Shawnee, you mentioned the election. Wrote about that a little bit in the morning brief for today that went out this morning, and about how Wall Street is kind of circling this idea. They're assuming now the base case is that there's going to be some kind of contested election. And I joked, but I'm not even sure if it's really a joke, that stocks rise because Trump says he won't commit to a peaceful transfer of power. Trump being in office, I think, is what a lot of investors in the market think is going to be better for stocks. We don't have to go through all the data on that today, but I think on a day like this, that's as good a narrative as any. So anybody out there who wants to steal that headline, you are free to have it. All right, Jared Blickery, let's talk a little bit about today's market and pick up on that point Shauna made, where the range today, fairly wide, and I think definitely speaks to a pretty unsettled environment when maybe earlier in the session around lunchtime, the bulls might have gotten excited, but that's kind of worn off quickly here.
Yeah, we're definitely off the highs. And just to continue that discussion about the range, I went back and it looks like the S&P 500 has moved 2% or more in the last 6 trading sessions. And that is above average in any normal year. Even against March lows, that's kind of above average. But let's take a look at the charts here. So we opened up just below yesterday's low, and then we managed to rally into about the middle of that range. And now we're off again right around yesterday's settlement. So we see the S&P 500 up just barely 16 basis points. We did have a nice breadth thrust, especially in the NASDAQ when we made these highs. And that was, I believe, shortly after, well, don't quote me on this, so I'm not even going to speculate the reason there. But I do want to take a look at some other charts here. We got the VIX. That's about break even here. If we take a look at the 3-month, we can see we poked above 30 once more, but now we've sold off here, and we are still looking like we could head higher until we break out of this cup formation that we have here. But if we look at the VIX of the VIX, that's actually quite depressed, and that's not showing as much fear in the fear index itself. So that's something interesting. 10-year T-note yield down about 1 basis point, still in this consolidation, waiting for a breakout. And then the U.S. dollar index, got to spend a little time on this because we had been up 4 days straight, and we got a nice pop above the 50-day moving average. I was talking to Keith Bliss this morning on one of the shows, and he thinks the dollar is overbought and that it's going to head back down. But I'll tell you what, if it goes higher, it's going to cause more pain for equities. So this morning we opened up this NASDAQ 100 heat map that we're going to look at here was mainly red, especially to the left, managed to claw into the green and stay there most of the day, but we have given back gains in a number of these stocks. Miles.
All right, Jared Blicker, we'll check in with you in about a half hour. All right, let's turn our attention now to everything going on with the coronavirus, and it's really been a busy 24 hours, Anjali Khemlani, when it comes to the FDA approvals, what people say they will do, won't do. Of course, you would find expect nothing less than Trump and Andrew Cuomo disagreeing with one another, but that is indeed the situation we find ourselves in.
That is correct, Miles. Unfortunately, we are watching yet another political back and forth over the vaccine timeline, which, as we know, has been clearly sort of extended, further than what initial hopes had been on that. So while Trump continues to tout the idea of a vaccine by election day or some sort of approval, most companies, especially the ones in the front, in the lead, are saying that that's not really going to be possible. And we had FDA Commissioner Hahn yesterday in front of the Senate Help Committee talking about, what that timeline looks like and reinforcing the idea that there will be no political pressure accepted on this front. And of course, behind all that, there is a push to actually strengthen the observation period of these phase 3 trials, extending the period of time, which would push out any kind of authorization or approval to closer to Thanksgiving. Right now, everyone was looking really at the end of October, sort of that initial indication, and maybe a few weeks after that, getting some sort of emergency use authorization. So that may be pushed out. While those guidelines have not come out yet, we did hear Trump yesterday sort of undercutting that idea, saying it seems to be a political move, and the White House does have the authority to deny that. And we had Health Secretary Azar sort of reinforce that message, saying that the things that the FDA is pushing for have already been addressed. So really just still waiting to see what happens with those guidelines and sort of where things all lay. As we know, there is a lot of concern over what happens to those vaccines. Meanwhile, really a big, as you mentioned, busy 24 hours, that we heard that United Airlines is now going to be offering COVID testing, an option for COVID testing prior to flights from San Francisco to Hawaii. And that falls in line with what we've kind of been seeing as sort of these optional offerings, both in airports as well as by airlines themselves. Lufthansa also has been doing similarly. We've seen in Newark Airport, there is an option to get COVID testing, as well as in some European airports, they're looking at sort of point of care right there, being able to get a saliva-based test. And so all this goes to sort of that push, as we've seen, for businesses to continue operating with that option available. But it's unclear whether or not this is something that could be covered in the future. There's still that cost to the consumer/patient at this point in time. So waiting to see how that all pans out. There are the strategy is to roll that out in other major airports as well pretty shortly.
And then Anjali, I guess on the testing side, and I think, I saw, someone say like, oh, so we've got it working in professional sports. People get tested every day. Now we're going to get business travelers going. Then I guess the rest of us can get tests. I guess in the context of the virus itself, how this coronavirus spreads and how COVID spreads from person to person, is like, can you still spread the disease even if you are testing negative? Are we sure about the efficacy of these tests? And I guess I'm just asking, do we have to be able to test everyone all the time, or is it really something else about how we can mitigate the spread of the virus? Because these are very expensive, very time-consuming measures that are not available for everybody. But is it even the best way to kind of get us back towards something like normal?
That has been an ongoing debate, quite honestly. I don't have the definitive answer to that question. There are some in the public health space who believe that too much testing is not very useful, and others who say that at least it gives some sort of indication. I spoke to an expert today that sort of explained it as, and I love this analogy, slices of Swiss cheese. Everything that you take as an action has its strengths and also has its gaps, the same with temperature checks. And so that idea, I think, kind of speaks speaks to exactly what you're talking about, where yes, and I've heard those same criticisms. We see how government officials have easy access to it, sports professionals have easy access to it, and now it clearly defines a very separate class of individuals who have access to these very rapid turnaround tests that do cost money out of pocket. But the average person still is left wondering where to get a test. And we haven't seen them, or this kind of widespread rollout at schools, for example, which is, one area where there is concern that there should be this. So I think right now the idea is that it's just one tool that should be helping, because as I've been told today, actually is a really important point to bring up right now. Even if we do get a vaccine, just to set expectations, a public health expert still expects us to have to wear masks and social distance even after that. So all of this put together, it just being, generally speaking, tests will be helpful.
Yeah, I mean, I think I've heard experts talk about like the chances that COVID disappears from the population are somewhere between 0 and 0. So that's probably not the future we're looking at after a vaccine, and all these things are going to be part of our life for a while. All right, Anjali, we will leave it there. Thanks for joining the show. All right, coming up on the other side of this break, we're going to have our call of the day. Today we are talking about Square. We'll get to that right after this. All right, welcome back to the final round here on Yahoo Finance. Time now for our call of the day. Today we are talking about Oppenheimer's latest on shares of Square. The firm is upgrading the stock to an outperform rating, putting a $185 price target on the stock. And Dan Roberts, I know you are writing about this call from OpCo on Square. And I guess as they see it, basically Square finds themselves, I don't want to make too many comparisons to this company, but in a Shopify-like situation where they're benefiting from everyone else moving online and sort of catching up maybe to where Square had positioned themselves. Is that maybe a fair way to kind of enter into where Oppenheimer gets so bullish on the stock?
Well, I think that's fair because increasingly Shopify and Square are competitors, although probably Square would say, well, wait a minute, we came first long before Shopify. So more people, I think, might compare Shopify these days to what Square has done. But look, all of the things highlighted in this very bullish note are the things that we've always talked about with Square, the ecosystem. And that is kind of Square's favorite term for the idea that it serves both sides of the sale equation. It serves sellers, i.e. merchants, and mostly small businesses. And then it serves consumers, shoppers, either at point of sale when you use Square products or with Cash App. But really this note is based around Cash App and its growth, which, I think in New York, we can tend to be very regional focused and think that Venmo is the end all be all, but Cash App is number one in a lot of markets and it's grown very nicely. And then interestingly, some real mention here in this note of the Bitcoin gains within Cash App, which we know is a obsession of Jack Dorsey's. Some have criticized it as too much of an obsession. But last quarter, Square saw profit from allowing Bitcoin trading in Cash App. Its profit from Bitcoin was about 17 million, tiny, but up 710% from its profit from Bitcoin a year earlier. And its Bitcoin revenue was up 600%. Now that was because Bitcoin prices have been up amid the pandemic, more people were interested. But all of this aside, what this note really is to me is a bet that small businesses emerging from the pandemic are going to need to digitize their businesses. Now, of course, we already know that. I mean, if you didn't realize before the pandemic that e-commerce was where everything was headed, well, you were sleeping. But now everyone sees it. I mean, we've talked so much about the huge gains that big retailers have seen with e-commerce amid the pandemic. Walmart, Target, Best Buy, Urban Outfitters, Dick's, Etsy, which is online only, Wayfair, which is online only. Now, of course, those are bigger businesses. But point being, the lesson applies to small businesses, the types of merchants that are Square's bread and butter as well. A ton, unfortunately, hundreds of thousands of small businesses have gone out of business amid the pandemic. But those that are still around and have survived are going to have to really focus on e-commerce coming out of the pandemic. And so this note is a bet that Square can be a winner by serving those businesses that'll be prioritizing e-commerce. It's got a hefty price target on the stock of like 185, whereas the all-time high is 166. And Square, interestingly, and I would argue kind of quietly, is up like 170% in 2020 so far.
And then Dan, a big part of this note is the Cash App for Square. And I guess, am I understanding this incorrectly, maybe, as someone who doesn't follow the company as closely as you do? I'm like, well, I use Venmo, so that's basically, I won't use cash. But it seems like there's a much larger opportunity here for Square to kind of use that ecosystem of users. And they have a great breakdown of profit by cohort. And they're clearly getting better at expanding what is in the Cash App. And that really seems to be a linchpin of this call.
Yeah, absolutely. And in fact, it's really all about the digital wallet race, right? And I'm glad you mentioned that. Here's the key line with what you're asking about. So we believe by reinvesting profits from prior Cash App cohorts, combined with its seller ecosystem, I mentioned that, Square can develop significant network effects and products that will be challenging for other neobanks to replicate in the digital wallet space. So really an advantage that Square has over banks. And we know that everyone is in this digital wallet race. Cash App now, I mentioned the comparison to Venmo, but really it does a lot more than just peer-to-peer payments. You can withdraw money. You can use it as a debit card. There's a Cash App debit card. And as I mentioned, you can buy and trade Bitcoin in there. So a number of these new features, steady growth, of course, not without its competitors in the digital wallet space, but that is a key to the note as well.
Yeah, Dan, in many ways, you can also compare it to Robinhood. You can also compare it to Acorns. You can think about it as supposedly the one-stop shop. And as you say, that ecosystem that's supposed to encapsulate all of your fintech needs. I do want to bring up some news today as well. Square did announce a commitment to invest $100 million into Black communities. Of course, Jack Dorsey has been very vocal about supporting Black Lives Matter, also committed $1 billion of his own Square stock in coronavirus-related issues. A lot of them focus on underserved, underprivileged communities. And I think this is particularly interesting, guys, because we've talked about so-called conscious capitalism for a decade now, right? Supposedly, this has been in the works. It's the underpinning of the future of stakeholder capitalism. But I do feel like we have to give Dorsey some credit here because he is baking it into the business model, right? In the same way that Netflix also pledged similarly, in addition to Reed Hastings and his wife committing to HBCUs and making sure that the pipeline can broaden out, right? This is not just putting a Band-Aid on things. So I appreciate the fact that, this sort of divvying up, it's about 3% of its cash balance right now into different buckets, right? To really galvanize the community and underserved communities and Black small businesses. And so often we found that small businesses in the Black community, they end up serving the larger population around them. It's not just, okay, we support one small store and that's where my money goes. So I do feel as though as much as we kind of bemoaned the fact that a lot of tech leaders had created those initial pledges after George Floyd's death, it's clear that there are some leaders out there who take this seriously, and this is going to be a lifelong commitment. And it's interesting to see Square kind of follow that infrastructure.
Yeah, and I think it's going to be very, it'll be interesting to see as I think our peer group grows into some of these leadership type roles along with these businesses, how much these plans remain in place. I mean, if you think about the construction of a lot of these major companies we talk about, basically everyone who's going to be making decisions, consequential decisions, is probably 15 to 20 years older than us. But I think that our peer group, they're certainly looking towards the future of their workforce, the future of kind of whatever we're calling this American capitalism system we've got, and they're thinking that it's going to have to be something different. And I would agree. While Jack's kind of other endeavor at Twitter is a product absolute nightmare, even though we use it all the time, what he's done at Square and the things that he stands for are certainly very interesting and something I think we're going to be following for quite a long time. All right. Well, speaking of, coming up on the other side of this break, we're going to talk a bit about what's going on in the ESG space. We'll also talk more broadly about the markets. Valerie Grant of Alliance Bernstein will join us for that conversation coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York to talk a bit more about what's going on in the markets, also what's happening in the ESG space. We're joined now by Valerie Grant. She's a Senior Vice President and Senior Portfolio Manager for Responsible Investing at Alliance Bernstein. Valerie, so great to have you on the show today. So let's just start broad markets right now, how you are thinking about the current environment, what the kinds of conversations you're having with your clients right now, how they've changed and sort of where they're at in thinking about this recovery.
It's a very interesting time in the markets right now because I think there's been a lot of focus perhaps on valuation, are things trading at too high a level? But I tend to focus a bit more on the level of volatility and uncertainty in the market. If you follow the VIX, which is an indication of market volatility and investor sentiment, certainly it's come down significantly from the peak in March, but it's still more than twice as high as it was at the beginning of the year. And what that implies is that there is still a lot of uncertainty and anticipated volatility in the market, and for good reason, right? Well, we are very uncertain about the path to a orderly presidential election. There's a lot of uncertainty regarding the COVID-19 pandemic and how it will evolve. There's uncertainty regarding fiscal policy. And finally, but most importantly, there's a lot of uncertainty about the path to economic recovery. And so I think those are the things that are weighing on the minds of clients and weighing on the minds of the CEOs and CFOs of the companies in which we invest.
And I guess as you think about, typically you're going to, have some investors and some managements that are saying, well, we're going through a restructuring next 3 months. Next 3 months is very important. Some groups might say, oh, we're looking 5-10 years down the line. Is everyone right now sort of forced into the same time frame where everyone has to kind of just get through this quarter, figure out all these challenges you just outlined for us? And has that maybe changed the environment a little bit?
No, I don't think that's true. I think that not everyone is focused on the short term. And quite frankly, not everyone is suffering and not everyone is restructuring. So what we've seen is that some companies are actually doing quite well in the midst of the pandemic and hiring aggressively. So if you look at some of the bellwethers, Walmart, Amazon, Kroger, Dollar General, on down the line, these companies are actually looking for new employees, and they're actually confronted with quite tight labor markets. And so I would say that it's really a mixed picture. Some of the large banks, in contrast, are laying off employees. So we're starting to see a bit more unemployment among white collar workers and higher income workers, and that will certainly have a cascading effect. But it's not a universally bleak picture, not at all.
Hey, Valerie and Sean, I just want to get back to what you were talking about with one of those uncertainties in the markets, and that, of course, is the election. We're less than 6 weeks away at this point. What do you think is priced into the market? And also, how big of a risk to the market is what we heard from President Trump yesterday when he basically refused to commit to having a peaceful transition if he were to lose in November?
Well, I think the biggest risk, quite frankly, is continued uncertainty. The reality is that markets can adapt and management teams can adapt to virtually any outcome, because once you know the outcome, then you can plan for it. Then you know how to deploy capital. Then you have a sense perhaps for how the regulatory environment may evolve. But the biggest risk is uncertainty. And so if we have a protracted, contested election, I think the markets will be quite volatile for a period of time until that is resolved. And hopefully it will be resolved peacefully and in an orderly fashion.
Valerie, Dan Roberts here. Let's talk about ESG. I know that you focus on that as well. And amid the larger social and racial justice movement and BLM right now, there's been a renewed focus on governance. That's very good. But because of the pandemic, it kind of seems like the environmentalism aspect has been somewhat lost in the shuffle. That is, there are sort of more important things to focus on. And then not to mention that in a practical sense, I just feel like, with everyone doing lockdown and all the concerns about safety and the virus, there has been, we talked on a recent segment about the lack of recycling. Is that something you're thinking about? How has the approach toward ESG changed in the last 6 or 7 months because of both the pandemic and the racial justice movement in America?
Right. So I do think that your observation is correct to some degree, meaning that in 2019 and in prior years, there was an intense focus on climate change and minimizing future damage to the environment. So that was absolutely top of mind for all investors who are focused on responsible investing. So again, a real anchor on the E in ESG. And I would say that since the COVID-19 pandemic and since the calls for greater racial equality in the US and globally, there has definitely been more of a focus on the S in ESG. And that tends to play out in a couple of ways. First, it plays out in terms of the focus on labor and labor relations, meaning what is the composition of the workforce? Are people actually being paid a sustainable wage? What types of benefits and opportunities for advancement do rank and file employees actually have? Because we know that one of the reasons that the virus was able to spread so quickly is the fact that many people had to continue to work even though it was not safe to do so. The other area of focus tends to be on diversity and inclusion at the board level, at the senior leadership level, and also throughout the organization. So that's a continued focus as well. And then also for my colleagues who, at AllianceBernstein who focus on municipal securities, there's a lot of focus on police departments and funding and racial justice and the flow of capital to various municipalities and from various municipal issuers as well. So that's a different asset class from the one that I invest in, but those are definitely conversations that we're having internally at the firm.
And then Valerie, I guess thinking about maybe the future of ESG as a style, is the line becoming blurred between just regular old investing and being an ESG investor? And what I mean is, isn't it, when you heard us earlier talking about Square and some of the things that they're doing, isn't it the case now that it's table stakes for some of these major businesses to be really thinking about this? And in some ways, again, ESG was a style that got very popular in the last decade, but it seems like the industry is moving towards kind of the things that had been laid out in that investing factor, and kind of, not the other way around.
Well, I think that virtually all investors, whether you're talking about asset managers or asset owners, are increasingly focused on environmental, social, and governance issues. And there's a fundamental reason for this. We know that these can be significant drivers of equity value over time, right? And so you have to pay attention to these environmental, social, and governance issues, because you could have unintended risk in your portfolio that you don't recognize, or conversely, right, there could be opportunities to invest that you may not have uncovered had you not focused on environmental, social, and governance performance. And so absolutely, I think managers across asset classes are considering environmental, social, and governance issues in their investment processes to a much higher degree than they were before. That's true.
All right, Valerie Grant with Alliance Bernstein. Thank you so much for joining the program. Really great to get your thoughts. Hopefully we can have you back soon.
Happy to join. Thank you.
All right, coming up on the other side of this break, we'll take a look at the market. Plus, Dan Halley will join us again. Amazon releasing a whole new set of products that will follow you in your home. We'll get to all that coming up here right after this. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's go over to Jared Blickery now for a look at where things stand in the market with about 25 minutes to go in today's trading session. Jared.
Well, we're seeing a little bit of a sell-off here, and I'm going to get the charts up in the Wi-Fi interactive. And we can see here in the NASDAQ that we've really peaked just before 2 p.m. and have sold off ever since. And if you look at the S&P 500, pretty similar here, just heading for the session lows. And we are seeing all three indices now in the red. Let's take a look at some of the stocks that are driving this action. In the NASDAQ 100, we can see a little bit more red than we did 30 minutes ago when we started the program. Facebook is now off 0.5%, although Alphabet and Microsoft and Apple all up not quite 1% for any of them right now. Tesla, which had been up 3%, up about 1% now, and NVIDIA up only 1.3%. Well, let's take a look at the market leadership here in terms of sectors, and we can see utilities, staples, materials, and real estate, and then tech. Those are all green. Interesting leadership there, kind of defensive, what you would expect with the 10-year T-note yield down, which it is 1 basis point today, kind of seen that correlation go up over the last week or so. To the downside, healthcare off the most. That's down nearly 1%, and then energy off about 0.5%. We'll just dig into those heat maps just for a second here. And this is pharmaceuticals, and we can see only Merck, Sanofi, and looks like, well, that's not the right chart. AGN is up, but not very much. And then also in the energy space, a lot of red here. We did see crude oil kind of volatile. The big majors over in Europe have been largely positive today. That would be Total and Royal Dutch Shell, but energy in the US has been underwater just about the entire day. Back to you, Miles.
All right, Jared Blicker, we'll check in with you after the closing bell. All right, well, earlier today, Amazon announcing a whole bunch of new Echo devices. Dan Howley joins us now to tell us what we need to know about all of this. Howley, and I guess my first question would just be, so I guess Jeff Bezos' statement a couple years back that he's most excited about Alexa and Echo would still be true, given everything that we saw today from them.
Yeah, today was really kind of a big refresh of a lot of Amazon's products that it has now. There's going to be a new Echo. Instead of that cylinder design, we're going to get these kind of spherical designs for the original Echo, and then the Echo Dot, as well as the Echo Dot with a clock. That's going to also have a spherical design. Enhanced Alexa capabilities. Alexa's going to sound more human-like, so when you have a conversation with it, it's not going to sound like kind of a stuttering robot. But it'll have kind of a conversational flow to its voice. They also announced, in partnership with Ring, some wild products. One of them is the Ring Always Home Cam. This is literally an in-home drone that flies around your house. And if you use it in conjunction with the Ring alarm, if the alarm trips, this drone will take off from its landing spot, fly to wherever the disturbance was, and then stream video to your phone wherever you are so you can see what's going on in your home. It's completely bonkers. You can also set predetermined paths for it so they can check out different parts of your house, and then it'll fly back to its docking station. And it's $229. Now, importantly, part of the design is that the blades are going to be encased, so they're not going to be exposed, and they won't clip walls or potentially your cat or dog, whatever, or your kids, I guess. Those are important too. And then also what they announced is Amazon's new cloud gaming platform called Luna. Now, this is available through early access. You need an invitation. It's $5.99 a month, and it's Amazon's biggest leap yet into gaming. It's a $160 billion business. They want a slice of it. They already have their Twitch game streaming platform where you can watch people stream their games. A lot of personalities have jumped onto that. But this will allow you to play games on any platform of your choosing, whether that's your Android phone or tablet. Importantly, iOS devices, though that'll be through web-based apps rather than apps themselves that you would download through the App Store, on your Fire TV or your Chrome devices. And this is really going to rival something that Microsoft offers called xCloud, part of its Xbox Game Pass, as well as Google's Stadia. These are the three players that are really the biggest in the cloud, and now they're all offering their own cloud gaming platform. It'll be interesting to see where this goes. But look, Microsoft is the leader right now, and we spoke earlier today to Microsoft VP of Gaming, Phil Spencer, and they are, really just going straight towards cloud gaming. They believe that they have the best technology, and right now it seems as though they do.
Hallie, you were on this program 24 hours ago talking about how compelling getting a cheaper Apple Watch would be, but ultimately you bought the Series 6, no question about it, just calling you out here. But I want to ask about this interconnectedness of Amazon's product mix. So I'm particularly interested in the Ring camera for the car. As I understand it, one of them will debut specifically for the Tesla, but we're looking at a Ring car alarm, a Ring car cam, and a car connect. How do you anticipate all of these flowing together, from the home to the car to working out with the new fitness band? Do you think it'll be a seamless process? Will it become Apple-esque in that way, or do you feel like there's still a long ways to go here?
I think that's the ultimate goal. Amazon's devices are great. They do have incredible voice capabilities. I think, you can still kind of rank it where it's Amazon's voice capabilities and recognition are up here. Google's is here. Siri is around here. But as far as information gathering and capabilities, it's Amazon. information, it's Google, but the capabilities aren't nearly as good as Amazon. And then Siri's kind of around down here with all that. But I do think that what Amazon needs to do is just kind of polish the software, right? The most interesting part about what Apple has to offer is the software looks and feels like you're in the future for the most part, right? You use that software and you recognize, ooh, this is well done. It's intuitive. I don't see that as much with Amazon, but what they're trying to do is, as you said, make this a cohesive ecosystem where you wake up in the morning, talk to Alexa on your nightstand, get to your car, talk to Alexa, get to the gym, talk to Alexa. And it basically allows you to be one with Amazon almost. But I do think over the long term, they will iron out the software kinks, and it will be kind of a platform that will rival something like Apple.
So I guess they're not worried about the fact that, to me, having an Echo is kind of a take it or leave it. I got one. I'd never want another one again. They're like, you're an idiot. That's a one-off. This is a thing that's real.
Yeah. I mean, I think really they want this to be, the end all be all, right? And a lot of companies are getting into cars now on the new Apple Watches, and then the iPhones. They're having ultra bandwidth connectors on them, so you'll be able to unlock your car with your watch or your phone. You already have Amazon in certain cars. You could tell Alexa to start certain cars from in your home. So this is just kind of a natural evolution with Ring being part of this. They're obviously the security arm of Amazon. It's really kind of bringing everything to bear so that Amazon truly becomes a greater part of your life. And look, I order something from Amazon at least every week. I watch Amazon Prime Video. They really do kind of integrate themselves very easily into your home. And now they want that to be the same with your car and with yourself.
And Dan, just very quickly to piggyback off Miles' point about people who might have one and no reason to buy another, anecdotally, what about the people who still have never bought one of these smart speakers and are still reluctant? I'm talking about myself here. Just don't see the case for them. Do you see Amazon gradually over the last few years gaining more of those people, convincing them to come over and try one, buy one?
I think people see it in other people's homes, or they eventually just break down when they see a sale, certain things along those lines. One of the interesting things is they're trying to add more privacy to it. So the Echo Show, for example, they have a camera on it, and there's actually a physical slider that will block the camera, and you'll see a little red piece of tape there, almost similar to. It's better than, but similar to when people put the sticky tape on their cameras on their webcams. But I think it's important that they're doing that. It shows that they recognize people think one of the issues with the Echoes is privacy. And there have been certain problems with this privacy before, people's transcripts going to the wrong people, people being able to speak through speakers before. So I think Amazon recognizing that and working to kind of improve that would go a long way in convincing more people to get on the service. But look, if I can tell my speaker to play Taylor Swift whenever I want, I'm going to do it.
All right, Dan Howley, go enjoy. I don't even know the names of the songs on the album because it just kind of loops endlessly in my home. I think August is one of them. Last Great American Tragedy, something like that. All right, Dan Howley, we'll talk to you later. All right, coming up on the other side of this break, we're going to talk about what's going on with the economy. No stimulus passed. Where do we go from here? Joe Minerick will join us for that conversation coming up here in just 2 minutes. Welcome back to the final round here on Yahoo Finance. Miles Other with you in New York. Let's talk a bit about what's going on in the economy right now. For more on that, we're joined by Joseph Minarek. He is the Chief Public Policy Economist with the Conference Board. Joe, great to have you back on the show. So let's kind of think about this through the lens of what we heard earlier today. Initial jobless claims remain discouraging. The housing market continues to exceed pretty much anybody's expectations. As you kind of take stock of the economy right now, how encouraged or discouraged are you by your kind of basic lay of the land take?
You're right that if you look from sector to sector, it's disorienting. It's, of course, like nothing we've ever seen before. Personally, I'm concerned. It's clear that the people who are hurting are the people who have the least to protect themselves. That is worrying. The fact that Washington is not responding is troublesome. The possibility, of course, that financial markets will start to become discouraged is always there. We're in an election season. Washington cannot walk and chew gum at the same time. Throw in the Supreme Court vacancy. There's a vacancy in policymaking, which is very worrisome at this time.
And, if we had this conversation 3 months ago, and I think we probably did, we said, there's certainly needs to be some kind of secondary stimulus package. And I mean, as you know well, lawmakers are typically only motivated to do anything in a crisis, in the most acute phases of the crisis. And I think a lot of policymakers now think that may have passed. Now, we heard the Fed this week reiterate that it is still needed for more fiscal support. But how concerned are you that we may pass through this entire period with that one CARES Act package, and everyone else will just, sort of drag their feet and we'll go on with this uneven recovery?
That is a concern. I was having a bull session with some of my friends from the time I've spent in Washington a couple of days ago, and one of the concerns that was one possible trigger for action would come in the first week of next month, which of course is going to be the last employment situation report, the monthly report that we have before the election. To this time, people have been looking at the trend lines and they seem to be improving, although too slowly. If we get to that employment situation report and the numbers start heading in the other direction, it is possible that the folks who are standing for re-election, which is all of the House and some of the Senate and the president, will look at those numbers and say, holy cow, we can't allow this to sit and fester for another month before folks go to the polls. So that's one possible turning point, but that's really the only one we've got at this point between now and the election.
And I guess, kind of piggybacking off that, is it surprising to you the way the conversation around the economy has, at least in my opinion, quickly become second, third, maybe fourth? Now, granted, an opening on Supreme Court is a massive story, especially given how that was handled last time. But we are still in an economic emergency of sorts, at the very least. And I guess I'm a little surprised maybe that it has become a secondary concern to sort of everything else going on politically.
I think it is surprising. There is enough to worry about in the economic outlook that you would think that going into an election, both sides, including the president, would want to address this problem. Now, a pandemic is not something you deal with every day. Yes, it does take an awful lot of people's attention. Throw in a Supreme Court vacancy and you've got a truly extraordinary situation. We've got three things going on here that are extremely unusual. But even so, you would have thought that response to today's economy would be one thing you could do. It would be a no-brainer for Washington to respond. And yet you've got the differences between the two sides. You've got business liability protection versus financing for states and local governments, hanging this up as that's one of the important standoffs. And, that plus the concern about unemployment compensation benefits that some see as being too generous. Our unemployment system, of course, is pretty creaky and runs state by state, which makes adjusting it in a situation like this very difficult. But all that said, you would have expected some agreement and some action.
All right, Joseph Minerick with the Conference Board. Joe, always great to get your thoughts. I imagine the next time we'll speak, it'll be after the election. So I guess good luck to all of us out there, and we'll see you on the other side.
Okay, maybe after we know what happened in the election.
Well, if it's in November, there's no guarantees, of course, as you know. All right, Joe, take care. Thanks for joining. All right, coming up on the other side of this break, we'll keep our eye here on the market. Jared Blicker will join us for a quick update on that. We're back with that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. A little under 5 minutes to go in today's trading session. Jared Blickery, been an interesting last hour of the day, really been an interesting day all the way through. What stands out to you here?
Yeah, just looking at the Dow intraday price action, you can see we're just barely above the unchanged, up 30 basis points or about 1/3%. And we peaked around 130, and that was just about when the hearing with Mnuchin and Powell, the second, well, actually, it was only Powell today. I believe that was ending. No, I take that back. It was Mnuchin too. Let me get my facts straight. NASDAQ here a little bit better, up about 0.5%, but you can see giving back most of the day's gains. And then the S&P 500, that's up about 1/3%. Now the Russell, the only one in negative territory right now, but that could change, down only about 5 basis points. Here's the Dow Transports today. They're not doing much, but over the last 3 months, we can see the trend has been up, although they flatlined over the last few sessions here. The SOX, that's also off of its highs here. We gave up quite a bit when we had that initial sell-off earlier in the month, but now kind of stabilizing around 2,100 or just above that level. And got to take a look at the dollar here. And I will find that. Here we go. It's down, but it had been up earlier. And this is important to note because this has been a major pain trade for a lot of Wall Streeters. And here we see it on the candlestick chart. Did talk to Keith Bliss earlier. He thinks it's set for a reversal just based on the fact that it's oversold. A lot of people saying that about the NASDAQ, but on the flip side, that the NASDAQ is actually oversold as well. So let's take a quick look at the NASDAQ 100 heat map. Big guys largely in the green now, not too much red on the left, except for Adobe, that's down about 45 basis points, but Apple up about 1% and Microsoft up 1.3%.
All right, 3 minutes to go in today's trading session. On the other side of this break, we're going to have the closing bell live from the floor of the New York Stock Exchange. We're back with that in just 2.
Welcome back to the final round on Yahoo Finance. I'm Shauna Smith. We're shaping up at the last 30 seconds of trading. Dow, S&P, and NASDAQ all in the green. The Dow up just around 0.2%. S&P holding on to gains, and the NASDAQ was the outperformer all day. Seems to be right now as we head into the close, with it up just around 0.3%. And that does it for the trading day today. Again, all three of the major averages closing in the green. It was a pretty volatile trading day when you take a look at the range. The Dow swinging in over 500-point range, closing to the upside, though, up just over 50 points. The S&P up just around 0.3%. It's been a very volatile past couple of days. The S&P has traveled in a 100-point range over the past 2 days. And taking a look at why we saw a bit of a turnaround this afternoon in the market, it was led by a lot of those tech names. Now, they are closing off their highs of the day, but Amazon, Apple, and Google all up just around 1%. Facebook also looking like it eked out some gains there. Goldman, it was a top performer in the Dow, up just over 4%. It looks like UBS upgrading the stock to a buy, saying that the potential election volatility could help the bank in the fourth quarter. And investors are really digesting the risk that's out there in the market. So concerns about the pandemic, a contentious election. We got that weaker than expected reading on initial claims this morning, rising week over week, coming in at 870,000. So some signs there that the recovery in the labor market is stalling just a little bit, but it wasn't all weak data. Again, housing coming in very strong. We got that new home sales number out this morning. It was another strong report, a 14-year high. So of course it remains to be seen how much some of that strength in housing can offset the weakness in the other areas of the market. But I want to bring in my co-host for the next 30 minutes, Miles Udlin. And Miles, when we take a look at the market's action today, it almost seemed like the market was searching for direction for most of the trading day. Stocks did though stabilize just a little bit, but what do you make of the action and really the volatility that we've seen in the market?
Yeah, I mean, I think, look, I think it's now becoming a more consensus view, and part of it is driven by mean, look, we don't need to get into how consensus is formed, but the fact that the election is now, I think 40 days away from right now. And so you back out the weekends, you really only have, 30, 35 trading sessions before you get to that. Many Wall Street banks are out talking about there will be, uncertainty around the election, contested, however you want to phrase that, but that November 3rd and November 4th don't necessarily deliver us an answer is a scenario that more people are braced for. And you look at the S&P right now, below its 50-day, above its 200-day moving average. In that kind of territory, you are going to be looking for direction. You are going to feel directionless, I think, as a market more broadly, because you've broken the intermediate trend. You haven't yet tested the longer-term trend. And so this is sort of the market we have right now. And it seems likely, because, again, that November 3rd date is coming up very quickly, that we're not going to get something like resolution before that. So whether this correction is some kind of long, doesn't matter how long it's drawn out or how steep the correction is, it's now a corrective phase for the markets. And it's really about the answer we don't know and can't know for some time, which is going to be who the next president is. After that, we can figure out where we go from there. But with a market, again, that sits below or sits between those two important moving averages with these kinds of outstanding questions, this is kind of the market we have.
Yeah, certainly as well. To help us get a little bit more clarity on this and the recent volatility that we've seen in the market, I want to bring in our first guest. We have Matt Orton. He's director and portfolio specialist here at Carrollton Tower Advisors. Excuse me there. I lost my place in the rundown. But Matt, let me just get to you just in terms of what we've seen recently. When we talk about the volatility in the market, the wild swings that we got today, the Dow traveling in a 500-point range, how should we be thinking about this?
I think it's a really interesting point that Miles had brought up, Shauna, earlier, is that the market is in between it. We're in an in-between phase. And if we look back to what happened in June and July when we went through a sort of corrective process as well, it took a while for the market to really find footing, and it took some more meaningful catalysts. Right now, there aren't that many catalysts outside of gathering more and more uncertainty. So when we talk to clients, I tend to describe this period as a little bit of indigestion for the market. We've shot up really, really far. We just went through a little bit of a corrective process, taking out some of the froth from the really high-flying performers in the information technology space. And right now, with an absence of many catalysts as we head into earnings season, we're likely going to continue to move sideways. But when you do have pullbacks in the market, it's important to keep a broader perspective of what has been driving the long-term trend, which in my opinion is still up. There's a lot of secular growth themes that are still benefiting sectors like information technology. Given some of the uncertainty around COVID, working from home is still going to be a theme that plays out in the marketplace. You just had big sell-offs in some of the large tech names, which could present opportunities to reset or get in. But also there's been a broadening out as well. So when there's weakness in some of the cyclical names that could benefit from longer term strength in the US economy, those areas start to look a lot more appealing as well. So we try and really keep a bottom-up focus on what is going to drive stocks in different sectors going forward, and try and use some of this uncertainty as an opportunity to get back in, reset our portfolios, and make sure that we are diversified going forward.
Yeah, Matt, it's interesting what you were saying just in terms of the market lacking any catalyst at this point. I guess my question is, can the market resume any meaningful gains, do you think, without more stimulus? How critical is it that we get something from Washington?
It's a good point, Shauna. We heard from Powell earlier this week basically saying, prodding the government or pleading with the government to pass some sort of stimulus measure. The challenge now, and I think part of the weakness we had earlier this week, is that now you've had a wrench thrown in potential stimulus plans with a new Supreme Court justice that might take precedent in terms of a legislative agenda. But that being said, there was encouraging news today with Republicans and Democrats saying they're willing to start negotiating again on fiscal stimulus. It's heading into an election. No one wants to be the person saying, I'm the one who held up fiscal stimulus. So if there's some sort of hope or some sort of direction that we can give the market that we are starting to come to a compromise, that's probably going to serve as enough of a catalyst until we start to get to earnings season and really hear from management teams what trends have been benefiting their companies or possibly hurting their companies, so that you can really make sense of where we are from a macro perspective.
Matt, how should we be looking at the risk of additional closures? We've heard the president say there are no additional economic closures on a federal level, but you look at, for example, a state like Indiana, they are going full capacity in restaurants, gyms come Saturday. And yet we just had a guest on in the last hour who said the data doesn't support that. So that seems to suggest that the spread's going to continue with the virus. How should investors be looking at those numbers right now when we have started to see it tick up again?
That's a large part of the uncertainty that we've been seeing in the market, because even outside of the US, when you look at what's happening over in Europe right now, the UK considering fresh lockdowns in the country, continental Europe going through another surge in cases. How they deal with it could be a precursor to how some states in the US might deal with it. But that being said, it's really hard to know where people are going to go. I think there's a hesitancy on the part of anyone in the US to completely institute full lockdowns again. I think that's going to be really, really tough. But that's also why when we're talking to clients, we're really pushing the idea of keeping diversification and not leaving the previous winners. Even though we've just gone through a little bit of a reset or taking out some of the froth from tech, those themes are still going to be important, because whether or not we fully lock down, we partially lock down, or people are still just a little bit more uncertain and more hesitant to jump out into the broader economy and start spending again on travel, even if it is local or domestic, you still want to maintain exposure to some of those companies. And so when we think about how you can use this as an opportunity, think about areas that are going to be necessary regardless of what happens. So in information technology, IT services have broadly lagged the information technology sector, and the need for Visa and MasterCard is still going to be there, especially as you process more and more electronic payments. They've been pivoting their businesses, but they haven't been rewarded as much as some of the software and cloud-based names. Additionally, healthcare has been an area that's both politicized. There's challenges with reopening in terms of whether or not you can do elective procedures. But at the end of the day, healthcare represents 20% of the US GDP, and it's growing at 4% per annum, which is even more than our top GDP rates heading into this. So that's a natural place to find growth. So we look at areas that have exposure to chronic diseases like diabetes, heart disease, that are going to continue to grow in the population, and finding companies that provide a solution to that are covered by Medicare or Medicaid or general insurance policies. So regardless of what's happening with respect to lockdowns, we're trying to find these sorts of opportunities in our portfolio so that the impact of a fresh shutdown might help us outperform in those spaces.
All right, Matt Worden, Carolyn Tower Advisors. Thanks so much for joining us today.
Thanks, Shauna.
Still ahead here on the final round, we're expecting Costco earnings out any minute. We'll bring you those numbers as soon as they break. Plus, Connor Flynn, the CEO of Kimco Realty, he'll join us with the impact that COVID is having on the commercial real estate industry. We're back with that interview in just 2 minutes. Welcome back to the final round here on Yahoo Finance. Well, a study out by the National Retail Federation and PJ Solomon today finding that in July, the number of retailers paying rent almost doubled from June to 65%. So here for more on this and the impact that COVID is having on commercial real estate, we want to bring in Connor Flynn. He's the CEO of Kimco Realty. And Connor, Kimco's portfolio, I was looking at it here before the show, it includes over 400 properties. You have big names like Costco. You also have these small mom and pop shops. And I know a lot of the headlines that have been catching the media's attention has been these retailers struggling or not being able to pay their rent. So what are you seeing from your tenants and their ability to pay rent right now?
Yeah, pleasure. And thanks for having me. Kimco is predominantly a grocery anchored portfolio. So we obviously benefit from having a lion's share of essential retailers that are benefiting in a lot of ways from the pandemic. We saw our grocery anchors do all-time high volumes, mainly from the surge in demand there. And then we're the largest landlord for Costco, Walmart, Target, and they've seen, obviously benefiting from this as well, deemed essential. The issue that we see and where we've been working overtime to try and help is the small shops, the mom and pop tenants. Those are the ones that typically don't have a rainy day fund or a big balance sheet or cash on hand to manage through this process. There's a lot of uses that have deemed non-essential that were forced to close. Restaurants have capacity constraints on them. So what we've tried to do as a landlord is activate green space, activate sidewalk cafes, and then we've installed curbside pickup across the entire portfolio to help those folks really navigate and try and activate the home delivery model.
It's interesting when you talk about navigating the home delivery model, because when we talk about the direct impact that COVID has had on so many of these retailers, I mean, even the grocery stores, the anchored centers there for your business, I mean, you can't overstate just the impact that COVID has had on so many of these different names. So I know that your strategy has proven at least to be the right strategy, certainly during a time like this. But when you take a look at the future of retail, what it's going to look like 5 or 10 years from now, how do you see that playing out?
So the lines are definitely blurring. When you look at the old retail model, it's really sort of starting to merge into an omni-channel retail model, where most of the best-in-class retailers today are not just single channel. They're utilizing their stores as distribution and fulfillment points. And where we benefit from that is our assets are located in that last mile. All the retailers are trying to solve to get as close to their customers as possible and to deliver the goods any way they choose. So whether it's delivered to the home, whether it's buy online, pick up in store, whether it's curbside pickup, or whether it's shopping in the actual store. And so what you're seeing is the players that have been able to invest in omni-channel have started to utilize their stores as a differentiator. Because they're the closest to the customer, they're actually able to service that customer faster in those ways.
Hey, Connor, Rick Newman here. With regard to those smaller retailers that are struggling to pay their rent, is it getting worse or is it getting better? Do you feel like you can see a pathway to the other side of this thing, or is it more like winter is coming and it's going to get ugly?
So all of our shopping centers stayed open through even the worst of the pandemic. We have up to now 96% of our tenants are open and operating. We're collecting over 85% of our rents, and the small shops definitely are the ones where we're trying to bridge them to the other side. I think to your point, winter is coming, right? So there's a lot of opportunities for in the warmer climate areas to activate outdoor space. There is a concern, obviously, with capacity constraints inside when they don't have the ability to have a sidewalk cafe or a picnic area to service customers. So that's where we continue to think and brainstorm, what can we do as a landlord to help them activate their curbside pickup program, to do more with ghost kitchens. One of the interesting tidbits I've found from a small operator is they're predominantly a brunch player. So they do a big business during the beginning of the day, and then they actually close in the evening. Well, what they've done is they've come up with a strategy to utilize their kitchen as a ghost kitchen and activate a taco concept in the evening. So even though their fixed costs are the same, they're actually able to utilize that kitchen to be able to drive more sales in the afternoon for just purely curbside and delivery model.
Connor, what do you see as the role of the government in helping with that bridge? We've heard so many stories about small restaurants, for example, not being able to pay the rents, landlords not necessarily giving them relief because they've also got to pay. And what you've really got right now is just a moratorium that's in place, kind of kicking the can down the road.
No, you're exactly spot on. I think originally when they launched the PPP funding round, we thought long and hard, how do we go about helping our small shops navigate that process? And we launched a tenant assistance program, which gave them the ability to use an outside attorney free of charge on Kimco's dime to have them navigate that process to get their documents in place so they can really hopefully get those fundings from the government. Over 600 tenants signed up for our tenant assistance program. They generated over $20 million of PPP funding, which was great. You saw the government actually working there. Now at the program exhausted or shut down, we're starting to see how does Kimco become a bigger partner there? What else can we do to help these folks bridge the other side? Do they need additional working capital to get their store or their business up and running? Because my biggest concern is these small businesses, they're like the fabric of the community. Many times they're generationally owned. Many times they're run by people that live and breathe the community. So we want to make sure if they were a strong business coming into this, Kimco is well positioned to utilize our balance sheet to help them bridge the other side. We have over $2 billion of dry powder. We have almost double the amounts of liquidity of anybody in our peer group. So we're fortunate. We're an unsecured lender. We just did a 1.9% bond when others are secured and trying to put mortgages on retail properties that are difficult today. We're in a unique position to hopefully not only weather the storm, but be able to thrive on the other side.
Connor, I want to ask you more of from an outside view looking at retail right now, because we've been talking about the record number of store closures over the past couple of years. We're expecting that again this year. And it seems like there's a supply and demand problem when we take a look at retail and the landscape right now. To what extent do you think the U.S. is still over-retailed?
So you're exactly right. There is an oversupply issue in the United States. If you look at us versus any other developed country, we're like 4 or 5 times more GLA developed versus other countries. So we recognized that about 5+ years ago at Kimco and did a massive transformation of the portfolio to get to markets that have higher barrier to entry. And what I mean by that is there's a supply and demand balance there. So it's harder to develop in certain trade areas than others. So we sold over $6 billion worth of real estate over the past 5 years to get to where we believe there's a balance. And that what I mean by that is higher density. So typically a shopping center is 80% parking lot. And so if you think bigger picture, if only 20% of it is developed by single story and you're in these high dense areas, you're sitting on gold that you can unlock through redevelopment by entitling, whether it's multifamily, whether it's office, whether it's hotel, another use that can complement the retail. And we look at the retail as an amenity. And if you look at the combination of those, the amenities really drive premiums on apartments. And so we have actually 5,000 apartment units entitled on our portfolio today. We're striving for 10,000 over the next 5 years and feel like with the amenity that we bring to the table, we have actually a pretty unique set of opportunity sets in the future.
Connor Flynn, great to have you on the show. We really appreciate you taking the time here, CEO of Kimco Realty. We hope to have you back soon.
My pleasure.
I want to get to some breaking news here after hours. Costco is out with their earnings report. Miles has the numbers for us. Miles.
Yeah, Shauna, another strong quarter here from Costco. The stock, however, is off about 2% in after-hours trading. Running through the numbers here, earnings per share, $3.13. The street was looking for something closer to $2.85. Revenues for Costco's fourth quarter, $53.38 billion, better than the $52.46 that was expected. Same-store sales in the U.S. up 11%. Same-store sales across the company's portfolio up 11.4% during the quarter. E-commerce sales up 90.6% in the company's fiscal fourth quarter. Now, just a couple of items that the company flagged here in the release. Hurting earnings by 47 cents per share was a $281 million charge related to increased wages. They're calling them COVID-19 premium wages, as well as sanitation costs. The company also paid down some debt, early paid in prepayment of some of that debt, and they took a small charge on that. So again, just a couple items in there that Costco flagged. As folks know, not the most robust earnings release, but the numbers there, again, beating on the top and the bottom line. And again, with total company same-store sales up 11.4% and e-commerce up 90.6% during the company's most recent quarter. Sean.
Yeah, certainly interesting here when we look at the after-hours action in the stock. It was off just over 2% now, off just around 1.5%, but Costco has been an outperformer so far this year. All right, we're going to take a quick break here on the final round, but when we come back, the White House unveiling some details about President Trump's new healthcare plan. We've got those details for you right after the break. Welcome back to the final round. We have a developing story that we're watching here on the show. President Trump today is set to give a speech on his healthcare plan in the swing state of North Carolina, and that's expected to get underway in just a little bit from now. And he will unveil his America First healthcare plan. Rick, I know you were just on a press call with the White House earlier this afternoon where they were talking about some of the details in regards to what Trump plans to do for healthcare. What do we know at this point?
Well, one of the things that's going to happen later today is Trump is going to sign an executive order, one of his favorite tools of government, that is going to declare it to be the policy of the United States to always protect people who have pre-existing conditions. Now, people who are listening to this might say, wait a minute, I thought the Affordable Care Act already protected people with pre-existing conditions, and it does. It prohibits insurance companies from charging people more or denying them coverage if they have pre-existing conditions, and that affects around 55 million Americans under the age of 65. So why is Trump doing this? The reason is that he wants the Supreme Court to strike down the Affordable Care Act. It's going to hear a lawsuit in the case on November 10th. The Trump administration is a party to that lawsuit. They've sided with the plaintiffs who want to strike down the ACA. So Trump wants to have this policy declaration in place if the Supreme Court does end up striking down the ACA, because part of the ACA is that protection for people with pre-existing conditions. Now, again, this would just be an executive order. It's not a law, so probably does not have any actual legal tenacity. And a couple other things Trump says he wants to do. He wants Congress to pass new legislation to prohibit surprise billing. And in a vaguer sense, he says he's going to come up with new ways to lower costs, but he hasn't said what those are.
So, Rick, it sounds like this is almost a photo op, for lack of a better way, I guess, to describe it. There's nothing really changing here, and it won't really have any, I guess, from my understanding, or I should ask you, is it going to have any meaningful impact on providers or on insurers at this point? It sounds like it won't.
No, nothing Trump is that Trump has talked about is going to talk about today, as far as I know, is going to actually change any policy. And of course, Trump cannot change the law. Only Congress can change the law, although he certainly tries through these executive orders. The whole reason Trump is doing this is because there's a big hole in his platform in terms of healthcare. Joe Biden, the Democratic presidential nominee, of course, has a detailed healthcare plan. He wants to lower the Medicare eligibility age from 65 to 60. He wants to fix parts of the ACA that are not working well. He also favors a public option for people who cannot get affordable health insurance and a lot of other things that go on for pages and pages on his website. Trump has had nothing really. So he needs something just to be able to point to say, this is my healthcare plan. And they're going to try to differentiate it from Biden's by saying we favor more choice and lower cost. And all Joe Biden wants to do is get the government more involved and spend more taxpayer money.
And Rick, he's almost forced to do this because isn't he trailing, isn't Trump trailing Biden in the polls when it comes to healthcare and just in terms of what the Americans' perception is between both of their plans?
Absolutely. This is probably where you'll find the biggest gap between Biden and Trump in terms of who voters think would do a better job. The Commonwealth Fund just released a poll. They asked people in 10 swing states, those are the close states that are going to decide the outcome in November, who do you favor to lower healthcare costs, to handle the COVID pandemic, and to protect people with pre-existing conditions? And overwhelmingly, voters in swing states say they favor Biden on almost every single instance. So Trump has a lot of ground to make up, and this is kind of a last-ditch plan that wouldn't really do much, but at least he's saying, I get it, and I'm paying attention, and I'm going to protect people with pre-existing conditions if the law no longer does.
All right, Rick, thanks so much. Well, that does it for us here on the final round today, but make sure to keep it right here on Yahoo Finance. 2020, A Time for Change is coming up next, and we'll be talking to New Jersey Senator Bob Menendez. Again, that happens right after this quick 2-minute break.
Welcome to Yahoo Finance. I'm Kristen Myers, and this is 2020, a time for change. Supreme Court Justice Ruth Bader Ginsburg's passing has ignited a political firestorm. Republicans have promised that the president's nominee will get a vote on the Senate floor. And if that happens, one of the people casting a vote will be New Jersey Democratic Senator Bob Menendez, one of only 2 Senate members of the Congressional Hispanic Caucus. He says he's more concerned than ever about what's at stake with a more conservative Supreme Court and its disproportionate impact on Black and Latino communities. Take a listen to our conversation.
What's at stake is the reality that for millions of Americans, including a disproportionate number of Latinos and African Americans who ultimately achieved healthcare for the first time, healthcare coverage for the first time under the Affordable Care Act, that Affordable Care Act is presently before the Supreme Court and at stake of being struck down. If it's struck down, my Republican colleagues who have had for more than a decade the opportunity to have their own plan out there have nothing. So millions in the midst of a pandemic where Latinos and African Americans have been disproportionately affected in both illnesses and deaths will have no health care coverage. They will have no pre-existing conditions protections, which the Affordable Care Act provided. They will have no coverage for the uniqueness of some of the minority health realities that we face. Women will no longer have a choice over their personal health decisions. And civil rights, voting rights, immigrant rights are all at stake. So that's what's at stake, not just in this Supreme Court nominee, but that's what's at stake in this election.
Are you concerned just more broadly about, or actually, I should say more specifically about this particular election, that this election could potentially be in the hands of the Supreme Court if there is a challenge?
Well, it worries me deeply, deeply, as it should disturb every American, that the president said that, in fact, we need to get the Supreme Court justice on the court because they will decide the election. In this democracy, I thought the people decide the election, not the Supreme Court. And so when that is your mentality, that somehow you're going to create the environment in which you're going to throw it into the courts so that your court that you've helped pack ultimately decides the election in your favor, that is a subversion of our democracy and everything that we have fought for since the inception of the Republic.
Now, Senator, I know you were talking just a moment ago about healthcare, which is obviously the huge topic of the day around the coronavirus pandemic. You have proposed a commission on coronavirus styled much like the 9/11 Commission. You've called it a bipartisan effort. And I wanted to ask about that particularly, because at least when the 9/11 Commission came around, 9/11 was a huge point of unity for everyone in this country. However, this pandemic has been highly politicized and a point of division. I'm curious to know if you're concerned at all, or how much faith and hope you have in the bipartisan effort moving forward of this commission and any bipartisan initiatives and solutions that could come out of a commission based on something so divisive.
Well, our proposal for a national coronavirus commission, very similar to a 9/11 commission, starts off with bipartisan and bicameral support. We have a Republican colleague, Susan Collins, has joined me in the Senate. A Republican and a Democrat have introduced the legislation in the House. We have received a large universe of former Homeland Security and other officials of both parties that have endorsed the legislation. The commission itself will have an equal number of Republicans and Democrats that get appointed. So what the commission is to take a look back and a look forward to understand what went right, what went wrong, what the federal government did right and wrong, what the states did right and wrong, what we need to do in the future in the face of a pandemic or an epidemic. And this is critical for us to be able to learn from this tragic set of circumstances we've had with the pandemic and not to repeat the mistakes for the future.
So to that point about preparing for the future, I know that your commission is also going to be focusing on the disproportionate impact that the virus has had on Black and Hispanic communities. And Hispanic households have obviously very severely felt the impacts of this pandemic. I'm wondering if there's a thought here or even a hope after this commission wraps up and concludes its findings to create some sort of legislation that is going to be targeted in the future to help those struggling communities. As we know, this pandemic did not create disparities, but rather revealed them. Is there a hope or a goal from this commission to essentially help those Hispanic communities better access, for example, healthcare in the future?
Well, it's a great question. And let me start off by saying, we're not going to wait for the commission. For some things that we see now is a reality in the disparity in healthcare and in some cases the discrimination as it relates to Black and Hispanic Americans. We do believe that the commission, because of the nature of it, will have an opportunity for further recommendations in the future as to how we deal with these disparities. I mean, look, the pandemic has wreaked havoc on communities of color. The sad fact is, if you're Black or brown in America, you're more likely to be infected by the coronavirus than if you're white. You're also, unfortunately and tragically, more likely to die as a result. Latinos have a 2.8 times higher rate than white Americans. Hospitalizations are 4.6 times higher. The death rate is 1.1 times higher. And so in many states, actually, the rates of infection and death among Latinos and African Americans outpace their share of the population in that state. So these are just the tragic realities. But when we look at underlying health issues, comorbidities, diabetes, heart disease, lung disease, or some within our communities, we understand that we need not wait for the commission to deal with that, but we look forward to the commission having a universal and complementary set of recommendations for the future.
So to that point then, Senator, you were obviously just listing some statistics there from the CDC. Case counts for Hispanics 2.8 times higher than whites. I believe you mentioned that death rate 1.1 times higher than white folks in the country. So then what can Congress do right now to essentially improve the health outcomes of this virus for Hispanic and Black households in the country?
Well, for one, as someone who's one of the authors of the Affordable Care Act as a member of the Senate Finance Committee, we need to build upon that. We have to create greater access for communities of color. We have to deal with some of the underlying, health issues that these communities have. We also have to recognize the fact that for both African Americans and Latinos, they're more likely to be essential frontline workers, meaning higher exposure to the virus. As a result of that, they're doing some of the toughest work, so all of us can stay home or all of us can safely distance. We should be making sure that in the workplace for these particular workers, considering the underlying health conditions that they have, that there are further protections. Those are all things that Congress can be doing right now.
I want to ask you now about stimulus. It's, of course, stalled in Congress, and you yourself called the Republican stimulus package a, quote, sham plan. As Congress continues bickering, partisan bickering over a plan, whether it's going to be $2.2 trillion, $3 trillion, et cetera, we are continuing to see millions of Americans suffer, millions of Americans still on unemployment. So I guess the question is, when can Americans expect some sort of economic relief, and how much are Democrats willing to give by way of concessions to get folks something?
Well, let me just start off by saying it may seem to some as partisan bickering, but if Democrats had not stood up when we were comprising and composing the CARES Act, that $600 that people got extra in unemployment and extended unemployment benefits and gig workers included on unemployment would not have existed. Now, some people may have considered that partisan bickering. I consider it one of the most significant things that we had for people not to go ultimately in desperate economic straits. If it wasn't for our engagement, the PPP program would not have extended to really, truly small businesses, women and minority-owned businesses. But as a result of our effort, it did. So yes, we're not looking for the perfect, even though we believe a larger number is appropriate. But even President Trump recently embraced 1.5 trillion. However, when 20 Republican senators tell Leader McConnell, the Republican leader of the Senate, that they will vote for nothing, as you just asked by your question, obviously something is necessary. So when they're unwilling to vote for nothing, that's a big, big difference in both sides. So yes, we are willing to compromise. We are willing to nearly come into half of the figure that we thought was necessary, but we need Republicans to meet us. And as part of that, we need to help states and local governments that are at the front line of helping our communities, which right now are facing a huge, huge problem.
Of course, that was, again, Democratic Senator Bob Menendez from New Jersey. Well, coming up after a quick break, we will be chatting with National Urban League President Mark Morial.
Welcome back to 2020, A Time for Change. I'm Sabine Marcellus. President Trump plans to announce his Supreme Court pick on Saturday. That means that it'll be a race against the clock for Senate Republicans who want to get a conservative judge on the Supreme Court by election day. So what impact will that have on the country's judicial system? Joining us now is Mark Morial. He's the president and CEO of the National Urban League. Mark, are you worried about having a conservative woman on the Supreme Court? And what impact do you think that would have on the country's legal system?
Well, there's no doubt, and thank you for having me on Yahoo Finance. There's no doubt that to add another conservative to the Supreme Court could unalterably, for the foreseeable future, affect the direction of the court. The court's relatively been balanced between, it's been 5-4 conservative, but you've had Justice Kennedy and now Justice Roberts sort of sitting in the middle of the court, serving as a swing vote from time to time on many important cases. I'm concerned that so much is at risk. Healthcare is at risk. A woman's right to choose is at risk. The fate of the Voting Rights Act is at risk with an alteration of the court. But what I'm also concerned about is just the outright hypocrisy we see from the Senate majority. 4 years ago, they were absolutely rigid and unyielding in standing on principle to say we cannot confirm a Supreme Court justice in the year of an election. Let's let the voters decide. Now they've reversed course on a principle and a precedent they established, which means that the American people are being violated. The sense of integrity, the sense of consistency is being violated because now there's a rush to not only fill a seat in the year of an election, but to fill a seat with almost 30 days to go before the end of voting. People are voting now. The election is underway now. So it's an act of hypocrisy. And I think it's also an effort to hijack the direction of the court, which is deeply offensive to me and something that we have got to resist. My hope is that there are enough Republican senators who stand on that principle and say, we're not going to violate that principle. We're not going to violate the precedent we set 4 years ago for political expediency.
Mark, from the death of George Floyd to the shooting of Jacob Blake, what role do you think Supreme Court justices can have in terms of helping us achieve change when it comes to issues such as police brutality? And do you think President Trump's nominee could help with that?
Well, certainly a justice who's going to be, cases relative to police misconduct and brutality rarely get to the Supreme Court. But I can tell you many civil rights issues and voting rights issues and affirmative action issues do get to the Supreme Court. Less than 10 years ago, and people have talked about Shelby v. Holder. To me, Shelby v. Holder is one of the tragic decisions in the history of the Supreme Court. I think it will be remembered the way the Dred Scott decision is remembered, the way the Plessy v. Ferguson decision is remembered, that they tortured the logic, they misconstrued the Constitution, and they did it all in the name of political power, not in the name of applying the law to the facts or applying the Constitution to the facts. So I think a Supreme Court could be extremely, potentially highly influential with respect to this, but Supreme Courts also set tones in the country, the way presidents set tones, the way Congress, meaning the House and the Senate, set tones as to whether they're going to be on the side of due process, on the side of protection of rights. This is what makes the Warren Court, the court in the 1950s and the 1960s, which really continued to affect the nation into the 70s and the 80s, so influential. They stood up. They shaped jurisprudence to meet the needs of the times. And in many respects, by doing so, they held the country together.
So, Mark, I saw a really interesting cartoon that likened the Democrats and the Republicans to Charlie Brown in the football and Lucy, with Lucy constantly, as we all know, pulling the football out from underneath Charlie Brown, which would in this case be the Democrats. But we're already now in a situation, as you mentioned, the election some 6 weeks away. For the American people and for activists like yourself, organizations like the National Urban League, what do we do now, today, on September 24th, September 25th, October 10th, in the run-up to the election, when the Senate decides, hey, we're going to move ahead with that Supreme Court nominee? What can we, the people, do? Or do we just have to sit back and say, listen, this is going to be a lesson for us in the future. This is a lesson for Democrats in the future.
We have to vote for change. I mean, people have to be willing to say, if you like the direction of the country, if you're better off today than you were 4 years ago, maybe you vote for the status quo. If you are, and I say this in my personal capacity, right? If you are worse off today, and if you believe the country is in the wrong direction, then your option is to vote for change in a significant and meaningful way. What I hope people do is turn out in record numbers. The most powerful thing would be a record voter turnout across the board so that the voice of the people can be heard in this election. But I think we have to call out the hypocrisy, the absolute hypocrisy of the Senate majority, who just seem to be hell-bent to manipulate the rules to grab power. In a democracy, it's the rule of law. In the Senate, precedent is often observed. It's not as though the precedent was forced on them. They set the precedent. Go look at Lindsey Graham's words. Use my words against me. He said, we're setting a precedent here. We need to understand. And very conveniently and quickly, without any deliberation, he switches course and says, I'll vote for whatever the president wants.
Well, Mark, we're definitely going to keep an eye out on that and see what happens if the Senate Republicans try to push through President Trump's nominee before the election. But Mark Morial, we don't want you to go anywhere because we want to continue this conversation after this quick break.
Welcome back to Yahoo Finances, A Time for Change 2020. We are talking with National Urban League President Mark Morial. And Mark, you were just talking about wanting to have a huge turnout. And I want to get to how you think that's going to happen and if you're optimistic, just because of all the doubts that the president has been seeding over how this election is going to actually pan out. And even on the other side of it, in terms of a transfer of power, do you feel like that will suppress the vote?
Well, I don't believe it will. I think what it does is it builds in more resentment and more of a determination to vote. And I think it's an act of trickery and deception and psychological warfare to try to undermine and literally insult the intelligence of the people by questioning the integrity of the voting process. Because you don't like the potential outcome of the voting process, you undermine. Donald Trump did this in 2016. When he was behind in the polls in early October, he raised questions about the integrity of the process. This is an old movie. This is what we call in the neighborhood a wolf ticket, an empty threat, a hollow suggestion. I'm going to resist the transfer of power. These are hollow, empty threats. And I hope people don't take them seriously. But I also hope, as they do to me, as a person, as an American, as someone who's seen members of their family who could not vote fight to secure the right to vote, it's deeply insulting to suggest that somehow the Postal Service is not an organization of integrity. It's deeply disturbing to suggest that somehow there's something wrong with the elections process. And I think the American people are smart enough, intelligent enough, and insightful enough not to fall for sort of these empty schoolyard threats that seem to emanate day to day. So I'm encouraging people, be vigilant and absolutely pay attention, but don't fall for empty threats. Don't fall for hollow suggestions. Right now, you've got an ecosystem working to try to discredit the election. One of the main players in this effort is Vladimir Putin and the Russian Federation, who've embarked on a consistent campaign going all the way back to 2013 and 2014 to suppress African American voters, to create racial division in the country, to play games on the internet. And I think people need to be woke and aware and very offended by it and say, you know what, we're going to stand up for our democracy. Stand up for your democracy. Don't be tricked. Don't be intimidated. Don't be fooled, because that is what the objective is: to trick, to intimidate, and to fool you so somehow you don't go out to vote. You don't believe your vote counts. You believe that the elections process. Now, I bet you that there's a different message going on Donald Trump's social media pages. And I don't think it's about don't vote. I think it's all about trying to get people to vote, trying to get his base to vote. So I'm just saying to people, look, I've been in this game for a little while, and I've seen some of these movies of deception and psychological games being played. It's just being played now from the largest bully pulpit that exists in the world, and that's the presidency of the United States.
Mark, before we let you go, just tell us really briefly about the effort for the community conversation and concert event happening tomorrow. Is one of the goals to help small businesses?
Yes. I mean, we are working to help small businesses all the time, and that's going to be one of its focuses.
All right. Well, we'll have to bring you back, Mark. We always love
ready to
having
come
you
back
on.
again. Want everybody to follow us at Nat Urban League, at Mark Morial. Be part of this ongoing conversation. And I just encourage people to vote, vote, and vote.
Well, hopefully we'll be able to talk to you before the November 3rd election. Mark Morial, President and CEO of the National Urban League. Thanks for joining us today.
Thanks, guys. Appreciate you. And
that is our show. Thank you all so much for watching. Be sure to tune in next week at this time, 4:30 p.m. for our next episode of 2020, A Time for Change.